Hello, my dear future child accountants. Good morning. I hope you are doing great. This chapter name is Advanced Capital Budgeting, which is introduced in your CA Final AFM in your syllabus. Previously, it was part of SFM old syllabus. Then they moved it to IPCC Inter FM, and now they have pushed it to final back. So it's a one full circle. So the students who have written the IPCC under old syllabus would have already covered this. But anyway, we have to do it. So, and also our students believe in first in, first out, learn first, forget first. So you would have forgotten by now. So for that purpose, we will definitely do the things in detail. So primarily, this chapter is investment with risk. That is what is called in your intermediate. I also would like to call that. So in my discussion, in my material, you will come across this terminology, investment with risk. So capital budgeting had things like NPV, IRR, profitability index. They're all the basics which I hope you are aware of it. So for that purpose, problem number 1 is there. Please try it out. That is for your practice purposes. Where we have to move is assuming you know NPV, IRR, the basic calculation of capital budgeting. Let us move towards investment with risk analysis. Risk. So when we consider projects, it is not only sufficient to consider returns, that the projects are profitable, but we should also consider the uncertainties involved, the risk involved, fluctuations involved. To give you a basic idea, just to example purpose, okay? Don't take it personally, don't take it seriously, just for an example and of understanding purpose. If you compare a course like a BCom and a CA, which one will be rewarding in the long term? Or to put the word straight, which will give a higher salary? It's obviously CA. There is no doubt about it. But even then, why do you think most people prefer doing BCom, MCom, MBA and not CA in spite of knowing that you get the best salary out there? That is because of the risk involved. What is the guarantee that you complete CA? So many people don't want to take that chance at all. In fact, if I put it other way around, CA has so much advantage. Even if you don't do it, the experience that you gain during this course over a period of time is simply cannot be substituted. So in fact, there is nothing to lose here. Anyway, let me not talk about those things at this point in time. The point is this: when you select a project, when you want to allocate your capital, it is not only about the returns but also the risk associated with it. From the point of view of business as well, you might be thinking of which business to start, whether to start a branch or not, how many units to produce, whether to take a patent of a company, patent or not. Like, we should also need to understand the uncertainties involved and how to incorporate uncertainty, how to measure that is our point of discussion. For example, you are trying to purchase a machinery. Let's say we'll think about a company now, ethanol manufacturing company. You heard of petrol. I'm not sure whether you heard of ethanol. Ethanol is said to be the future in energy sector. It is supposed to substitute the petrol products, diesel products, the vehicles. Of course, electric vehicles are there. But even the government of India is giving lot of subsidies. It is expected that the coming budget also is expected to have some feature on some good subsidy on the ethanol project, ethanol manufacturing companies. So where does ethanol basically come from? It comes from sugar products. So recently, if you observe, sugar companies, there is a very good rally in last few days or even few weeks, I would say. So you also decided, and now Reliance is there everywhere. Now Reliance, they thought, why not? We start one sugar factory also. I'm not sure it is there. To my knowledge, at least, that it is not there. Now, thinking that you get good support, thinking that sugar is going to be the future, you start the sugar factory, sugar manufacturing company. What if the budget nothing is announced? And what if ethanol products are no more in demand after few days? Who would have thought that petrol will lose demand? In last few months, the petrol price have reduced. I'm talking about the crude oil. Recently, again, it started increasing, right? So anything what you thought earlier may not be there after a particular point in time. There will be uncertainties. There will be fluctuations. About 10, 12 years back, you know who is the number one mobile manufacturing company? Nokia. Nobody would have thought that Nokia will not sustain after some time. Now, number one mobile manufacturing company in India. Now, you don't hear. Blueberry, you know, blackberry, blueberry. I mean, I think blackberry. Blueberry is a fruit. Black. I mean, it used to call blueberry also earlier. The BlackBerry mobile phone recently have stopped manufacturing. It was a craze a few years back. Things change. So when economy change, GST implementation, demonetization, corona effect, macro factors. So when things starts changing, it will have an impact on the business, which you will not know in advance. But in the capital budgeting decision, in the investment decisions, to the extent possible, we have to oversee that. To the extent possible, we have to estimate that. If things change, then what will happen? So how to incorporate risk? And many times you would have heard of this. We should always take a calculated risk. But most people don't know how to calculate risk. Let's try to understand now. In capital budgeting, what are the techniques that can be applied numerically, mathematically to incorporate risk, to incorporate uncertainty? We have these techniques as part of your syllabus. Risk adjusted discounting rate, certainty equivalent approach, sensitivity analysis, scenario analysis, then incorporation of risk through standard deviation, application of inflation, and decision tree analysis. Decision tree analysis was part of your syllabus earlier, but now it is taken out. But I just included so that in case you have some old textbook or you're referring some other author, you should be aware. Decision tree analysis is not part of our syllabus from exam point of view. Let's understand briefly, conceptually about each of these things. Later, we'll take up problems. The first one among them is RADR, risk adjusted discounting rate. Risk adjusted discounting rate. Okay, let me ask you one very basic question. You put the, I mean, I'll ask this question again and again, okay? I'll be asking repeatedly same question because concept is same. So there will be repetition. Try to follow it. You put the money in fixed deposit. You put the money in equity shares, mutual funds, etc. Do you think you expect same return from both? Obviously no. Where do you expect higher return and why? From equity shares or from fixed deposits? Where do you expect higher returns and why? You expect higher return in stock market, in equity shares, in fixed deposit, you get 5-6%. Now it's almost even less than that, maybe 4.5-5%. But you put the money in stock market, same 4-5% is satisfied? No, you expect more. Why do you expect more? Why do you expect extra? Because you take risk. When you take risk, fluctuations, today stock market is down, yesterday stock market is down, day before yesterday stock market is down, earlier to that 5 days the market is up continuously at a stretch. I spent today, I drilled in Bank Nifty. I mean, you may not know what is Bank Nifty, but try to understand the feeling of it. It is down 200 points in 10 minutes, up 200 points in 15 minutes. So these kind of fluctuations, you need to have your heart stronger. You are taking so much of risk. When you have risk, you expect higher return. It's called as risk premium. Similarly, when you do CA, you expect more salary than a BCom? Definitely. Whether you get or not, how much more you get is a different matter. But I am talking from expectation angle. You're supposed to get more because you have put in more effort, you have taken more risk. Similarly, a project, if it is more riskier, it should generate more return. Let's say the source for you, the loan you have taken from a bank, but you're investing in 3 projects. Let's talk about a real estate company. They have a project in Mumbai, and they have a project in Delhi, and they have a project in, let's say, a small city like Surat or something. Now, depending on the location, depending on the physical whatever amenities involved and your experience, you may consider the project in Surat is more riskier because we are entering that city for the first time. We don't know the local suppliers over there. We are not sure much about the demography, the people's experience, or people's behavior, people's preferences, what kind of houses, apartments they like there, what kind of paint should be used, what kind of cement materials, so many things, and what is the structure of the building, what should be the amenities there. You have, let's say, limited experience there. You have taken more risk. You have taken more risk means, as compared to others, you expect higher return. So RADR means the required rate of return. What is required rate of return? To compute NPV, we need a cost of capital, discounting rate, minimum required rate, the required rate of return. The required rate of return will be combination of two things. One is risk-free rate, and then plus risk premium. Risk premium means the return expected for the risk undertaken. I have taken so much of risk, so I need to have extra return. And how to measure those things in detail in examination, question will tell you. They will use the word risk index, coefficient of variation. They will give you idea. When we do the problem, you'll also get an idea. But conceptually understand. What is the concept point of view? Along with the risk-free rate, we have to expect the extra return that is for undertaking risk. That I may be same company, my source of capital may be same, but my expectation in different projects is different because each project will have different risk characteristics. And while solving the problem, you get a better idea. Don't worry. That is RADR, risk adjusted discounting rate. Higher the risk, higher will be the expected rate. And what happens mathematically? When the required rate of return increases, when I take more risk, the required rate of return increase. The discounting rate will be higher. Now, when discounting rate will be higher, what do you think will happen to NPV? Mathematical relationship. I hope you know. When the discounting rate increase, the present value will decrease. inverse relationship. So in that process, NPV may become negative. If it happens, you reject the project. But even after the risk premium, even after increasing the discounting rate, NPV reduces, but still if it is positive, that means even after considering the risk, even after increasing the required rate of return, NPV is positive, it's worth it. Our method is still NPV only. In this chapter, we don't go anything beyond NPV. We will be looking for NPV, but we adjust for risk, uncertainties and fluctuations. So even after doing increase in the rate, if NPV is still positive, we say project is worth taking. It is recommended to invest in the project. So this is how the risk is considered in RADR, risk adjusted discounting rate method. Next we have certainty equivalent, CE, certainty equivalent approach. What is the certainty equivalent approach? When you estimate the future cash flows, there will be a lot of uncertainties, fluctuations. You don't know if economy is good, cash flow will be high. If BJP wins, cash flow will be high. Or for some people, BJP wins, cash flow will be less. Political factors, social factors, demography. What do we do? Let us forget about the uncertainty factor. Let's consider only what is guaranteed cash flow. Let's consider only what is certain cash flow. Sir, how do we do that? I will give an example. After you have written exam, if somebody asks you what happened in the exam, how was your exam? How will you reply? CA students' reply will be different. CA students' reply and a doctor's reply after performing operation will be same only. That both of them will be, CA student and the doctor after performing operation. Both will tell, we have tried our level best, rest is in God's hands. So I'm not talking about the CA students. I'm talking about the normal exams. Let's say 5th standard, 10th standard, normal class exams. How normally people will react? How much marks do you think you get? If somebody asks you, you tell, I will get 60 or I'll get 65. After that, in one or two questions, I have doubt. I don't know how much I'll get. But up to 60, I'm confident. You'll always do like that, right? Even after doing CA, you'll be like, I know I'll get 50,000 per month salary. 60,000, I'm sure. After that, I don't know. In anything, you'll always have some level of guaranteed expectation. Nobody guaranteed, but you have some expectations. That much I'll get for sure. Projects also will be like that. Even if you think about a restaurant, if everything is good, no corona happens, then we'll get so much of cash flow. But even worst to worst case, this much at least we'll get. This many customer at least will get. And in certain projects like real estate projects, I told you, you might have a contract. See, for example, there's a company called as TVS Sri Chakra, who supplies the tires to my automobile companies. So you will have a contract with them. By looking into the contract, you can tell this much minimum sales will happen, this much minimum cash flow will happen. If demand is good in the economy, if more number of people are buying, then we can have a better sales. But that is uncertain, but minimum I'm sure of it. That's what is called as certainty equivalent approach. We take only certain cash flows. We take certain cash flows. And how do you calculate certain cash flows? Whatever the expected cash flows, multiplied by CE factor, certain equivalent factor. CE factor, C heading only is there, certainty equivalent factor. Many times it can also come from people's experience. Like you say, you are estimating from this project 1 lakh, 80% I'm confident, 20% I don't know. Okay, take only 80%. That 80% 0.8 will be is called as certainty equivalent factor. So 0.8 means if I estimate 1 rupee, 0.8, I am certain, I am sure, I am guaranteed. In the examination, you don't have to worry about C factor, how to calculate, it will be given in the problem. Practically, we follow some statistical models and we do regression model and we'll try to arrive at that number. Examination, you don't worry. They will give you the certainty equivalent factor. And then what do? You calculate NPV. Certain cash flow, you know. And remember, the discounting rate should be risk-free rate here. Discounting rate should be here risk-free rate. Why? Because cash flow, we are taking a certain cash flow, not taking any risk. So discounting rate also no risk, matching, right? So cash flow is certain, discounting rate is risk-free rate. We compute NPV. If NPV is positive, we accept the project. This is called as certainty equivalent approach. Then we have sensitivity analysis. Sensitivity analysis. Sensitivity, responsiveness, reaction level. Please repeat the C formula again. I have written certain cash flow is calculated by the expected cash flow multiplied by C factor. When you multiply C factor with the expected cash flow, you get the certain cash flow. Hope it is fine. Next, sensitivity analysis. Sensitivity means change. You see, when somebody tells you, how do you react? Again, for example purpose only, I'll tell you. If your mobile is falling, how do you react? If mobile is falling down, you'll be like, oh, my heart is falling. You react like that mobile. Such an important, sensitive part of your body, I think. Mobile. It has become integral part of body. I think sooner or later, it will be like you will be able to affix to your body. Just like we have 5 senses, I think mobile also will become one more sense. Maybe nonsense. Anyway, I'm also dependent on mobile. So I can't argue much. Okay, fine. If your friend is falling, you'll be like, entertainment. No, you call everybody, you see your friend is falling. Our sensitivity is different. Our responsiveness is different. See, when you are in school, when you're in high school, again, I'm talking about normal people. If some teacher scolds you, or if somebody will speak to you with a higher tone, you will be start crying, or why are you scolding me? But in CA students, CA class, or in articleship office, you people are not at all worried. If somebody is scolding, okay, you scold. How much ever you want, you scold. You satisfied now? Okay, then you speak to me. What is your problem? We don't react. Now because our sensitivity level is at a different level. Similarly, in projects also, in case of business projects, certain variable change, your NPV will change. You're estimating, oh, next year, my sales units will be 1 lakh per annum. Let's say I'm a chemical manufacturing company, or let's say a pharmaceutical company. I'm expecting only, let's say, 1 lakh units to be sold. I manufacture Dolo tablets. You must have seen some latest memes and all is coming, right? We are eating the Dolo tablet like a chewing gum by Rajnika. I'm a tablet manufacturing company. I'm expecting, let's say, 1 lakh units to be sold every month. But now suddenly, this third wave is coming, the demand is increasing. I'm not worried then. After few months, let's say the corona third wave settled down. Not much demand for the tablets that you are going to produce. You purchased machinery, you appointed so many people, you hired medical representatives, you gave discounts to doctor to push your tablets, you invested all your money. Now the corona wave is coming down. What will happen to the investment you made? Now you start worrying. Oh, units I cannot sell. Investment is already made. I may not be able to achieve my sales. So if sales reduces beyond my expectation or below my expectation, what will happen to my NPV? It will reduce. How much it reduce? Will NPV become negative? If it happens, I may have to stop, close my business, or I may have to do some alternative strategies. So sales units or government in the budget or in GST council increase the GST input rate, and you cannot take input rate. So your variable cost, input cost will increase. Then also your profitability comes down. So sales units, variable cost, fixed cost, advertisement cost, discounting rate, investment, whatever may be. When a variable change, your NPV will change. By how much? What is the impact? Which factor has the highest impact? So that as a project manager, that factor like sales, price, I can protect somehow. So sensitive analysis means computing the impact of change. Impact of change. Of course, you're worried about adverse effect, not good effect. But anyway, impact of change in variables. Impact of change in variables. What variables? Like sales, variable cost, fixed cost, etc. These are the variables. When they change, what impact? Impact on what? Impact on NPV of the project. NPV of the project. And how do you compute those analyses? When we come to the problem, we'll understand. But get the concept clear. I'm trying to give you the overall concept. Formulas, we'll look at it later. So sensitivity analysis means responsiveness. When a variable changes, how NPV will change. How much will change? For example, if sales change by 10%, NPV fall by 20%, double impact. I'm sorry, if sales down by 10%, NPV down by 20%, double impact. Sales increase is not a point of concern. It's good for business. We are worried about what is bad for business. We should be careful there. So among the various factors where NPV is most sensitive, that can be given extra importance. Okay. Or maybe, so variable cost is a problem, let's say. Maybe we can have a talk with our supplier. We can offer him, we'll purchase more from you. You please have a discount, bulk discount, you give it to me. Some negotiation like this you can do. If wages is a point of concern, you can have a negotiation with the employees, telling that you try to work little less so that our wages cost also will be reduced. Otherwise, we have to remove certain people to reduce the cost. We can have a discussion like that. Anyway, so certainty equivalent approach, sensitivity analysis is about that. Then we have scenario analysis. Okay, scenario analysis. As the name suggests, scenario. Now, like this also will happen in CA exam. Especially in CA exam only, they will give answer like this. What answer? How much marks do you think you will get this in exam? First of all, we'll tell I don't know. But if somebody tells, how much marks do you think you'll get in CA exam? You'll be like, if the evaluator is in good mood, I will get 80 marks. If the evaluator is in okay mood, I will get 70 marks. If the evaluator is in very bad mode, if the evaluator had a fight with his wife and or something, if the evaluator is having a very bad time, I will get around 50 marks. You understand? That was scenario analysis. In different situations, if economy is growing well, political stability is there, India is growing, GDP is growing, everybody is buying, there is economy, business economics you would have learned, it's always a cycle, right? In general also you know. If not, you should know. If you don't know, learn it. The business or economy does not go in a straight line. We have business cycles, economic cycles. In certain period the economy will be down. If economy is down, only your business cannot flourish, right? Every see understand, more and more the life is becoming interconnected. Earlier only your society has to be very important, or your family, your society, your district. Now if something happens in US, you are severely affected. 2 days, I think yesterday, there was an increase in treasury bond yield. You will not understand what is it now. Just try to get the feel of it. Something happened in US, or US, Trump wins, Joe Biden wins, or some US president makes some announcement, Indian stock market falls. It is logical. Or if US president tells, we don't allow Indians to be given visas, some announcement might come. In fact, there was some discussion like that. We want to stop outsourcing to Indian, because a lot of job opportunities are not even given to the US people. Everything is coming to India, especially Bangalore, Hyderabad. There is one popular statement there. Somebody told me that the US company was telling its US employees, not Indian employees, US employees, you better listen to me. If you don't listen, your job will be Bangalore. There's one new term, Bangalore. Means what? If you don't listen, I will fire you and your job will be given to Bangalore, will be outsourced to India. Anyway, so if there is a news that okay, a US president is in favor of not giving visa to much of Indian employees, if the news comes like, what will happen to Indian software company? They will have to suffer, right? So lot of factors in these days are universal, macroeconomic. If RBI reduces interest rates, just imagine RBI, RBI reduce interest rates, there is a very good demand for cement companies. Sir, what you are telling? Yes. If RBI reduces interest rates, cement companies will get a good demand. Any idea how is it even possible? How it is connected? Where is RBI? Well, if RBI reduces interest rate, why cement companies? Yes. If RBI reduces interest rate, housing loan also will be reduced. If housing loan reduce, more people come and buy houses. There's a demand for construction, and construction means cements, paints, real estate companies, tiles. Those stocks will increase. Reverse also true. If RBI increase interest rates, all those industry might have a negative impact. So, in different situations, if this happens, if this happens, if this happens, what will happen to our NPV? We can also apply to an extent probability here. There is 30% chance it will be optimistic, 50% chance it will be average, 20% chance pessimistic approach. So, computing NPV under different economic scenarios, under economic scenarios, computing NPV under different economic scenarios, like economy is in development, or in a depression, or economy is average, or inflation stage, all those things. In different economic in scenarios like optimistic, pessimistic, most likely, etc. Most likely, etc. And here we will have probability. So how do we calculate the probability? We calculate like this. Expected NPV is calculated by the value of x multiplied by p. What is this x and p? Summation x and p. If you know a little bit of statistics, you might have seen expected value, mathematical value of expectation, x into p. How is that? Now, I'll give an example. Okay, scenario. If it is pessimistic, your NPV will be high, right? You will have a high NPV. Some number will be there. Some higher number will be there. If scenario is most likely, it is moderate. Your cash flow will be moderate, medium. If pessimistic, if this is high, will be optimistic. When things are good, your cash flow will be high, optimistic. When scenario is pessimistic, your NPV will be low or even negative also sometimes. According to different scenario, our NPV will be changing. Now, we will have a probability. Like there is a 30% probability regarding optimistic approach, 50% moderate, and the 20% low. Total should be 100% always. So we have different NPV under different scenarios. I need one number. I need average. How do I calculate? Multiply. This NPV is like a X column. Probability is a P column. You multiply X into P. Then you get total amount. That is what is expected NPV. Nothing but average. It's called expected value or it is called as expected NPV. This column total. And when the expected NPV is positive, we say that the project should be accepted. Average basis basically. So scenario analysis, what will happen? Under different scenario, we calculate NPV, we multiply it by probability, we get the expected NPV. Or in some problem, cash flow might happen. We have different scenario, cash flows, and you multiply by probability, do the total, same format. This total, what do you get? Their expected cash flow. And based on expected cash flow, you can calculate expected NPV. If NPV is more than 0, project is accepted. So this is how we bring in probability into scenario analysis to get the expected NPV. We also have a standard deviation because when we have average, we have deviation, a standard deviation. I'll give you the format. You may not be able to understand everything clearly now, but I'll give a tabular format. And when we do the problem, you understand how do you calculate the standard deviation very clearly. I hope you have taken down till here. Okay, fine. Okay, standard deviation. I'll give the format. I'll not explain the concept. I mean, I'll not explain detail much. Example I'll not give. When we do the problem, you understand. So how do we have standard deviation? In general, a standard deviation measures risk, right? In say, how do you measure risk? We say standard deviation is a measure of risk. So risk is measured through standard deviation. Okay, I'll just take X as an example now. X may be cash flow, X may be NPV, depending on what is in the problem. But I'll just say X, numerical. It's a random variable. Just say X is a random variable. Random variable like cash flow, NPV, like that. Random variable. P stands for, probability. Okay, regular formula, standard deviation. This symbol is also there. This symbol stands for standard deviation. Is given by summation x minus x bar the whole square divided by n square root. X means I told you, x bar means average, mean, arithmetic mean. X bar means mean, arithmetic mean. Divided by n. N stands for number of observations, like number of years, number of projects, like that, number of possibilities. But what is most important formula is this. When a probability is given, we will do summation x minus x bar whole square multiplied by p. P stands for probability. Then we take the square root. This formula is even more important when the probability is there. And we follow a tabular approach. If I and standard deviation square is called as variance. That's also you should know it. standard deviation square, or if I don't take square root, standard deviation square is called as variance. Just know the formula. Application will do it later. What are the columns required? One column is x, random variable. One column is p, probability. That they only will give in the problem in the examination. X and p. That they only will give in the examination problem. Okay. Then we need x bar. So for that, what do? I'll multiply x into p. Expected value, that one. This total, summation xp, this is what is x bar. This summation xp, call total. This column will give me x bar. Then I will do x minus x bar. X value is this column. X bar what I calculated now. I'll subtract both. Then I'll square it. X minus x bar whole square. Then I multiplied by p. X minus x bar whole square multiplied by p. This total will give me this one. Summation x minus x bar whole square into p. Basically this column total will give me variance. Then will I take a square root of it like this here formula. I'll get standard deviation. You may not be able to get everything now. That's okay. First you get the format clear. Just write down the table heading. When we do the problem, you'll understand better. Okay. One small concept is there. Then we take a problem. Okay. That is impact of inflation. This is one very important factor, economic factor, I will say. But many people don't consider it. Many people should consider it. Inflation means increase in price. So when the price increases, a company sales will increase. At the same time, your cost also will increase. You have to pay more salary. You have to pay more rent. So when you consider inflation, what will happen to the NPV? So impact of increase in prices. Impact of increase in prices on NPV. That is inflation. And here, formulas are not there, but one important concept is there. I'll discuss it. That is called as nominal cash flow, real cash flow. Let me give the meaning. Nominal cash flow is comprising of two things. One is real cash flow and impact of inflation. That means real cash flow is without inflation, nominal cash flow including inflation. Real cash flow without inflation. Nominal cash flow is with inflation. Basically, before the price is increased, that is real cash flow. Like I estimate after 5 years, my cash flow will be 5 lakh. But actually, after 5 lakh, because of inflation, cash flow will be high. You understand my point? When you don't consider inflation, pure cash flow, that's called as real cash flow. With the impact of inflation, you add inflation, that will give you nominal cash flow. Now, how to consider this real cash flow, nominal cash flow while solving the problem? When we do the problem, you understand. But now, what you should know, real cash flow means without giving any effect to inflation. If I add inflation, I will get nominal cash flow. This much remember, sufficient as of now. Okay, so this is the brief introduction about the chapter. Hope you have taken in all these things. Now we'll go to the problem one by one. Come to this problem. Come to this problem. I don't know the question number. A hospital is considering that problem. Did you get the question? Please confirm. Did you get the question? Did you get the question? Okay. A hospital is considering to purchase diagnostic machine costing 80,000. The projected life of the machine is 8 years and has an expected salvage value of 6,000 at the end of 8 years. The annual operating cost of the machine is 7,500. It is expected to generate revenue of rupees 40,000 per year for 8 years. Presently, the hospital is outsourcing the diagnostic work and earning commission income of 12,000 per annum net of taxes. Whether it would be profitable for the hospital to purchase the machine, give you recommendation under net present value method and profitability tax method. Okay. Now, whenever they ask this NPV method and all, whenever they ask you application problem like this, try to think from three kinds of cash flows I told you, easy to analyze. Initial cash flow, interim cash flow, and terminal cash flow, IIT, easy to remember. The hospital is considering purchasing a machine costing 80,000. The initial cash flow 80,000 outflow, so within brackets. Interim cash flow is interesting one. I want you to participate here. The salvage value will come terminally, that is later. Salvage value will come at the end, that you ignore. That will come later. The annual operating cost is 7,500 and will generate revenue of 40,000. The revenue of 40,000 is income. Cost is 7,500, so I subtract. So 40,000 minus 7,500. That is very, very clear. Can you tell me this commission income of 12,000? Should I do plus 12,000? Should I do minus 12,000? Or should I ignore it? Try to analyze and tell me the commission income to compute annual cash flow. Should I subtract? Should I add? Or should I ignore it? Should I subtract? Should I add? Or should I ignore it? Commission income. Do you think it should be subtracted, it should be added, or it should be ignored? What do you think? What do you think?
Okay, I think this Q&A method is not working out. There's no point in asking me many questions because I'll be keep on waiting only. So let's do one thing. I will not ask many questions going forward. I will answer it. I'll ask myself. I'll answer it. Uh, Only if you have doubt, you ask. Otherwise, you don't have to reply it. Okay, fine. So it happens like this. I will explain this process. Presently, let's say a patient is going to hospital. Correct? Now he says, I want to diagnose, let's say X-ray. What the hospital says, we don't have this facility. Nearby, there is one center, X-ray center. Go there, get the X-ray done and give it to me. We will do the diagnosis. So what he does, he go to that center, the patient gets the X-ray done, gives the report to the doctor. Doctor will diagnose and give medicine. Now, because you are referring, that diagnostic center is getting some sales, revenue, because whenever doctor refers, those people get the revenue. Now, if the hospital purchase the machine themselves, do you think they will refer? Do you think they will refer? Don't answer. Anyway, you don't answer. Do you think they will refer? They don't. They don't uh, refer because they do it themselves. Therefore, the revenue will be earned by the hospital itself. It will not be given to the center. So center will not get any reference. So when they don't get reference, they will not give you the commission income. Now the commission income will stop. So when you do the work yourself, the reference income, referral income will not come, commission income will stop. Now you think, should I add, should I subtract, or should I ignore? The answer is we should subtract. Why? Because my incremental cash flow is what I have to consider. Because even without purchasing this machine, I'm getting that income anyways. If I'm purchasing the machine, my incremental income should be justified. Therefore, from the current level of 12,000 to the new level of the whatever income I get, what is the incremental benefit is what that is required. Therefore, we have to subtract to incremental cash flow. One more way of understanding is opportunity cost. What is opportunity cost? Because you are doing the work by yourself, the opportunity of earning commission income is lost. That no longer will be there. Therefore, you have to subtract the existing income which no longer will be there as the opportunity cost, as the incremental cash flow. This should be subtracted. So cash flow goes like this: initial investment 80,000, every year cash flow 40,000, minus operating cost 7,500, minus 12,000, this commission income, opportunity cost. Because this will no longer be there, that is 20,500. This 20,500 is incremental cash flow. And this comes every year, and discounting rate they have given how much? Discounting rate 10%, and they have given discounting factors also. What you should do? Simply add all the numbers, because every year cash flow is same. Add all the numbers, you get annuity factor. So 20,500 into 5.334, get 109,347. Then last salvage value you get 6,000. So last year discounting factor. Salvage value will not come every year. Salvage value will come only on the last year. So multiplied by discounting factor, you get the present value. Then do the total: 80,000 outflow, 109,347 inflow, 2802 inflow. So total present value of inflows 109 plus 2802 is 1,12,000. Then you do 1,12,149 minus 80,000, get NPV of 32,149. Profitability index, present value inflows divided by investment, 1,12,149 divided by 80,000, 1.40. The NPV is more than 0 and PI is also more than 1. So we suggest that machine should be purchased. The project should be implemented. To take it down, we'll go for the next problem. Okay, I'll move further. Okay, I'm getting one question. Let's see if I can answer. Can we take the commission value at the end of 8 years? Because during the terminal value, part of commission would have received. No, that if you do like that, there will be duplication. Because when I say year 1 to 8, year 1 to 8, 8 times I've considered 12,000. At the end of 8th year also I've considered year 1 to 8 includes 12,000. At the end of 8th year also the 12,000 is considered already. If you consider the terminal value once more, it will be duplication. You should not do like that. The year 1 to 8, you have already included 12,000. Once more, you should not consider. Hope you got the point. Okay. Okay. Let's move further.
From the following, compute NPV based on risk adjusted discounting rate. Annual cash flow 5 lakh, investment 15 lakh, period means term of the project 4 years, risk free rate 10%, minimum required rate of return of the firm is 12%, risk index is 2. Risk index is 2. Okay, first let the get the basics right. Risk free rate means without any risk. Usually treasury bonds, government bonds are considered as risk free rate, return from government bonds. But minimum required return of the firm is 12%. Your firm expects 12%. Why the firm is expecting more? The firm is expecting is more because your firm is more riskier. You can't have a risk-free rate. The business is always risky. So when you invest in a business, you always expect higher return. That is why required rate of return 12%. But risk index is 2.0. What is risk index 2.0 means? Your project, this particular project is double riskier. Risk index 2.0 is like a beta. Beta, what is it? We'll discuss later, but get the meaning right. Risk index is 2. It implies the project is double riskier. Implies, you can write somewhere, the project is double riskier or riskier 2 times than other projects. Is riskier 2 times. Riskier 2 times. Okay, so let's calculate now RADR, risk adjusted discounting rate, is risk free rate plus whatever the excess return, risk premium. Normally this would have been the formula, but here we have risk index also, so multiply by that. Multiplied by risk index. So risk free rate is 10%. Risk premium, how much extra you are requiring? 12 minus 10. Sir, why 12 minus 10? 10% risk free rate. But you expect 12%. How much extra you are expecting? 2%. That extra is risk premium. But this project is double riskier, risk index. So multiplied by 2. So 10 plus, this is 2 into, which is 4. So 10 plus 4, that is 16%. Sorry, 14%. See, from a regular project, you will expect 12% from your business, a regular project. But this project is double riskier. So you want double return. That's why you multiplied by 2. So 4% extra you need. 2% extra not sufficient. 4% extra you need. That's how you got 14%. You also do that where if your parents tell, go and get something this, go and get milk for the house or go and get some vegetables for the house, you what do you tell? Normal days give me 10 rupees, but these days give me 20 rupees. Why? Or 50 rupees. Police will be there, lockdown will be there, corona is there, I am taking more risk, give me more pocket money, I mean more money for getting things to the home, right? So things increase because you are taking more risk premium. Okay, it's not sufficient to compute RADR. We have to calculate NPV. So what is NPV? Tabular approach not required. Informations are straight away given here. Cash flow is straight away available. So directly we can do present value of inflows minus investment. How do you calculate present value of inflows? Cash flow multiplied by annuity factor. Cash flow is 5 lakh multiplied by annuity factor. Annuity factor at the rate of how much? What you calculated now? 14%. What you calculated now? 14% for 4 years minus investment. 15 lakh. So how do you calculate this? 1 by 1.14 equals GT. So 5 lakh multiplied by 1 by 1.14. 3, 4. One, two, three, 4. So 2.9137. Yeah, 2.9137 minus 15 lakh. So present total inflows is 14 lakh 56 850 minus 15 lakh. Oh, NPV, I think you're getting negative 43 150. So when NPV is negative, project should not be accepted. So you see, had you not taken this discounting rate, had you taken 12%, NPV would have been accepted. But now we have increased the rate, and in that process, NPV has fallen, and so much fallen, it has become negative. When NPV is negative, this project is not recommended. So you can say NPV less than 0, so project is rejected. NPV less than 0, so project is rejected. Project is rejected. Okay. Okay, let's go further. Next problem. New project is evaluating the 3 projects P1, P2, P3, P4. Following information is available in respect of these projects. Cost means investment, inflows, cash inflows, year 1, year 2, year 3, year 4. Since cash inflows is directly given, we don't have to worry about depreciation, tax rate and all, we don't have to worry about it. P1, P2, P3. 3 projects are there. Risk index is there. Minimum required rate of return of the firm is 15%. Applicable tax rate is 40%. Risk-free rate is 10%. Find out the risk-adjusted discounting rate for these projects. Which project is best? Which project is best? We do it based on NPV. Find out the risk-adjusted discounting rate. Formula we discussed earlier in the previous problem also. That is risk-free rates. RADR equals risk-free rate plus risk premium multiplied by risk index. Risk index will tell you how much more riskier. Multiplied by risk index. And how do you calculate the risk premium? Whatever the required rate of return, required rates, minimum required rate minus risk-free rate. So please calculate. Very similar to the previous problem. NPV don't calculate. We'll do it together. RADR you calculate for all the 3 projects. You can refer the previous problem for more clarity. Please try for 3 projects. Compute RADR. Okay. Screen is not visible to me. I'm just showing the question. I've not shown the answer. I'm expecting you to give me the numbers. Okay. Now I'm showing the answer. Uh, I hope now it is visible. It is 19%, 15%, 13%. Check it out. If you have got good, if not, you can copy it. Okay, good. No problem. Check your number. If not, you can copy it. Then we'll compute NPV together. Okay. NPV calculation. I will just show you for the first project. Second and third project, you can do it. Okay, fine. Very simple. Year 1, 2, 3, 4. Cash flow they have given 6 lakh, 6 lakh, 6 lakh, 6 lakh. Then discounting factor for the first project, we just calculated 19%. 1 by 1.19. We'll get every year discounting factor multiply. Cash from discounting factor, you get the discounted cash flow present value. And the total will give you present value of inflows. Subtract investment, that is same flat 15 lakh, that will give you NPV. This for project 1. Similarly, you do for project 2 and project 3. For project 2, discounting rate is 15%, different 15%, and for project 3, 13%. Yeah, I forward till one more point. You see, this 1.8 is the highest number, highest risk, therefore 19%, high risk, high return. This is one little bit lesser risk, so less expected return. This is lowest risk, only 0.6, so this is less expected return. So a project carrying higher risk is given higher discounting rate. So the risk is incorporated in the discounting rate, and accordingly NPV is also adjusted. Anyway, so you take down the project 1 and you please try for project 2 and project 3, then we'll compare the answer. Please try for project 2 and project 3. Question, you don't have the material. Okay, this is the question. Okay, so if you have tried for project 2, check it out. It comes to around 1,67,310. If you have done for project 2, please compare the solution for project 2. Okay, so if you have done for project 3, let me put a solution. Project 3, around 2,14,300. Check it out. And whichever is the highest project. So based on NPV, project 3 is recommended. In fact, in the problem, they have not asked NPV only. But when nothing is specified, I told you, you go for NPV method. In fact, you can also do on profitability index also. Since amount of investment is different, even PI you can do, but it's from exam point of view, NPV is sufficient. And as you know, based on PI, based on IRR and all, answer can vary also. Conflict will be there, right? But anyway, from exam point of view, when they have not specified the method, we will go with NPV. NPV is the highest in the third project, so project 3 is recommended. Okay, hope it is done. If you have done, please compare your solution. You can take a screenshot and copy it down later in case you are not able to write down. Right. Next. Okay. Next problem. The company selects risk adjusted discounting rate of discount on the basis of coefficient of variation, risk adjusted discounting rate, and PV factor from 1 to 5 years. Determine the risk adjusted net present value. Okay, here in this question it is very straightforward. We have to calculate the NPV, risk adjusted net present value, net cash outlay, project life, annual cash flow, coefficient of variation. Okay, in this problem also logic is same, means higher the risk, higher the discounting rate. We have to take the risk adjusted discounting rate to reflect the risk, but they have not given risk index, they have given coefficient of variation. What is coefficient of variation? You don't worry, coefficient of variation reflect risk, and beautifully they have given one table. What table? For a given coefficient of variation, risk adjusted discounting rate should be so much, which means for project X, coefficient of variation is 1.2. Now, look at coefficient of variation, which is 1.2, and see what is the corresponding rate of return. How much it is? For 1.2 here, the corresponding rate of return is 16%. So, a project X will have a discounting rate of 16%, will have a required rate of 16%, will have a RADR of 16% for project X based on coefficient of variation. In fact, coefficient of variation is a standard deviation by mean return rate. Anyway, Y. For Y, it is 0.8 coefficient of variation. So for 0.8, how much is corresponding discounting rate? It is 14%. So while calculating NPV of project Y, we will use discounting rate 14%. Then similarly for project Z, the coefficient of variation is 0.4, looks the less risky among the three projects. Coefficient of variation 0.4, and for 0.4 corresponding number we have 12%. So for project X, discounting rate 16%. For project Y, discounting rate 14%. For project Z, discounting rate 12%. Using this discounting rate, we'll calculate NPV. What's the formula for NPV? Present value of inflow minus investment. Cash outlay means investment. Annual cash flow they have given. We multiplied by annuity factor. And annuity factor I don't have to calculate. For 12%, the annuity factor is given. For 14%, annuity factor is given. For 16%, annuity factor is given. Use those things. Multiplied by annual cash flow. You get present value of inflows. Subtract investment. You get NPV. I'll do for project X. Applicable discounting rate 16%. So annual cash flow into annuity factor. 7 lakh is the cash flow for project X. And at 16%, the table only given, right? At 16%, the annuity factor is, see, 3.274. They only have given 3.274. Multiply annual cash flow. Subtract investment. You get NPV. I've done for project X. You try for project Y and project Z. Okay. If you have done for project Y, let's see if you have done it. Applicable discounting at 14% and annuity factor 3.433. They give you the problem itself. You get 24,186. Similarly for project Z, I think NPV comes to 8150, and they've not asked for decision, but we'll recommend highest NPV is project X. So if you have to choose one, project X is recommended. Sorry, not project X, project Y, right? 24,186, not project X, sorry. Project Y is recommended. Okay, hope it is done. Okay, fine, very good. Next problem. Investment proposal 45 lakh, expected cash flow, certainty equivalent coefficient, assuming interest free rate means risk free rate actually. Interest free rate means, yeah, I mean, it's not proper English, but anyway, risk free rate is 5%. Calculate NPV. So this problem is based on certainty equivalent approach. Certainty equivalent. Example, in this case, 0.9. What do you mean by that? In the first year, I am expecting my cash flow to be 10 lakhs. But out of 10 lakh, 0.9, I am certain, I am confident, I am sure. Balance, I'm not confident. Zero point 0.9 is not probability. Huh? Please don't confuse for that. It's not probability. So out of 10 lakh, 0.9, 90%, I'm certain, I'm sure, I'm confident. Balance, I'm not sure, I will not take it. Sir, how do you get this zero point 0.9? Maybe from experience, or maybe you have certain contract with some people, you have signed a contract, so they are legally valid, so you're confident. Or you have done some regression analysis, you have ascertained those numbers. That you don't worry. What we require is the cash flows multiplied by certainty equivalent. We get certain cash flow. Let's write it one by one. So here the certain cash flow. How do you get the certain cash flow? The expected cash flow multiplied by CE factor, certainty equivalent factor. Both are given. We just have to multiply. Then I multiplied by the discounting factor, our regular process. I will get the discounted cash flow. I add all. I get present value of inflows. I subtract investment. I get NPV. Okay. So here 1, 2, 3, 4. Hope you're writing along with me. Certain cash flow they have given multiplied by the certainty equivalent factor. So certain cash flow is 10 lakh, out of which I am confident only 0.9. Take only that much. So 10 lakh is the expected cash flow multiplied by the certainty equivalent of 0.9. So 9 lakh, that is your certain cash flow. 15 lakh into 0.85. 15 lakh into 0.85. Only that much confident? Yes, take only that much. 15 lakh into 0.85. 12 lakh 75,000. 20 lakh into 0.82. 16 lakh 40,000. 25 lakh into 0.78. 19 lakh 50,000. Discounting factor at the rate of 5%, risk free rate. They only have given risk free rate only. Discounting factor at 5%. So 1 by 1.05, 0.9524. Round off very clearly. I'm taking 4 decimals. 0.9524, 0.9070, 0.8638, 0.8227. Let's multiply 9 lakh into 0.9524, 8 lakh 57 160, 12 lakh 75,000 into 0.9070, 11 lakh 56 425, 16 lakh 40 to 0.8638, 14 lakh 16 632, 16 lakh 4,000 265. Okay, total. This is what is present value of inflows. Fifty lakh 34 482. 50 lakh 34 482. Subtract investment minus investment. Outlay initial investment 45 lakh. So 5 lakh 34 482. And NPV is positive, and therefore project is accepted. Even after taking only certain cash flow, still NPV is positive. Must be a good project. NPV is greater than 0. Means what? From this project, I'm expecting 5% risk-free cash flow. Am I getting 5%? Yes. More than that also I'm getting. How much more? 5 lakh 34 482. That's what NPV positive 0 means. NPV more than 0 means my expectation is exceeded. NPV positive project is accepted. Project is accepted. Okay, hope it is straightforward, very simple calculation. Let's go further. Next problem. Hope you got it. Okay. The Textile Manufacturing Company Limited is considering one of two mutually exclusive proposals, Projects M and N, which require cash outlay of 8,50,000 and 8,25,000 respectively. Two projects are given, and how much outlay means initial investment they have given. The certainty equivalent approach, CE approach, is used. They're only telling you don't have a choice. CE approach is used in incorporating risk in capital budgeting decisions. The current yield on government bond is 6%. Means risk-free rate, required rate of return, risk-free rate. Government bonds is taken as risk-free rate. And this is used as risk-free rate. Very good. They are telling you that also. Very nice people. Huh? The expected net cash flows and their certainty equivalents are as follows. Project M, Project N. Year end 1, 2, 3. Cash flow only directly given. To compute NPV, we require cash flow. Cash flow is given. No need to do any profit after tax, depreciation, adjustment, nothing of that sort required. Cash flow directly available. Certainty equivalent. Cash flows required. Which project should be accepted? If risk adjusted discounting rate method is used, which project would be appraised with a higher rate and why? Okay, let's do it together. Let's first do project M. They have given cash flow. They have given certainty equivalent factor. Very good. We multiply 4,50,000 multiplied by zero point 0.8. We get a certain cash flow. Sir, what is the logic? I've explained. I'll repeat once more. zero point 0.8 means if I expect 1 rupee cash flow, I am confident, I am sure, I am certain zero point 0.8 of it means 80% of my cash flow. I'm very, very confident. I am certain. 4,50,000 into zero point 0.8, how much ever that number comes to, that much money I'm sure. I have experience, I have contract, I have calculated, this is my past experience, whatever it may be. This is not probability. So that much amount, yes, we can calculate only that cash flow. We will use only certain cash flow. If something is uncertain, don't take it. Something is not sure, don't take it. Only to what extent you're confident, you're very clear, only that much amount is considered. Right? So, initial cash flow, and 4,50,000, you can add anywhere. Year 1, 2, 3, cash flow, 4 lakh 50, 5 lakh and 5 lakh. Please write down along with me. Column, you are very clear. Cash flow into certainty equivalents. That will give me certain cash flow. That I multiplied by discounting factor will give me discount cash flow, nothing but present value. When I add all of them, I get present value of inflows. Anyway, have all these columns and a year and cash flow and certainty equivalent. So all the three columns given in the problem itself. Please write down till there. Okay, so let's multiply 4,50,000 into 0.8. We get 3,60,000. 5 lakh into zero point 0.7. We get 3,50,000. 5 lakh into zero point 0.5. We get 2,50,000. Discounting factor 6%. So 1 by 1.06 equals. We get every year. Write down till there. Okay, fine. Next, present value 3,60,000 into 0.9434. 3,50,000 into 0.8900. 2,50,000 into 0.8396. This will give me the present value. There is no terminal cash flow as such, no scrap value and all given. I'm writing, even if you don't write, it's fine. Subtract investment 8,50,000, you get NPV. Please write down. Let me know if you have any doubts. Similarly, we should do for the next project, project N also we should do it. Okay, next project, project N. Same format, year cash flow they have given, multiplied by certainty equivalent, 0.9, 0.8, 0.7, 4 lakh 15 to 0.9, 4 lakh 5,000, 4 lakh 15 to 0.8, 3 lakh 60,000, 5 lakh into 0.7, 3 lakh 50,000. Multiplied by discounting factor, same discounting factor, is period is same, you get present value. In fact, you can prepare in the columnar format also. The year column and discounting factor column can be saved. But anyway, this looks more clear. To save time, you can write in the same table as well. subtract investment, which is 8,25,000, you get NPV of 1,71,337. So wherever NPV is higher, NPV is higher in second project, so project N is recommended. Project N is recommended. One more theory question is there. I will discuss. You write down till here. You write down till here. Please solve and do it. Let me know if you have any doubt. Very simple problems. So I'm not explaining much. Hope you're able to follow. Let me know once it is done. Done. Okay. There's one theory question. So let us read that. If risk adjusted discounting rate method is used, which project would be appraised with a higher rate and why? Listen to me. Here they are not asking as to compute risk adjusted discounting rate. They are not asking us to compute. They are asking us to comment. What comment? Very simple. If you use risk adjusted discounting rate, which one would be appraised with a higher rate? Which one will you appraise with a higher rate? Whichever is high risky, right? When the project is high risk, discounting rate also will be high. Risk premium will be there. Higher the risk premium, higher will be the discounting rate. So we have to identify among the two projects, M and N, which is more risky. Sir, how do we know which is more risky? You can identify. How? By looking at the certainty equivalents. Don't compute, just observe. Which one do you think is more riskier? Wherever certainty equivalent is more, you see project in 0.9 more than 0.8, 0.8 more than 0.7, 0.7 more than 0.5. So in all the 3 years, project N has got higher certainty equivalent. And higher certainty means what? Higher confidence. Higher confidence means less risk. And less risk means lesser discounting rate and less premium. Other way around. Project M, first year also CA factor is less. Second year also CA factor is less as compared to when? On a comparison basis. How much high low I don't know. On a comparison basis. 0.8 less than 0.9, 0.7 less than 0.8, 0.5 less than 0.7. Right? So in all the 3 years, project M has got less certainty equivalent, less certainty, less confidence, less guarantee, lesser surety, high risk. And higher risk means discounting rate also will be high. That's what they're asking us to comment. If you use RADR method, project M would have been used. Why? Because it is more riskier. Let's write that in sentences. Write down. Write down. Among the 3 years, among the 3 years, among the 3 years, among the 3 years, project M, project M has got, project M has got less certainty equivalent. Project M has got less certainty equivalent. Less certainty equivalent. Less certainty equivalent as compared, as compared to project N, as compared to project N, as compared to project N, as compared to project N. Hence, lower the CE, hence lower the CE, lower the CE means higher risk. Lower the CE means higher risk, higher risk. Lower the CE means higher risk. Lower the CE means higher risk. Full stop. Full stop. If RADR method is used, 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 then project M, M for Mumbai, project M, project M, project M would be appraised. Project M would be appraised with a higher rate. Project M would be appraised with a higher rate. Project M would be appraised with a higher rate. Project M would be appraised with a higher rate. With a higher rate. Okay, so I hope you are clear on this point. Let's go further. Did you get this question? Globe Manufacturing Company Limited, that problem. Globe Manufacturing Company. You got the question? Okay, I hope you got it. I think question number 6. Let's read. Globe Manufacturing Company Limited is considering an investment in one of the two mutually exclusive proposals. Mutually exclusive means either this project or this project. Project X and Y require cash outlay of 3,40,000 and 3,30,000 respectively. Very close, 3,40,000, 3,30,000, not difference, very close. Certainty equivalent approach is used in incorporating risk in capital budgeting decision. Which approach? Not RADR approach, not risk adjusted discounting rate approach. It is certainty equivalent approach. Certainty equivalent. I'll explain that, don't worry. So this is the method, certainty equivalent. The current yield on government bond is 8%. This you can take it as risk-free rate, because government bonds are considered as the best ones in terms of risk. So no risk, risk-free, and is used as risk-free rate. Oh, they only have given used as risk-free rate. Expected net cash flow and their certainty equivalent are as follows. Let's focus on project X. First year, second year, third year, they have given cash flow. And CE stands for certainty equivalent. 0.8, 0.7, 0.5. Okay, now let me tell you the interpretation of this. There is one common example I would have given. I'll tell you once more. After writing the CA examination, and after doctor doing operation theater, no, surgeon, heart operation like that, some critical injury operation, both are same. How both are same? Once a CA students come out of the exam hall, once the doctor come out of the operation theater, people ask, how was it? The answer is same. Doctor also tell the same thing. CA student also tell the same thing. What is that? I have tried my level best. Rest up to the God. Anyway, so let me take out the CA for the time being. Go back to your childhood days, little bit earlier, maybe 9th standard, 8th standard, 10th standard. Once you come out of the exam hall, friends will ask, or parents will ask, how much you get? What do you tell? I'm sure I'll get 80 plus. 80, I'm sure, guarantee. Beyond 80, I don't know how much I get. I'm little bit uncertain. I'm doubtful. But 80 marks I've written perfectly. I'm very confident. You understand the position, right? Some portion of some people say 60 plus I'm sure. After that, I don't know. It is subject to evaluators thing. But 60 I'm confident. Hope you're able to get the feeling. Whenever something is asked, you tell, oh, this much I'm confident, this I'm not. Here, that is called as certainty equivalent. It comes mostly by experience and expertise. Now you see 0.8, which means if I estimate 1 rupee as my cash flow, everything is about expectations, mind it. These are all predictions. These are all expectations based on which we are taking a decision today. That's the fundamental essence of financial management. Okay, so if I expect 1 rupee, out of 1 rupee, 0.8, I'm very confident. Balance, I'm not so confident. It may come, may not come, but out of 1 rupee, 0.8, I'm very, very confident. It's almost certain. Look at the name, certainty equivalent. If I expect 1 rupee cash flow, 0.8 is certain. How can you tell it is going to be certain? Maybe you have signed contract with customers. You have got a project. You have signed contracts. See, contract means the prices are fixed, right? You know, you're guaranteed. It's not like that, like not a hotel. You may sell, people may come, may not come. It's uncertain. You have signed a contract, big corporates. You got a government contract. So government contract means, income will come. Sign contracts, risk free. Are you able to get the point? 1 rupee if I expect, zero point 0.8 is guarantee. 0.8 is not a probability. Probability will take it later. 0.8 represent surety, guarantee, certainty. Balance 0.2 may come, may not come, uncertain. Now, can you tell me, if I am expecting 1,80,000 as my cash flow, how much is certain out of that? Can you tell me? Out of 1,80,000, based on this calculation, how much is certain now? Simple calculation. 1,44,000. Absolutely right. How did you calculate? 1,80,000 into 0.8. So 1,44,000 is certain and sure I will get. No doubt, no risk, no uncertainty. Balance 36,000, I may get, I may not get. Okay. This approach is very simple. What you should do? You have a cash flow. Take out all uncertainty element. Take only certain element. So 1,80,000 we just discussed. 0.8 is certain. Take only that cash flow. Uncertain, don't take it. Risk you eliminate. If you take out the risk element, how much cash flow remains? That is certain cash flow. Now tell me, when the cash flow is certain, discounting rate should be what? It should be risk-free rate. See, both should be matching. You understand the concept? If cash flow is risk-free, discounting rate also should be risk-free. If cash flow includes risk, discounting rate should also include risk. That's what we did in RADR. Risk adjusted discounting rate. In cash flow, we included risky cash flow. All cash flows we took it. Includes risky cash flow. So discounting rate, also we included risk. We have added risk index. So both elements included risk. We took a decision based on that. Here we are taking a different approach. Nothing right, nothing wrong. Depending on the context people use in practical life. In the exam they will tell you. So what approach is this? In the cash flow, don't take risk. Take only certain cash flow. Since cash flow is certain, discounting rate should not include any risk. So discount rate should be risk-free rate, and that's why they have given risk-free rate. Okay. Having said all these things, which product should be accepted? We'll compute NPV. How to calculate NPV? Every year cash flow is different, so I cannot use annuity factor. I'll use discounting factor. What discounting factor? Cash flow into discounting factor gives me discounted cash flow, gives me present value. Which cash flow? Not full cash flow. I will take certain cash flow. How do you get certain cash flow? Cash flow multiplied by certainty equivalent. So let me show you the calculation. Then you please take it down. Give me 2 minutes. I'll show you the complete solution. Project X. Initial cash flow 3,40,000 investment outflow. Year 1, year 2, year 3. Cash flow they have given 1,80,000, 2 lakh they have given. Certainty equivalent 0.8, 0.7, 0.5. So we convert cash flow into certain cash flow, CCF, certain cash flow. How? 1,80,000 into 0.8. You get 1,44,000. You only told me this number. Similarly, 2 lakh into 0.7, 2 lakh into 0.5. These are all certain cash flow, guaranteed cash flows, not probable cash flows. And then you take discounting factor at risk-free rates, so that present value can be obtained. So 1 by 1.08, you know how to calculate, or they have given the problem actually. Discounting rates are given. Yeah, year 1, year 2, year 3 are 0.826, 0.857, 0.794. They are given. So use that number. So what are cash flow we got? Multiplied by discounting factor, you get the discount cash flow, present value. So that is present value of inflows. This is present value of inflows. This is initial inflow, investment, terminal cash flow, nothing is there, 0. You can ignore it also. And NPV, you get negative numbers. Anyway, so look at these calculations. Please take it down. If you have any doubts, please ask. Then you try for project Y. One more project is there, right? Same table, headings are all same, numbers are different. You try. During that process, any doubts, please get it clarified. Once you try, once you do, you please do for next project. Project Y also you try it. Okay. I'll show you project Y. If you have done, please check it out. You can take a screenshot quickly if you want. I think NPV is positive here. Take a quick screenshot of this. I hope you are able to understand the process. Very simple. It's ultimately you calculate NPV only. So which project is accepted? Project Y. NPV positive, NPV higher. So project Y is accepted. So take a screenshot of this. I hope it's simple, straightforward to understand. NPV ultimately, only step is you should convert the cash flow into certain cash flow. How do you convert? You multiply it by certainty equivalent factor, CE factor. One more small question is there. Please let me know once you have taken the screenshot and copy it down later. Okay, hope you have taken it down. One more theory question is there, small question. Let me complete that. If risk adjusted discounting rate is used, which project would be analyzed with the higher rate? It's not a numerical question, it's a theory question. Now, please tell me. I think you'll be able to tell. Look at this certainty equivalent factor 0.8, 0.7, 0.5. and here certainty equivalent factor 0.9, 0.8, 0.7. You tell me where risk is more. In project X, risk is more, or in project Y, risk is more, or let's say confidence. Where confidence is more? Who has more confidence? Project X or project Y? Project X is having more confidence, right? Why? Because you see 0.9, 0.8, 0.7. Higher certainty equivalent means higher confidence, higher certainty, higher confidence. But project X having comparatively lower confidence. Lower confidence means what? Lower certainty means what? Higher risk. Correct? Higher risk means what should be discounted rate. Remember RADR. If you have higher risk, then it means it is having higher RADR. If you use RADR method, a project which has higher risk will be having higher RADR. How much we don't know. Risk index is not given. It's a theory question. We'll answer it. You write it down, I'll dictate. You write down, I'll dictate. If RADR method is used, hope you know the full form. Risk adjusted discounting rate. Okay, write down. If RADR method is used, if RADR method is used, then project X will have higher RADR. Project X will have higher RADR. Project X will have higher RADR because of higher risk. Because of higher risk reflected in lower certainty equivalents. Higher risk reflected in lower certainty equivalents. Lower certainty equivalents means higher risk. Reflected in lower certainty equivalents. Reflected in lower certainty equivalents. Okay, so I hope you are able to understand this. Okay. Take a screenshot in case you have not taken. I'll just show you once more. Following details relative to a project: initial project cost, annual cash inflow, project life, cost of capital. Find NPV. If the project cost is increased by 10%, how much NPV will change? They have talked about cost of capital, project cost. I'll also talk about one more aspect. But before that, let me first calculate NPV. So basic formula of NPV, you know. Let's do, write it down. NPV is, of course, you know, full form. Net present value. This is present value of inflows minus investment. Present value of inflows minus investment. How do you calculate present value of inflows? Either we should use discounting factor or we should use annuity factor. We don't have to use a discounting factor here because every year cash flow is same, 50,000, same cash flow. So we can use annuity factor. So 50,000 is the annual cash flow multiplied by annuity factor at what rate? 10%. For how many number of years? 4 years. minus investment is initial project cost, that is 1,30,000. So 50,000 multiplied by, can you please calculate for me what is annuity factor at 10% for 4 years? How do you calculate? 1 by 1.1, press equal to 4 times and then press G. 3.1699, right? In round of 3.1699. We can take 3.17 also. No problem. Let's take 3.1699 minus 1,30,000. So what is that NPV we get? 50,000 into 3.1699, 1,58,495 minus 1,30,000, 28,495. This is present NPV. Got it? Basic one. Now, what is the requirement they said in the problem? If project cost is increased by 10%, back to basics. What is the purpose we are trying to do? Sensitivity analysis. If one variable changes, one of the variable is the cost of investment. These are all estimations, you know. If it changes, we estimate it to be 1,30,000, but in reality, if it is more than 10% increase, what will happen to NPV is what we would like to calculate. So NPV, if investment changes or cost of investment changes, cost of investment increase by 10%. NPV if cost of investment increase by 10%. Now, can you tell me one more thing, my dear friends? Why are we worried about increase in the cost only? What if decrease in the cost happens? Should you think we should analyze that also? If cost decrease by 10%, what do you think? Is it required to analyze? What is your opinion? If cost decrease, NPV will increase. Absolutely correct. We need not worry about it, right? So we will not even discuss about it, because if cost decrease, NPV will increase. We are not worried about the positive factors. We are worried about the negative factors. If cost increase, sales reduce, inflow reduce. Understanding? Only we are worried about negative factors. So that is why they have asked, if cost of investment increased by 10%. So increased by 10% means what? What will be the new cost of investment, revised cost of investment, revised cost of investment 1,30,000 plus 10% increase, plus 10% increase. 10% means 13,000. So you get 1,30,000 plus 13,000, 1,43,000. So NPV, new NPV now. Same formula, present value of inflows minus investment. Present value of inflows is, we already calculated. Let me use the same number, 1,58,495 minus investment, new investment 1,43,000. So what is the NPV coming to? 15,495. Okay, so what is the requirement they're asking? How much NPV will change? How much NPV will change? We should always express in percentage terms. So what was previous NPV? 28,495 and new NPV 15,495. So what is the percentage change in NPV? You know how to calculate percentage change? New minus old divided by old into 100. I hope you know that. I'll quickly tell you. If petrol cost was 60 rupees, if it becomes let's say 70 rupees, how do we tell increase in cost? 60 becoming 70, increase is 10 in rupee terms. In percentage terms, we do 10 divided by 60 into 100. Nothing but what formula we do? New price minus old price divided by old price into 100. I hope you are aware of it. This is very basic elementary level. If you don't know, please note it down. New minus old divided by old into 100. So new NPV 15,495 minus 28,495 divided by new minus old divided by old 28,495 into 100. Minus 45.46 percentage. Minus 45.46 percentage. So if cost of investment increase by 10%, NPV will be reduced by 45.46%. This is the response of NPV. Write it down. What they've asked in the problem, we have done. I would like to go one step further. I would like to do a little bit of more analysis, which might be helping in other problems. But anyway, first, you take it down. Which question number is this? Whichever we were doing previously, the next problem. I hope you remember which was the previous problem which is solved. This is the next number. I'll just show you the question. This is the question we are solving. Following details relating to a project. That question. 45.62%, is it? 15,495 minus 28,495 by 28,495 into 100. Okay, 45.62. 45.62. Is it done? Shall I go one step further to understand and to interpret a little bit more? Any questions on these calculations? Please confirm. Is it done? Okay. So this is if cost of investment changes. Now I'll go one step further. Okay. So I'll go one step further. Now can you tell me in this NPV what are the other factors, other variables which are involved? One was cost of investments. Can I say other one is present value of inflows? Can I tell that also? Right? So let me take one more situation. If if cash inflow, okay, now tell me, if you are worried about cash inflow, are we worried about the decrease in cash flow or are we worried about the increase in cash flow? In which case our NPV will be affected. We are worried about negative impact. It is decrease, right? Not increase. So I will write if cash inflow decreases by 10%. If cash inflow decreases by 10%. Okay, so what will happen to our new NPV? Let's calculate what is the new cash flow will be. Cash flow was 50,000, decrease by 10%. So minus 10% decrease. 10% of 50,000 means 5,000. So 50,000 minus 5,000 means 45,000. So what is the new NPV will be? Present value of inflows 45,000 into annuity factor 3.1699 minus 45,000, sorry, minus investment 1,30,000 investment don't take the new one. We can't change all the variables together, one by one only. So how much we get? 45,000 into 3.1699 minus 1,30,000. 12,645. Positive number is it? 12,645.5, right? Positive number. Okay, fine. So what is the change in NPV? Change in NPV. Same formula. So same formula. New price 12,645.5 minus old NPV, existing NPV 28,495 divided by 28,495, that is divided by old, multiplied by 100. To express in percentage, we are multiplying by 100. So 28,495 by 28,495 into 100 minus 55.62%. Please check, is the numbers correct? These calculations. Instead of cash flow decreasing, cannot we decrease PV rate? That is one more different factor. We are trying to understand one factor at a time. They have given initial investment as one factor. I took cash flow as one of the factor. You can also take present value factor. You can also take number of years. Each one has an impact. But we are not trying to do everything. I would like to take one more factor. That is cash inflow is what I have taken. Right? Okay. Now let me do a little bit of analysis here. Small comparison. What is percentage change in variable and what is the percentage change or fall in NPV? I'm not using the word increase decrease because we are anyway taking the negative factor. We are worried about the adversely affected situations. So that you understand. NPV, we are worried about the decrease. Variables maybe increase decrease, but whichever is affected one we are taking. So I'm just using the word change, that is convenient. Okay, look at the first regarding the cost of investment we have taken. Cost of investment. What is a percentage change? We talk about increase. It was 10%, right? We took 10% increase in variables. How much NPV reduced by? NPV changed by 45.62%. NPV reduced by 45.62%. And what about cash inflow? We also took a decrease by 10%. So change by 10%. And what happened to NPV? NPV reduced by 55.62%. Now here can you tell me among the two variables, we can take many variables at this point in time, among the two variables, which is more sensitive? Which is more sensitive? cost of investment is more sensitive or cash inflow is more sensitive? Cash inflow is more sensitive, right? Because you see 55% affected, whereas this is 45% affected. So on a comparison basis, affection is more. Affection means the impact is more on a comparison basis in cash flow. You can see here impact is more. Impact is more. And that's what we say. Therefore, cash inflow is more sensitive as compared to investment. And we can also take lot of other variables. We will see in the next set of problems where we take in sale price, we can take variable cost, we can take fixed cost, we can take PV factor, number of years. Each variable will change NPV. So here impact is more, therefore comparison basis cash inflow is more sensitive. As percentages are negative, so the sensitive one is 55.62 only. So you don't worry about that negative plus minus. We are worried about negative only. If it is, as I told you, if it is a positive NPV, I don't even care about it. I mean, impact is positive. 55% is there, that impact is more, fall is more, worry is more. So we select it. So don't worry about these negative positive things. Look at absolute numbers. That is easy to apply. You can bring in plus minus, but mathematics will confuse little bit more. 45% impact, 55% impact. 55% is more impact. So that is more sensitive. That's it. That's why I have not used the word plus minus. Look at the heading. I have written percentage change. So the plus minus thing, take out from your head. Just focus on the percentage change. Things becomes more clear and more simple. Okay. I hope people are comfortable with this. Okay. Now, in the examination, they can ask you two kinds of thing. One, yeah, like this they've asked. If project is increased by 10%, by how much NPV will change, we calculate. But sometimes they say compute sensitivity. If they just tell compute sensitivity, they don't tell if project is increased by 10%. Like that they don't tell. But no problem. You can assume like this and solve like the way we have done it. So if they just say compute sensitivity, we can assume 10% change and we can solve like this. But there is one more alternative approach. I would like to discuss that here. And I would recommend this to write in the exam if they just say compute sensitivity. So alternative presentation. Alternative presentation of sensitivity. And this is recommended in the exam. If they say compute sensitivity of the factor, use this methods. You please write down somewhere so that you remember. Anyway, in the next problem and all we'll do, but you write down. In exam or in question, in question, in question, if requirement is to compute sensitivity, in question, if requirement is to compute sensitivity, then then apply this method, then apply this method, then apply this method, then apply this method. Okay, got it? So in the exam, if they just say compute sensitivity, then you please make sure you follow this method, what we are doing now. Okay, I want you to answer this. Slowly think and tell me what we are trying to understand. One variable, change, may increase, decrease, but we are worried about change that will affect us. And affecting means what? Our NPV is getting affected. Now, in life also, there is always a tolerance level, right? Even if somebody beats, we accept. It's okay, you beat. If somebody scolds, okay, you scold. I will hold on. I have patience. But there is one moment where we break out. We cannot take it. Similarly, negative factor comes, we will control. In some business, we manage the business somehow. But if it reaches beyond a point, we are seriously worried. Now, please tell me, if we are worried about the NPV change, we are worried about the impact on NPV, till what point we can accept the change, where project is still viable, still profitable? Beyond what point we are worried? Can you think of this? I'll repeat the question once more. NPV, up to what point we can accept the project? We are continue to be in the project. At what, till what points? Our NPV is 28,495. Till NPV becomes 0, somehow we can continue. If NPV becomes below 0, that's where we're worried, right? That's our tolerance level, can I say? NPV up to 0 is our tolerance level. So, there is this way of computing sensitivity. That is, sensitivity computation goes like this. You can also write along with me. What percentage change in factor that makes NPV 0? What percentage change in factor, that is how much percentage the factor should change so that NPV becomes 0. Why NPV becomes 0? That is our tolerance level. If it is beyond, NPV becomes negative, project is not financially viable. Getting it? Okay, let's calculate now. What is NPV formula? NPV is present value of inflows minus investment. And what is present value of inflows? That is cash flow multiplied by annuity factor minus investment. Okay, now we want to make NPV 0. I want to make NPV 0. And at what value this investment will NPV become 0? So I have to calculate investment. What is cash flow into annuity factor? Cash flow was 50,000. Annuity factor was 3.1699. What was that number? 1,58,495. So minus investment. So what is investment? If that comes to left side, investment should be 1,58,495. If my investment becomes 1,58,495, my NPV will become 0. but we need percentage change. So what is the percentage change in investments that makes NPV 0? New investment 1,58,495 minus old investment, that is 1,50,000, right? 1,50,000, no, 1,30,000. 1,30,000 divided by old 1,30,000 into 100. $21.91992, let's say 21.92%. So if investment increased by 21.92%, NPV becomes 0. Percentage change in investment that makes NPV 0. Don't worry about the plus minus. Just focus on the percentage change. So you understood how to calculate? You should make NPV 0, then what should be that variable? You can assume it as X and solve it. Then calculate the percentage change. That percentage is the sensitivity. So in the exam, if they just ask you sensitivity, write solve like this. We can do for any variable like cash flow. Yes, any variable. Now, first of all, how do you calculate cash flow? From the income statement, right? Sales minus variable expenses minus fixed expenses minus tax, profit after tax, minus depreciation plus depreciation, like that, right? So cash flow itself comprises of many variables. So each variable, same process. Assume X, make NPV 0, compute the percentage change. So sensitivity can be computed for each variable. This is done at the time of purchase investment. Yes, this is done at the time of purchase investment and also done subsequently, because some factor may change later. So if some factors are changing, we will be continuously reassessing it. But for exam purposes, these are all done at the initial time, at the beginning of the project, to understand which factor is more sensitive. But practically, we do it continuously. We review it. But from exam purpose, yes, we are all doing this at the beginning. And why are we doing this? To understand so many factors are there in the business, which factor should be given importance? Which factor should be given importance? Which is more sensitive? How to calculate sensitive? We are doing this. So by doing this analysis, we'll understand, oh, cash inflow is more sensitive, or sales price is more sensitive. So whichever is more sensitive factors, we should be more careful about it. You employ more number of people around it. Even if small changes, you do somehow that something is set right. So you take care of it. So when something is sensitive, you take care of it. That's the intention. This change in NPV we should only assume. That 10% change in NPV we should assume. But because if you follow this method to make NPV 0, if you follow this method, then you don't have to assume anything. That's why I say follow this method in exam. Institute will accept both, but I would recommend follow this method. That is to make NPV 0, that is our tolerance level. To make NPV 0, what should be the change in the factor? So that it is consistent and makes sense, right? That's our tolerance level. Up to NPV 0, we are happy. Beyond that, we are worried because project becomes non-financially viable. Financially not viable. Okay, so I hope you got it. My dear friends, can you do same process for cash flow and take a percentage? That means just like I take investment as investment or investment as X, you can say, then I calculate percentage. Can you do similar process for me for cash flow? So this is the sensitivity of investment, cost of investment. This is sensitivity of cost of investment. Similarly, please tell me what is sensitivity of cash flow. What do you mean by that? By what percentage cash flow should change so that NPV becomes 0? Please calculate. I'll give you 5 minutes. I want the percentage change. Worried about plus minus. As I told you, the plus minus percentage, don't worry. We just focus on percentage change. Because obviously you get negative number because cash flow decrease we're worried about. But let's look at the percentage. Okay, let me solve it for you, for those people who are yet to solve. So we will have to make NPV 0, NPV, cash flow, our present value of inflows, minus investments. NPV would like to make it 0. Present value of inflows, that is cash flow into annuity factor, minus investment. So NP will make it as 0. Cash flow, I'll keep it as cash flow itself. I would like to compute. Annuity factor 3.1699 minus investment. Minus investment, that is 1,30,000. So what is the cash flow? Will be that 1,30,000 comes left side, becomes positive number. Then 3.1699, you will take it to denominator. $41,010.76. 41,010. 0.76. So if cash flow becomes 41,010 or NPV becomes 0, so what's the percentage change? Percentage change in uh, cash flow that makes NPV 0. So as usual, new price minus old price, new cash flow 41,010.76, old cash flow 50,000, I think, yes, 50,000 divided by old cash flow 50,000 into 100. Don't worry about the plus minus, put the absolute number. 17.98, so 97898. So you get 17.98%. Plus minus, don't worry, as I told you. So if cash flow decrease by 17.98, decrease only, no, that's only, then only NPV is worried. So minus is automatic. So if cash flow changes by 17.98%, NPV will become 0. Let me just do a quick table comparison. Uh, okay, before I'll just ask you that, nothing to write. Now tell me this one. Tell me this one. If cash flow decreased by 17.98%, NPV decreased by how much percentage? Cash flow decreased by 17.98%. We have written that. NPV decreased by how much percentage? NPV becoming 0. 0 means the entire thing is gone. 100% reduction. 100% gone. Right? 100% reduction. Now tell me, which is more sensitive? 21.192 is more sensitive or 17.98 is more sensitive? Here you have to be a little bit careful. Your analysis, conclusion is same, analysis will change slightly. I'll repeat this analysis, you try to think. If cash flow changed by 17.98%, NPV reduced by 100%. Investment reduced by 21 or increased by 21.92% makes NPV 0 or make NPV 100%. In both the cases, NPV becoming 0. But who is more sensitive? What more sensitive? Small change, big impact. Cash flow has to change by just 17.98. Investment has to change by 21%. So actually in investment we have more time. Up to 21% is okay. Whereas the cash flow, if 17% changes, NPV becomes 0. So where NPV becomes 0 faster in cash flow. That's our conclusion. Here also we told cash flow is more sensitive. Our conclusion will not be different. Our analysis will be slightly different. That's why I would tell, if you follow this method, choose whichever is less, because small things are more sensitive, right? You remember when you are giving gift to your girlfriend or boyfriend, will you give small ring or will give you tire, big one? Smalls are more sensitive, right? Big ones are not sensitive, small one. So remembering wise, you can say when you follow this method, lower the percentage, the sensitivity it is. So it is more sensitive because lower percentage that makes NPV 0. So select whichever is lower. So when the percentage is less, it is more sensitive. Remember like that. Okay. Hope things are clear here. Now, uh, now I'll come to purely from exam point of view. Subsequent problems and all, I'll follow this method. These are all logically perfectly fine. But if you want to solve the problem quickly, the shortcut is there. I'll tell you with the logic. There is shortcut, I'll tell you with the logic. Now, ultimately, what we're worried about, we are worried about NPV becoming zero, right? NPV becoming zero, right? That's what we're worried about. What is our current NPV? Our current NPV is 28,495. Current NPV is 28,495. If that NPV is taken out, NPV becomes zero. So when you say investment, because of investment NPV becomes zero. So our investment, if it is increased by 28,495, don't you think NPV will become automatically zero? I'll tell you what I'm trying to tell. Don't worry. We'll write down. Alternative you can write down. This is a shortcut you can say. Shortcut for the same answer. Okay. So cost of investment sensitivity. Cost of investment sensitivity is calculated like this. You write in the numerator NPV, denominator you write the cost of investment multiplied by 100. What is NPV? 28,495. Yeah, 28,495 divided by what is cost of investment? 1,30,000 into 100. How much you get? 21.92 percentage. Same answer, right? So much circus we did. None of this circus required. Simple answer. Numerator NPV, denominator whichever is the variable you are doing. That's all. Why is that? Because we are worried about NPV change. So if my cost of investment 1,30,000 increased by 28,495, that is our NPV. If 1,30,000 takes out entire NPV, NPV becomes zero only, no? Anyway, forget the logic. Remember the format, simple format. Numerator NPV, denominator whichever is the variable you are doing. That's all. One line answer. None of this circus required. I know you will be thinking, why is this circus required then? You could have told this one line shortcut. You could have finished the class earlier. But the logic you will not be able to get. The concept you will not be able to get. For that, I have to spend so much of process. So this one line calculation is sufficient from exam point of view. You can follow the big process. That's also fine. You can follow the shortcut. That's also fine. Have you taken down? We'll apply this in the next variable also. In some cases, the shortcut cannot be applied. I'll tell you when. In those cases, you have to follow the regular process only. That is, you have to make NPV 0, then calculate the percentage change. Is it done? Shall we apply this for the cash flow part? Shortcut. Okay, so I'll go to the cash flow part now. Cash flow sensitivity. NPV divided by cash flow. But one small thing here, my dear friends. I cannot just take only cash flow. Can you tell me why? Can you think why? Cost of investment, we took it as it is. But cash flow, I cannot take it just the cash flow. Why is that? Yes, because NPV is in present value terms. Cash flow is not in present value terms. Not one number. Yes, that's what I'm trying to tell. NPV is in present value terms, but cash flow is in annual terms. Two different points in time. So how do we bring cash flow also into present value terms? Very simple. We'll multiply it by annuity factor. If every year cash flow is different, I will apply by discounting factor. So basically, numerator should be in present value terms. Denominator should be in present value terms. So NPV 28,495. Cash flow 50,000. Annuity factor 3.1699 into 100. 17.98%. You can check it. And little bit of calculator technique. Some of you might be aware of it. I'll tell you anyways. You don't have to do like this 50,000 into 3.1699, write down somewhere, then divide. You don't have to follow that process. What you can do in the calculator, 28,495 divided by 50,000 divided by 3.1699. Keep dividing it. Divide by 50,000, divide by 3.1699 into 100. So you get the answer straight away in calculators. Okay, is it done? Okay, so in general, I'll just try to make a summary part of it. I hope you have done it. I'll just make a summary of the sensitivity, what to be done for solving problems. That one we will apply from next problem onwards. Okay, so sensitivity analysis problems. You can do it in two methods. Method 1, assume 10% change in variable and compute percentage change in NPV. That's what asked in the problem. That method you can do it in other problems. Assume 10% change in variable and compute percentage change in NPV. Method 2, make NPV 0. Make NPV 0 and compute
percentage change in variable. Make NPV 0, percentage change in variable, and there is one shortcut for this. The percentage change in variable, there's one shortcut for this, and that is NPV divided by present value of any variable. Present value of any variable multiplied by 100. Present value of cash flows, present value of sales, present value of variable cost, present value of fixed cost, anything like that. The present value variable into 100 is the shortcut, but the shortcut do not apply for shortcut don't apply for two factors, two variables. One is cost of capital and the other is life of the project. Usually they will not ask this in the examination, but anyway. For these two things, you have to go traditionally. What is traditionally? Make NPV 0 and then solve based on that. There is no shortcut like NPV by present value of that. So shortcut don't apply in these two situations. In all other situations, you can do NPV by present value of that respective variable. Okay, done? Good. Okay, hope you have come to this problem. This is the one you got. Next one. The following information applies to new projects. Initial investment, selling price per unit, variable cost, fixed cost, sales volume, life, discounting rate, project's NPV, compute the project NPV and show how sensitive the results are to various input factors. Okay, so this problem is based on sensitivity analysis. Sensitivity. In English word, what is sensitivity? Means response, reaction. So you people also, how you react in different ways. Some people react in one manner, some other people react in some other manner, right? Like for small things also, some people react too much. For small things, like some movies coming in TV, some people are too excited. Small things also they react too much. Or some cockroaches coming, you shout. You are so sensitive. And some people are insensitive. They do not care at all. Anything happens, they don't react. They say, Sachin Tendulkar is coming to see you. You say, okay, no reaction. Or somebody say, there's earthquake happening. You say, okay, no reaction. Some people don't react. Some people react too much. Let's say less sensitive, more sensitive. Like that. Like that. You will have in projects also. Some factors are less sensitive. Some factors are more sensitive. We have to take care of more sensitive factors. How do you know which factor is more sensitive? We are going to learn how to calculate. So we are trying to calculate NPV, correct? If NPV is positive, we say project is profitable. If NPV is negative, we say project is not worth it, not financially viable. Okay. Now, if for example, selling price. If selling price increase, we don't worry much. Our profit will increase. But if selling price decreases, our profit will reduce. So what will happen to NPV? Will NPV become 0? Will NPV become negative? If NPV becomes negative, then we are worried. So what we are trying to calculate is what is the percentage change in selling price which will make the project financially non-viable, which means what percentage in selling price makes NPV zero. If NPV zero means project becomes loss making project, below NPV, negative becoming negative. What will be that selling price? To what percentage you can accept it? Let me calculate and you'll get a better logic with that. I'll give a shortcut also afterwards. Okay, so first let's calculate NPV. NPV formula, basic one, present value of inflows minus investment. Okay, now in this problem, inflows are not directly given. So can I use the things like this? Selling price minus variable cost, because selling price per unit, variable cost per unit. So I get the, what do you call this difference? Selling price minus variable cost per unit. What do you think it's called? I know it's profit, but to be specific, what is it called as? Selling price minus variable cost is called as contribution. But I'm doing per unit. I know number of units. So how do we get total contribution? Selling price minus variable cost multiplied by number of units. Correct? This will give me total contribution. What else we have to compute profits? We have fixed expenses. So I subtract fixed fixed expenses. Fixed cost, fixed expenses. Now at this stage, I know we have to do depreciation and all, but tax rate not given. When tax rate not given, the depreciation does not matter. Because why depreciation matter? Only because of tax benefit, only because of tax calculation. If no tax rate is there, don't worry about depreciation. So this will be our annual cash flow. No tax rate also given. So no need to do any tax rate. This itself is your annual cash flow. But I want present value of this annual cash flow. Since every year cash flow is same, I want a present value. What do? I multiply it by annuity factor. I multiply it by annuity factor, then subtract initial investment. So subtract initial investment. So selling price. What is selling price? 100 rupees minus variable cost 30 rupees multiplied by number of units 2000 minus fixed cost 1 lakh multiplied by annuity factor. How do you calculate annuity factor? At the rate of 12% for 5 years. Minus initial investment, which is 1,25,000. So this is 70 into 2000, 1,40,000 minus 1 lakh. Into annuity factor 1 by 1.1 equal to 5 times GT. $3.7908 minus 1,25,000. So 40,000 into 3.7908 minus 1,25,000. 1,51,632 minus 1,25,000. 26, 630. See, the numbers are fine. Hope you are comfortable about these calculation of NPV. Is it fine till here? NPV calculation? Okay, now we'll go for sensitivity factor. What is sensitivity? When one variable changes, we want to know how much NPV will change. So, what is sensitivity? That is the impact on NPV. Sensitivity means calculation of impact on NPV. Sir, why NPV? Because NPV is the most important parameter which makes either accept a project or reject a project. So we are trying to understand to what extent a factor can badly influence NPV. Let's say, take an example of, let's say, selling price. So let's calculate selling price sensitivity. Okay. So what I'm going to do, in the first point I'm going to calculate at what selling price NPV becomes 0. At what selling price NPV will become 0. How do you calculate? Any idea? Simple mathematics. We'll assume selling price as X. Or if you'd like some other alphabet because your X is different alphabet, you can take that also, no problem. We'll assume, we can't do any cross multiplication directly. We'll assume selling price as X. And then we'll have to solve the equation. So entire equation we have calculated, no, same thing I'll repeat. NPV, cell calculation I've done, no, that 100, instead of 100, I will take it as NPV as, I'll take it as X. So please compare, I'm using the same equation I've used earlier. This 100, I will take it as X. Selling price was 100, now you take it as X and equate this as 0. Make this equation to 0. Equate this NPV to be 0. Hope you got this one. Let's simplify now. 1,25,000 comes left side. So minus becomes plus. 1,25,000 equals, I'll open the brackets. 2,000 into X means 2,000X minus 2,000 into 30 means 60,000. Minus 1 lakh multiplied by annuity factor. Annuity factor we already calculated 3.7908. So 1,25,000. Again, open the brackets. Or actually, I can take 3.7908 to the left side. So it will come to denominator 3.7908. $2,000x as it is. 60,000 also minus. 1 lakh also minus. So I can make 1,60,000. So 1,25,000 by 3.7908. 32,000 975, a round off, 2000x minus 1,60,000. So 1,60,000 comes left side, becomes plus 32,975 as it is, equals 2000x. So 2000x equals 1,92,975. So x equals 1,92,975 divided by 2000. 96.4875. That's a 96.49. $96.49. Okay. So if selling price is 100, we get NPV of 26,632. If selling price becomes 96.49, what will happen to NPV? NPV will become 0. So what is the percentage change? Selling price change from 100 minus 96.49 divided by 100 into 100 divided by 100 into 100. Percentage change, current price minus new price divided by old price into 100. You get 3.51%. So which means if selling price increase, we don't worry. If selling price decrease by 3.51%, NPV will become 0. NPV becomes 0 means how much percentage of NPV is gone? 100% NPV is gone. Every NPV is gone. Entire NPV is gone. So if selling price changes by 3.51%, if selling price fall by 3.51%, NPV will become 0. That is, NPV will reduce by 100%. So this NPV is, this selling price 3.51% is called as selling price sensitivity. Is called as selling price sensitivity. Okay. Hope you got it, the meaning of it. Selling price sensitivity means if the selling price changes by 3.51%, if selling price changes by 3.51%, how much our NPV going to reduce by? NPV becomes 0. So that percentage is called as sensitivity. So we have computed for selling price sensitivity. Like that, we'll have to calculate for variable cost sensitivity. Like that, we'll have to calculate for fixed cost, discounting factor, time period, initial investment, and so on. So basically, when those factors will make NPV 0. What process to adopt? Assume that factor as X and keep calculating others. Then the project has become useless. Okay. That's not the way you have to understand. In costing, they know, or in economics also, there's one concept, right? Break even point. What is break even point? What is break even point? Break even point, no profit, no loss. Correct. No profit, no loss. So can I say business is useless? No profit, no loss. Business is useless? No. That is a benchmark, right? That is for us to help decision. That is the minimum number of units to be sold. That's a benchmark for decision making. Now, if I tell you in your body, heart is more sensitive. If heart fails, your body fails. What's the use of heart then? Let it fail. No. We want to understand in the body, heart is more sensitive. So we have to take care of heart more. Like that, in the project, we calculate which factor is most sensitive. And by identifying that factor, we can take care of it better. But to take care of it better, we have to identify. To identify means we want to know which is more critical. And how do you know which is more critical? By calculating these percentages. Selling price, how much percentage? Variable cost, how much percentage? Like that we calculate for all the parameters. Then we choose which is the most critical one, and we'll try to give importance to that. We'll take care of those factors. For example, if selling price is sensitive, then selling price we make sure that it is not changed. Even if GST comes, some tax comes, we don't change the selling price because the selling price is very, very critical. Hope you get the point. The objective of this exercise is to understand which factor should be given importance, because a slight change can make this project loss. Slight change can make NPV 0, which is very, very critical, because if it happens, then the project becomes useless. We want to make sure that does not happen. Okay, hope you got the logic behind it. Now, this process what we followed, mathematical process, assuming it as x, solve for big calculations, big equations, very, very long process. So what I explained to you is fine, but I don't want to follow this method for solving other parameters. Other parameters also you can do. How you can do? For variable cost, don't take 30, take it as you solve for it. You can get it, but I don't want to follow that route. I would like to follow one more route. There's one beautiful shortcut available. That shortcut you can use in exam also. But before I go to shortcut, I have to explain the logic behind that shortcut. So for that, I will go with one regular calculation of NPV calculation. It's a repetition for you now, but please follow. I would like to follow this process. Now what I'm going to do, stay focused. What I did using annuity factor, no? Or whatever the everything I compute on net basis, selling price minus variable cost. I don't do that. Everything I do it on a separate present value. Selling price, separate present value. Variable cost, separate present value. Fixed cost, separate present value. See, this everything I did on net basis. I got 40,000 net. I don't want to do on net basis. Everything I do it separately. So what we'll have now? Same parameters I'll do, but I will do calculation one by one. Please observe, you also write down parallelly. Year, since every year is same amount, so I'll say year 1 to 4. I will show sales, variable cost, I'll say short form, contribution, everything I compute separately. Same sum, I'm computing for the same number only. Instead of calculating in a net basis, I'm doing it on a separate basis. Sales, variable cost, contribution, fixed cost. You apply discounting factor. I'll use short form. Fixed cost. Discounting factor. So sales, what is my annual sales is going to be? Selling price is 100, number of units 2000. So 100 into 2000. I want annual sales. 2 lakh. Similarly, variable cost. Variable cost 30, annual sales 2000. 30 into 2000. 60,000. Contribution 2 lakh minus 60, 1 lakh 40,000. Fixed cost 1 lakh. Okay, discounting factor 3.7908. Okay, now what I did earlier, sales minus variable cost, contribution minus fixed cost, profit we got. We got net amount, then I multiplied by discounting factor, correct? But here I'm not doing on net basis. I'm calculating every year on separate basis. Year 1 to 5. Okay, I'll make it year 1 to 5. I'm calculating each factor present value separately. Listen to me once more. I'm not calculating on a net basis. Then multiplied by present value factor. I'm calculating present value of sales, present value of variable cost, present value of fixed cost, like that. Each element present value I'm calculating separately. Then what will happen? Multiplied by discounting factor, all present values. Present value of sales. How do you calculate? Then present value of variable costs. Then present value of contribution. Okay. So what is present value of sales? 2 lakh into discounting factor. 2 lakh into 3.7908. 2 lakh into 3.7908. 7 lakh 58. 160. Present value of variable cost. Oh, fixed cost also there. I'll use short form. Every present value I need, that's all. Present value of variable cost. Present value of fixed cost or contribution. Present value of fixed cost. So variable cost, 60,000 into 3.7908, 2,27,448. Contribution, 1,40,000 into 3.7908, 5,30,712. Fixed cost, 1 lakh into 3.7908, 3,79,080. Okay, so you got all the present values. So everything we got in present values. So NPV, how are we going to calculate then? NPV is calculated by present value of sales minus present value of variable costs minus present value of contribution. I don't have to do. Sales minus variable cost will give me contribution only. Present value of fixed cost minus initial investment. Initial investment anyway present value only, no. So you don't have to worry about present value of initial investment. So present value of sales is 7,58,160. Present value of variable cost is 2,27,448. Present value of fixed cost 3,79,080 minus initial investment, that is 1,25,000. How much NPV will come to? 26,632. Are you getting the same numbers? Are you getting the logic also? Very simple. Instead of doing it on net base originally, I'm doing independent calculation because I want each factor sensitivity separately for that purpose. Okay, now please confirm you have written till there. Can this be done in exam? Yes. There are other methods also available. Any method can be approached, can be followed in exam because these are all sensitivities. Methods are different. Ultimate answer is same only. You can follow it. This is easy, but wait for it. I'll give you, I'm going further with respect to this. And I have not calculated sensitivity yet. I just calculated NPV. I have not gone for sensitivity calculation. Now I'm going for sensitivity calculation. Okay. So selling price sensitivity. Okay. Now please observe this. Please listen to me carefully. We are calculating selling price sensitivity means at what selling price NPV becomes 0. So currently my NPV is how much? Currently my NPV is 26,632. It should be reduced by how much to make NPV 0? It's a very simple question but can be confusing. Our current NPV is 26,632. It has to become 0. So how much NPV should reduced by? 26,632 only. No. If 10 rupees should become 0, 10 rupees should be reduced full. Correct. Full should be reduced. Means 26,632 should be reduced. Next question. Reduction in which variable should make NPV 0? So which variable should be reduced by 26,632? It is sales. We are discussing selling price sensitivity. If you're discussing variable cost, then I'll do variable cost. If I'm dealing fixed cost, then I'll do fixed cost, like that. Okay. So I'm talking about selling price sensitivity. So my sales, if it reduces by 26,632, my NPV becomes 0 because sales reduces means I should take NPV also reduces, sales reduce, NPV reduce, NPV becomes 0. But I cannot compare 2632 with 2 lakh. I repeat the last sentence. Listen to me carefully. Reduction
in NPV, sales reduces, NPV reduces. But I cannot compare 26,632 with 2 lakh. Why I should not compare? Because 2 lakh is annual, 26,632 is present. So 2 lakh is not a right comparison. What should I comparison then? Instead of 26,632, right comparable number is present value of sales, which is 7,58,160. That number is comparable because 7,58,160 is present value and NPV is also present value. Since both are present value, they are comparable. Now let me calculate selling price sensitivity is simple formula NPV divided by present value of sales. What is NPV? 26,632 divided by present value of sales 7,58,160 multiplied by 100. Are getting 3.51%. That's all. We got answer in one simple formula. No need to assume x, solve for x, remember about your x, feel bad for it. Once you calculate, then you calculate percentage change. Nothing required. NPV divided by that particular variable, you get the answer. Simple. Over. Like that. If I have to calculate variable cost sensitivity, I don't have to follow X method. what should I do? NPV divided by present value of variable cost. Hope you are getting it. Why should I divide by present variable cost? Because I'm calculating percentage. My present value of sales is 7,58,160. If that reduces by 26,632, it becomes 0. NPV becomes 0. So 7,58,160, out of that 26,632 means what percentage? Oh, divided by. Okay, okay, got it. Not multiplied. Got it, got it. Divided by. Yes, that's a typing mistake. Divided by. Hope you got it mathematically, logically. Simple concept, simple formula. No need to calculate too much long process, mathematical process. Numerator NPV, denominator present value of whichever factor you are calculating. So selling price divided by present value of selling price. Variable cost, you divide by present value of variable cost. NPV is 26,162 divided by variable cost, present value variable cost. We calculated 2,27,448 into 100 to express in percentage. 26,632 by 227,448 into 100, 11.71%. But remember only one small thing, selling price should reduce to reduce NPV, but variable cost should increase to reduce NPV because cost should increase. But that does not matter. We are looking at the change. Increase, decrease does not matter to us. We are worried about a change in a parameter will make NPV 0. So don't worry about plus minus. Just focus on the percentage. Okay. Then fixed cost sensitivity. Fixed cost sensitivity, NPV divided by present value of fixed costs. What is NPV? 26,632. Present value of fixed cost, not fixed cost. Present value of fixed cost, 3,79,080 into 100 to express in percentage. 7.05, let's say 7.03%. Okay. Volume sensitivity, number of units. For volume, you wrote divide by volume because NPV is rupees and volume is number of units, not comparable. So we do NPV divided by contribution, we do present value of contribution. NPV, that is 26,632 divided by contribution. Present value of contribution 5,30,712. 5.02%. So this is volume sensitivity. For volume, make use of contribution because contribution increase means when volume and contributions are related. Okay, then initial investment sensitivity. Investment sensitivity. Okay. Now what do we do? NPV divided by present value of investment. I don't have to say. Why present value of investment? I don't have to say. Investment is already in present value terms. So NPV divided by investment. What is NPV? 26,632 divided by investment, which is 1,25,000 into 100 to express in percentage. 21.31%. This shortcut can be used in exam. Yes, only in this kind of exam. Yes, in this problem only. Whenever they ask you to compute sensitivity, you can use these concepts. Only in sensitivity, that big calculation not required, you can use this format I'm telling you. Okay. Now, these things are fine, but there are two more factors which I doubt they may ask in exam, but still as a concept I would like to discuss. So, for which there is no shortcuts. One is rate sensitivity, the other is project life sensitivity. One is the rate sensitivity, other is project life sensitivity. So that too, I don't have any shortcut. I have to do it in a detailed calculation. I'll explain that. But before that, any doubts still here? Okay. So I'll just calculate the two more factors. One is rate sensitivity percentage. Other is project life sensitivity, number of years. Both of them, I doubt they can ask in exam, but I still calculate so that all the concepts of this chapter is covered. So I'll come to that. One is rate sensitivity, discounting rate sensitivity. Okay, what is discounting rate sensitivity? Uh, Going back to the basics, at what selling price NPV becomes zero? At what variable cost NPV becomes zero? I want to calculate similar process. At what rate, at what discounting rate NPV becomes zero? You know what this is called as? At what rate NPV becomes zero? Remember, IRR, correct. We have to calculate IRR. Once I calculate IRR, then I'll be able to calculate the sensitivity. Let's calculate IRR. So at what percentage I got this number, my annual cash flow, year cash flow, discounting factor, discounted cash flow, year 1 to 5. What is our annual cash flow? We made use of this calculation earlier. I think annual cash flow 40,000, right? We did calculation earlier. I'll make use of that. 40,000. Discounting factor should be what? So that NPV becomes negative. Okay. Let's say I need to take a higher rate or lesser rates. Their discounting rate was 10%. At 10%, NPV we got 26,632. NPV should become zero. NPV should reduce or become negative. NPV negative. What should be discounting rates? Higher rate or lower rate? Less than 10%. Still have confusion. We need to take a higher rate. There is an inverse relationship, correct? So if we want to reduce NPV means our discounting rate should be a higher rate. So let's take 20%. Why take a chance? Let's take 20%. I can take 15, 18 also. 20%. How? 40,000 we already calculated, right? I showed you. 40,000. I am marking you. 40,000. Sales minus variable cost minus contribution. 40,000. Got it? Annual cash flow 40,000. We have done the calculations earlier. I'm making use of that. Okay. So discounting factor 20%. Give me the annuity factor. So 1 by 1.2 press equal to 5 times and then GT. 2.9906. So discounted cash flow comes to 1,19,624 minus investment. This is present value of inflows. There is no other things. less initial investment, 1,25,000. So you get negative 5376. So you know the IRR formula. Let's use IRR formula. IRR formula is lower percentage 10% plus difference in percentage 20 minus 10 divided by difference in NPV, 26,632 minus of minus 5376 multiplied by NPV at lower percentage, that is 26,632. So 10 plus this is also 10 into 26,632 divided by minus of minus becomes plus. So 26,632 plus 5376, 32,008. So 10 plus 10 into 26,632 divided by 32,008. 16.10 into 26,632 divided by 32,008. 8.3. So 10 plus 8.32. So we can say 18.32. So basically, if discounting rate 10% becomes 18.32%, NPV becomes 0. So what is the discounting rate sensitivity? That is 18.32 minus 10 divided by 10 into 100. Hope you understand this. Like if 50 rupees becomes 60 rupees, that is you do 60 minus 50 by 50 into 100. New price minus old price by old price into 100 to calculate the percentage that I'm using. So 18.32 minus 10 divided by 10 into 100. That gives me 80 something. 83.2%. So discounting rate sensitivity is 83.2%. So discounting rate should change by 83.2% of the current one to make NPV 0. It's not so sensitive, correct. We'll have to compare all of them. Then we can say which factor is most sensitive, second sensitive, and so on. Let me do one more, then we can uh, compare all of them. Explain the last step. That's very elementary. Anyway, I'll do it. But if that is not known, then you have to really work on your basics. If your current price is 20 rupees, if new price becomes 23 rupees, if you want to calculate the percentage change, how do you calculate? 23 minus 20 divided by 20 into 100. That's how you calculate the percentage change. Like that. 10% is the current one, 18.32 is the new one. So how do we calculate the percentage increase? 18.32 minus 10 divided by 10 into 100. Percentage increase. Hope you understand this calculation. Okay, so I'll go for the last one. Today I'll extend the class for maybe 5 minutes. So I know I'm just crossing it. So please bear with me so that I'll complete this portion, this part. Only one more I have to calculate. Project life sensitivity. Project life sensitivity. I'll just calculate this one, then I'll compare. Project life sensitivity. Okay, now project life sensitivity. First, I have to calculate in which time NPV becomes 0. What is NPV becoming 0? I recover only my investment. Can you tell me what is that concept? When will you recover your investment? In what time your investment is recovered, that is payback period. But I'm talking about present value concept also, so I don't say payback period, I will say discounted payback periods. So at what period investment is recovered, meaning we'll calculate discounted payback period. Okay, so for that I have to calculate yearly separately. I can't use annuity factor shortcuts. So year 1, 2, 3, 4, 5. Cash flow 40,000 per annum. I showed you earlier how to calculate this. Discounting rate at 10%, calculate separately. One by 1.1, 0.9091, 0.8264, 0.7513, 0.6830, 0.6209 multiplied by 40,000. 40,000 into 0.9091, that is 634, 33,056, 30,052, 27,320, 24,836. Okay, let's calculate cumulative discounted cash flow. So first one 36,634 only, 36,634 plus 33,056, 69,690 plus 30,052, 99,742 plus 27,320, 1,27,662 plus 24,836, 1,51,898. Okay, fine. So when is the investment recovered? 1,25,000 recovered, investment recovery. Investment recovery in after where 1,25,000 is crossed in fourth year. In fourth year means between, that is between third and fourth years. Between third and fourth year. So answer is going to be 3 points something. So investment recovery divided by discount cash flow of that year. Investment recovery 1,25,000 minus previous recovery 99,742 divided by discount cash flow of that year 27,320. Please refer our discussion on discounted payback period for this calculation once more. So 1,25,000 minus 99,742 by 27,320, 0.9245. Okay, 0.92. So basically 3.92 years. 36,364 first year. 36,364. Okay. So this calculation will slightly change. small change. You can leave it as it. Okay, that's my mistake. You can change also. I'll change quickly. Plus 33,056, 69,420 plus 30,052, 99,472 plus 27,320, 1,26,792 plus 24,836, 1,51,620. Okay, so I'll divide by not 99,742. I mean 472, 99,472. Divide 27,320. I get 0.934. Okay, 0.93 I get. I think that's all difference. 0.93. So what is this 0.93 means? If my project life becomes 3.93, my investment is recovered. And if I don't have any further life, if I stop the project at this point, I recovered only my investment, which means my NPV will be 0. So if the project life becomes 3.93 years, of course below, I'm gone. But if the project life is becoming 3.93 years, that means my NPV will become 0. Therefore, what is the percentage change or project life sensitivity? Project life sensitivity. Again, current minus new. That is 3.93 minus current is 4. No, 5. Current life is 5 divided by 5 into 100. You get negative number. Don't worry about the minus number because this reduction will be a problem. So don't worry about the minus number. Just calculate the percentage. 3.93 minus 5 divided by 5 into 100. Just the absolute percentage, 21.4%. So if the project life reduces by 21.4%, my NPV will become 0. So project life sensitivity, tolerance level in project life is 21.4%. Now I'll just compare with all other sensitivity. Please compare all of them. We got all other sensitivity, right? 3.51, 11.71, 7.03, 5.0, 21.31, 83.2 and 21.4. Which factor is most sensitive? For that, one confusion may arise. Higher percentage should I take or lower percentage should I take? Keep it in mind, all these percentages will make NPV 0. All these percentage. So selling price will change by 3.51%. Let's say 3.5. NPV becomes 0. Whereas the project life 21%. So which is most sensitive? Selling price, a small change can make NPV 0. Project life 21% is there. Time is there. So lower the percentage, higher the sensitive. So lower the percentage, higher the sensitivity. So selling price is the most sensitive one in this case. In some other project, some other variable can be most sensitive. So as a project manager, it's my responsibility to make sure selling price is not touched under any conditions. We don't want to give lot of discount. I don't want to change the selling price because a small selling price can cause NPV 0. The project may become loss. You should be careful with respect to selling price. Okay, so it's a full-fledged problem. In the examination, I really don't expect you to calculate all the sensitivity factor. In the exam, they'll ask you to calculate maybe 1 or 2. That's all, maximum. We have done all to understand all, and that too specifically this project life sensitivity and rate of return sensitivity, I don't expect at all. That is only others like selling price, variable cost, fixed cost. Only that they can only that you can expect. They can change the project only. I did not get the question. What is that question? They can change the project means? Because once you start the project, you can't change it, you can't stop it. So you have to make sure your critical factors are given highest priority. Okay. Hope all of your question got addressed. This is when we are conducting the project, correct? Once we start the project and before starting the project also. Before starting the project, if somebody tells you selling price is 3.51 sensitivity and in the market selling price is very, very fluctuating, I don't even go for the project. That's what you're telling, I think. But once I start the project, then if my variable cost, I calculated what percentage? Variable cost 11.71%. I thought 11%, no problem, variable cost. Now, suddenly, once I start the project, variable cost is increasing by 10%. Out of 11.71, 10% increased. Now, suddenly, variable cost becomes more sensitive now. My limit of 1.71% only balance is there. So, these parameters, this discussion is important at the start of the project as well as when the project is running. In both situations, these are important. This particular discussion. Okay. Hope you got the points of sensitivity analysis.
Okay, so are you able to come to this problem? From the following details relating to a project, analyze sensitivity of the project changes to the initial project cost, annual cash inflow, and cost of capital. Are you able to get this question? Same question, right? You are having? Okay. So they're asking us to analyze the sensitivity of three factors: initial project cost, annual cash flow, and cost of capital. They have given those data: initial project annual cash flow, project life, cost of capital. To which of these three factors project more sensitive? See, here they have not given, assume 10%, right? If 10% change in variable, how much percentage change in NPV? They have not told like that. So one method you can do like that. Assume 10% change in project cost. How much NPV will change? Assume 10% change in annual cash flow. How much NPV will change? Assume 10% change in cost of capital and compute how much NPV change. That is one method, but I will not follow that method. You can do in exam, accepted. I will follow the other method. What is the other method? To make NPV 0. Okay. Let's calculate. First, let's calculate NPV. Then shortcut method is there. Let's make use of that. So present value of inflows minus investment, annual cash flow into annuity factor, that is present value of inflows. Annual cash flow is 45,000. Annuity factor at 10%, they only have given for 10%, they said take 3.169. Directly they said. So we'll make use of that. 45,000 into 3.169 minus investment 1,20,000, we get NPV. Okay, then one by one factors will calculate. Sensitivity with respect to project cost. What is the formula? NPV by project cost, which is already in present value terms. Straight away you go for it. NPV by investments. 22,605 divided by 1,20,000. It's already in present value terms. Then multiplied by 100 to express in percentage. Okay, can you calculate for cash flow, my dear friends? Sensitivity with respect to the cash flow. Can you try calculating it? By now, you should be prepared for it. Please try, give a try. Can you try calculating for cash flow? Okay, so it is 15.85%. Many of you are getting it. Very nice. NPV by present value of annual cash flow. Basically, present value of that factor. That's all. Annual cash flow to present value means multiplied by discounting factor. Here, annuity factor. Okay, but for sensitivity with respect to cost of capital, I told you the shortcut don't apply. We have to follow the traditional method. What is that? We have to make NPV 0. So annual cash flow 45,000. Cost of capital we'll assume we don't know how much into annuity factor. Let me write down. Annual cash flow 45,000 into annuity factor. At what percentage? I need to calculate that. Comma. Number of years. How many years? 4 years. Minus investment 1,20,000 should make NPV 0. So 1,20,000 goes to right side. That becomes plus 1,20,000. And this remains as it is 45,000 into annuity factor. At what percentage we should calculate? Comma 4. And one more small point. My dear friends, do you remember what is this percentage called as? Which makes NPV 0? We have discussed at what percentage NPV becomes 0. What is it called as? Anyway, I don't know whether you remember. That is what is IRR, isn't it? The rate at which NPV becomes 0. When the percentage changes, increases, NPV reduces, percentage reduce, NPV increases. At what percentage NPV equal to 0? IRR. Effectively, we are calculating IRR only now, nothing new, nothing fresh. But anyway, let's calculate at what percentage NPV should become IRR. We'll follow this process. So, annuity factor, since the table is given, we can make use of the table. We can also do interpolation method, that is also fine. So, annuity factor, percentage comma 4, 1,20,000 divided by 45,000. 2.6666. Okay, let's say 2.67 approximately. 2.67. So one method you can do, IRR what we did, at this percentage, at 10% we got NPV positive, you assume one more number, let's say 20%, you make NPV negative, in between you do interpolation method. That method also you can do, but here we have the table, so approximately you will be able to find out. I hope you got the number now. You should look at the annuity table which is given in the problem. At what percentage for 4 years we get 2.67. So take a look at the table. Look at 4 years column only. We should not look at any other thing. Look at 4 years column, and where we get approximately 2.6. 2.67, right? 2.67. So 2.66 is 2.67. Approximately, where is it? 2.67. Approximately, right? 69 approximately. 2.67, 2.69 approximate number. So our answer is approximately 18%. If they ask you IRR, you have to calculate fully, but this is a full-fledged problem, so we don't have to be very, very accurate. So this method is fine. When they give you table, if they don't give table, you have to solve IRR method only. So approximate method is 18%. So this percentage, the percentage cost of capital that makes NPV 0 is 18%. So what is sensitivity then? Sensitivity, new cost of capital 18 minus old cost of capital 10 divided by old cost of capital 10 into hundreds. So that becomes 18 minus 10, 8 by 10 into 100, 80% I think. And which is more sensitive? You should select whichever is less. Small is sensitive. Ring example, tire example, remember, small is sensitive. So more sensitive is, in this case, among the three factor, is annual cash flow most sensitive. Most sensitive. Okay, hope it is done. That's all, right? Nothing else in the problem. Yes, let's go further. I'll go further. Next one. Red Limited is considering a project with the following cash flows: years, cost of the plant, recurring cost, savings. The cost of capital 9%. Measure the sensitivity of the project to changes in level of plant value, running cost, and savings, considering each factor at a time such that NPV becomes zero. The PV factors are given. Which factor is more sensitive to affect the acceptability of the project? Here you don't have two choice. You can't assume a variable changing by 10% like that, because they only said such a way that NPV becomes zero, but a shortcut can be applied. So what is the first shortcut? You calculate NPV by present value of that respective variable. Let's calculate NPV first. So let's calculate year, cash flow, discounting factor, discounted cash flow. Why I'm writing this? Why I'm not using annuity factor here? Can you tell me why I'm not using annuity factor here? Why I'm going for discounting factor here? Why are we not using annuity factor? Not using annuity factor because cash flows are different, right? Every year cash flow is different. So let's calculate year 1, 2. Only 2 years are there. Cash flow, savings is inflow, cost is outflow. So net I will take 12,000 minus 4,000. That is 8,000. Here also 14,000 is inflow, 5,000 outflow. 14,000 minus 5,000. 9,000. Discounting factor they have given 0.917, 0.842. 0.917, 0.842. So let's calculate this. 8,000 into 7336. 9,000 into 0.842, 7578. Total 14,914. This is present value of inflows. Minus investment, that is cost of the plant, 10,000. So you get NPV 4914. Please check if the calculations are fine and let me know if you have any doubts. Just 1 second. Yes. Okay, hope it is fine. Let's calculate sensitivity. First, regarding cost of the plant, that is investment, cost of the plant. The formula you know, NPV by present value of that variable. So 4914 divided by present value of that variable, which is investment itself. 4914 into 100. I think 49.1 0.14%. Then recurring cost, numerator is NPV, denominator, can you think how to do? Denominator, can you think how to do? What we should do? Present value of recurring cost. You can write it in the denominator, you can write it here, present value. But every year cash flow is different. So I don't use annuity factor, I will use discounting factor. 4,000 is the cash flow multiplied by 0.917. 5,000 is the cash flow multiplied by 0.842 recurring cost. So 4,000, I'll just write it here in the column, the present value of recurring cost, so that I can make use of it here. 4,000 into 0.917, 3668, and 5,000 into 0.842, 4210, total 7878. That's what is present value, that I can take it here, 7878 into 100. Sixty-two point three seven six. Let's say 38. 62.38 percentage. Let's do savings also. Same process. Numerator is NPV. Denominator is present value of sales. Present value of sales. Savings. Present value of savings. So I'll have one column here. So easy to calculate. Present value of savings. If every year cash flow was same, I would have easily multiplied by annuity factor. Every year cash flow is not same, right? So I'm using this discounting factor technique. So 12,000 into 0.917. 11,004. 14,000 into 0.842. 11,788. So do the total. 22,792. So divide by 22,792 multiplied by 100. 21.56%. And now which one is more sensitive? The lower the number, higher the sensitivities. Therefore, most sensitive factor is savings. Most sensitive factors. Okay, done? Okay, very good. Let's read. XYZ Limited is considering a project for which the following estimates are available. Initial cost of the project, sales price per unit, cost per unit, sales volume, year 1, year 2, year 3. Discounting rate is 10% per annum. You require to measure the sensitivity of the project in relation to each of the following parameters. Selling price per unit, unit cost, sales volume, initial outlay, project lifetime. Taxation may be ignored. Okay, now you have to calculate the sensitivity. What is sensitivity? If the variable changes, NPV will change. So what is the proportion between those two? Is the sensitivity. So if sales changes, NPV change. If variable cost changes, NPV will change. Okay. The only problem is sales will be annual terms, but NPV will not be in annual terms. Now, sales will be in annual terms. NPV is in present value terms. Can you please tell me how do you convert sales into present value? Not only sales, any cash flow. How do we convert this into present value? Very simple, right? We have to multiply it by discounting factor. Or if every year cash flow is same, I can multiply it by annuity factor. If every year cash flow is same. So sales into discounting factor, let's say, like that year 1, year 2, year 3. If every year sales is same, I can multiply by annuity factor. I get present value of sales. Now sales in present value, then NPV is in present value. I'll have to take the proportion of that. That's all is sensitivity. For example, I'll tell you, suppose you want sensitivity of sales. Sensitivity of sales. You have to calculate that number. What will be the formula? It will be present value of sales. Sales number, you take the present value divided by NPV into 100 to express in percentage. That's all. Is the selling price a sensitivity? Sales sensitivity. So what is the interpretation? We'll come to it. First, let me calculate, then we'll come to that. Just 1 second. Okay. So now for sensitivity of sales, the formula is PV of sales by NPV, selling price. Now, I also have to compute the cost sensitivity. Now, can you tell me what would be the formula? Do you think the sensitivity of cost, sensitivity of unit cost, sensitivity of cost, variable cost? There is no fixed cost here. Okay. Sensitivity of the cost. What do you think is the formula? Numerator present value of cost, denominator NPV. Hope logic is simple. How do you calculate if it is anything initial investment or if it is anything they calculate? The formula is sensitivity of sales is like that is a PV of sales by NPV. So let's calculate the first one. We'll write the interpretation, then you'll understand the other aspects as well. Okay, so initial cash flow 10 lakh. Every year cash flow year 1, 2, 3. Don't write sales, don't write cash flow directly. I need sales present value separately, cost present value separately. Each component I require. Are you getting my point? Every component I need present value because I have to calculate sensitivity. If sensitivity was not required, each component is not required. Now, cash flow, how do you calculate? We have sales units, right? sales units multiplied by selling price. Selling price I have the given, selling price. So units into selling price, you get sales. Minus cost. So sales is one line, minus cost. Depreciation you ignore because no taxation means depreciation no impact. Sales minus cost. That's all. No other fixed cost, variable cost. Okay. That's what is actually cash flow you get. Sales minus cost. So, sales you calculate the present value separately. Cost you calculate the present value separately. I hope you are able to get my point. So, we have sales. Sales have they given? Okay. 20,000 units multiplied by selling price. 60 rupees. So 20,000 multiplied by 60 rupees, 30,000 multiplied by 60 rupees, 30,000 multiplied by 60 rupees. So 20,000 into 60, I'll show you the calculation. 20,000 units into 60. Then 30,000 into 60 and 13,000 into 60. That's what is sales. Write down till there. Write down till there. Okay, very good. Now, cost also. What is cost? How do you calculate? Units 20,000 multiplied by cost of 40 rupees. 20,000 into 40, 30,000 into 40, 30,000 into 40. So 20,000 units multiplied by 40. I'm calculating sales for each year. I'm calculating cost for each year. I get cash flow for each year. But I don't stop with that. For the sales also, I compute present value. For the cost also, we compute present value so that we will be able to calculate sensitivity. And the interpretation of sensitivity is more important. We'll come to it. You write down this cost. So 20,000 into 40. 20,000 units multiplied by cost 40. Then 30,000 units multiplied by 40. 30,000 units multiplied by 40. Okay. I'm also going to calculate contribution. In this case, the profit, in this case, cash flow. In this case, all are same. Why it is cash flow? Because no depreciation. In this case, why it is profit? Because no fixed cost. You know the formula, right? Sales minus variable cost is contribution minus, I'll show it to you in case you don't remember. Sales minus variable cost is a contribution minus fixed cost is profit or EBIT will say. This is earning before depreciation and tax. Then you know the format. Minus depreciation, you get profit before tax. Minus tax, you get profit after tax. You add back depreciation, you get cash flow. But in this problem, there is no depreciation, there is no fixed cost, no tax also. So contribution is only profit. The contribution is only cash flow, right? So 12 lakh minus 8 lakh, 18 lakh minus 12 lakh, 18 lakh minus 12 lakh. This itself is cash flow. This itself is profit. This itself is contribution. Then discounting factor 10% they have given. Then don't only calculate NPV. For NPV, cash flow is sufficient. Don't use only NPV. Use present value of sales, present value of cost, present value of contribution, present value of cash flow. Everything you calculate present value. PV of sales. How do you calculate PV of sales? Sales multiplied by discounting factor. 12 lakh into 0.9091. Please write it there. If you have any doubt, get it clarified first. Okay, got it? So 12 lakh into 0.9091, we get present value of sales. 18 lakh into 0.8264, we get 14 lakh 87,520. 18 lakh into 0.7513, you get 13 lakh 52,340, present value of sales. Similarly, calculate present value of cost. I'll give you 2 minutes. Cost, individual three numbers we have, multiplied by discounting factor. So 7 lakh 27 8280, 9 lakh 91 901, 26 25 20. Hope you are able to get it. Then contribution or profit or cash flow, that present value also we calculate. That is 4 lakh into 0.9091, 6 lakh into 0.8264, 6 lakh into 0.7513. That is present value of contribution, that is present value of profit, and that is present value of cash flow. All are equal. Then calculate NPV. Present value of inflows minus investment. Okay, write down till there first. Okay, now let's calculate NPV first. Present value of inflows minus investment. Now, present value of inflows is 30 lakh 260. That is what is present value of cash flows. Or you can also do sales minus cost. After all, that is what is profit. That is what is contribution. That is what is cash flow in this problem. So, PV of inflow minus investment. Investment 10 lakh. Outlay. Initial cash flow. Outflow 10 lakh. NPV you got. Then sensitivity of the sales price. What's the formula? Let me write down. Since the sale price is numerator present value of sales divided by NPV. To express in percentage multiplied by 100. So 3,10,260 is the NPV. 39,37,80 is the present value of sales. You write down. The interpretation is more important here. We'll write the interpretation for the first one. Others we not write. But first you write down till here, take 2 minutes, look at the calculation, let me know if you have any doubt. Don't hesitate to ask any doubt. Okay, hope you have done. Are you able to calculate this number? 7.89%. Present value of sales 39,37,80 divided by NPV 3,10,260. Sorry, reverse. Sorry, formula is opposite. Sorry, my mistake. Its formula is reverse. NPV divided by PV of sales. I think I told correctly in the previous slide, right? Okay, no, I don't remember. Anyway, this is I don't know whether I told you the formula correctly. So formula is NPV by PV of sales. Numerator is NPV. If I have given wrongly, please correct it. NPV is 3,10,260 divided by PV of sales. Numerator is NPV, denominator is PV of sales. Okay, please confirm. Are you able to calculate here? Any doubt on these calculations? Please confirm. You got this number 7.89. Okay, good. Right, the interpretation. This is more important from understanding point of view. Calculation is very simple. Numerator NPV, denominator a corresponding present value. Over. Formula is done. Interpretation important. Write down. Write down. Sensitivity of the sales price. Sensitivity of the sales price 7.89%. Sensitivity of the sales price 7.89% implies sensitivity of the sales price 7.89% implies if selling price drop dropped if the selling price is dropped by 7.89%, if the selling price is dropped by 7.89%, if the selling price is dropped by 7.89%, then then NPV will become 0. Then NPV will become 0. NPV will become 0. NPV will become 0. Did you get the seriousness of this number? This is the tolerance level. Sales can reduce by 7.89%. Selling price, if it is beyond 7.89, NPV becomes 0. The project is not financially viable. You are at risk. This is your tolerance level. This is your maximum. This is like your passing mark. No, your passing mark is 40. If it falls below, you are not going to pass the exam. The tolerance level, cutoff level. So, as a sales manager, marketing team, if you are a CFO, you have to put pressure on sales manager, marketing team. Make sure selling price does not fall below 7.89%. Do something. Somehow protect the sale price, not falling beyond 7.89%. Hope you got the interpretation. Okay, next. Unit cost sensitivity, same formula. NPV by unit cost. Numerator NPV, denominator respective cost. Are you getting the point? What is the sensitivity we are talking about? Till NPV becoming 0, no problem. Up to that level means how much percentage change is what we are trying to calculate. So NPV 3,10,260 divided by present value of cost, that is 2620 520. 11.84%. So if the cost increases by 11.84%, NPV will become 0. Now can you tell me, between the two, where you have little bit of safety? I mean, you can be little bit relaxed. In a selling price, you can relax little bit, or in a unit cost sensitivity, you can relax little bit. Among the two, where you have some flexibility, some time. Unit cost, you have some time. Are you getting 11.84 up to approximately 12%? You are not worried, but selling price 8% fall only, you are worried. So can I say, among the two, selling price is more sensitive, because only 7.84% will make NPV 0, but unit cost 11.84% should happen to make NPV 0. In other words, wherever the percentage is lowest, wherever the percentage is less, which makes NPV 0, that is sensitive. So whichever we calculate, lower percentage is more sensitive. We can also rank order for the priority purpose for the project manager to analyze. Anyway, sales volume sensitivity. For the sales volume, you divide by the contribution, this number. For the sales volume, the formula is NPV divided by present value of contribution. In this problem, cash flow also same, but in some other problem, contribution cash flow may be different. For sales volume sensitivity, the formula is NPV by present value of contribution. For sales, PV of sales. For variable cost, PV of variable cost. For sales volume, don't take sales volume. It will not be in rupees. To express in rupees means you do contribution. That is what is 13,10,260. Okay, what else they have asked? Initial outlay. Okay, initial outlay means divided by investment. Initial outlay means divided by initial outlay only. NPV divided by investment. NPV divided by investment. That is initial outlay. So NPV is 3,10,260. Investment, the 10 lakh. You divide. Okay. Last one they're asking. is project lifetime sensitivity. This is little bit complex, not such much complex, but uh, calculation is slightly different. So first you complete these 4 points. Let me know if you have any doubts. Then I'll explain the last part. Okay, let me cover the last parts. What is the third and fourth point interpretation? Same interpretation. If the sales volume reduced by 23.86 percentage, NPV becomes 0. If initial outlay cost increased by 31.03%, NPV becoming 0. All are same only. Ultimately, we are worried about which percentage will make NPV 0. That is our concern. Sales means we are worried about the fall. Cost means we are worried about the rise. The direction should be worried. But percentage change is a percentage change. Hope you got it. Volume here is for contribution. Yes. For sales volume sensitivity, we make use of contribution in the formula. Because I can't divide by volume. No, volume is not in rupees. So I make use of contribution. So for sales volume sensitivity, the formula is NPV by PV of contribution. But the interpretation is still sales volume only, number of units. If sales volume reduce, number of units reduce every year by 23.68 percentage, if sales volume reduced by 23.68%, NPV becomes 0. Hope you're clear on that aspect. Yes? Okay, very good. Now, last one, project lifetime sensitivity. There, we have to apply this concept little bit in a raw manner. Means what? We are worried about NPV becoming 0. Project lifetime, NPV becoming 0. That means we just recovered cost and the project is closed. If we just recovered our cost and the project is closed, so no profit, no loss, NPV becomes 0. Now, what is that concept? Can you tell me? Do you recollect the concept? When will you recover the investment? When will you recover the cost? In terms of years, not IRR, payback period. IRR, you are right. But IRR is for percentage cost of capital. I am talking about the lifetime, number of years, payback period. But one small change. Here I am taking a present value into consideration. So it is discounted payback period. So I'll do discounted payback period. Okay, first calculation here. First calculate time period in which NPV becoming 0, which means we will calculate discounted payback period. Year 1, 3,63,640. Cumulative cash flows. Cumulative discount cash flow. Year 2, 4,95,840. And year 3 is where I have recovered. How much I have to recover? Minus cumulative cash flow. 10 lakh minus 3,63,000 minus 4,95,000. So 1,40,000 I have to recover. In which year? In third year. And third year present value is 4,50,780. So which means it is 2.31 years. 2 plus 0.31. Remember the formula. It is going to be year plus investment minus cumulative cash flow, and here cumulative discounted cash flow divided by the cash flow for the year. Whatever discounted cash flow for the year. This formula, hope you remember it. So investment 10 lakh minus previous cumulative cash flow 3,63 and 4,95. I'm subtracting one by one, means cumulative. Then you divide by that year cash flow 4,57,80 and recovery in between second and third year. So 2.31 years. So if the project becomes 2.31 years, NPV is gone. NPV becomes 0. What is the present life? 3 years. It has to become 2.31. So what percentage fall? 2.31 minus 3 divided by 3 into 100. Some of you may not know this logic. I'll explain. You write down. I'll explain the logic. First you write down. Okay. Now, how did I calculate this number? I'll tell you. This is how we calculate percentage change, right? Suppose if 10 rupee become 8 rupee, how much it has fallen? 2 rupee. In percentage means 2 by 10, right? Into 100. It's like current price minus previous price by previous price. 8 rupee minus 10 rupee reduced by 2 rupee. Divide by 10 into 100. So reduced by 20%. That's how we calculate, right? Hope you're able to get it. So if 3 years become 2.31 years, 3 years of present project life. If it becomes 2.31, gone. NPV becomes 0. So how much percentage fall? 2.31 minus 3, current price minus previous price, divide by previous, divide by 3. That's what is 23%. Minus you ignore. That's plus minus, the direction only will be there. But the percentage change we are worried is 23%. So among the four, the most sensitive one is 7.89, the lesser one. So you can say selling price is the most sensitive variable compared to others because it's the lowest one. Only 7% change NPV is gone. You should be very careful. Most sensitive variable compared to others. Selling price is the lowest number, right? Only 7% compared to others. Okay, so I hope you got it. Very good. So ultimately, what is the summary we have to learn from this problem or from this concept, sensitivity analysis? Numerator is NPV, denominator is the present value of that variable, present value of sales, present value of variable cost, present value of fixed cost, present value of initial investment. Initial investment is anyway present value only. But only for discounted payback period, we can't do direct formula. We have to calculate discounted payback period, subtract from the current project life. That percentage change is the sensitivity. And what is the interpretation of the sensitivity? If the variable is moving by certain percentage, as we calculated, NPV becomes 0. This is like a cutoff point for us, tolerable point for us. If you cross this point, that means your project becomes negative. I hope logical point you're able to get it. Okay, so that's about this problem. Okay, hope you got this question. Okay, let's read. Just give me 1 minute. Okay, let's read. Unmat Limited is considering investing rupees 50 lakh in new machine. Expected life of the machine is 5 years and has no scrap value. It is expected that 2 lakh units will be produced and sold each year at a selling price of 30 per unit. So number of units 2 lakh. Selling price per unit 30 rupees. It is expected that the variable cost to be 16.5 per unit and fixed cost 10 lakh per year. The cost of capital of Unmat Limited is 12% and acceptable level of risk is 20%. I feel there is a voice lag coming. Are you feeling the same? Or is it fine for you? I mean, it looks fine now. It's clear, right? Okay, very good. Fine, then let's go further. You are required to measure the sensitivity of the project net present value to changes in the following project variables: sales price, sales volume, variable cost. Okay, so they are asking us to compute NPV and sensitivity with respect to specifically 3 variables. That's how that will happen in examination conditions also. Okay. On further investigation, it is found that there is a significant change that the expected sales volume of 2 lakh per year will not be achieved. The sales manager of Unmat Limited suggests the sales volume could depend on expected economic states which could be assigned in the following probabilities: state of economy, annual sales, probability. Calculate the expected net present value of the project and give your decision whether company should accept the project or not. So there is one part of the question which talks about sensitivity, and second part of the question is talking about the some uncertainty level where they are given some probability aspect also. Anyway, so we will address that. Fine. Just read the problem once more. Okay, so now hope you read the question once more. So first part is regarding the sensitivity. So what do we do first? Let's calculate NPV. And what do you mean by sensitivity? What percentage the variable should change so that NPV becomes 0? And what is the best method we have learnt? We are not going to assume it as X and we are not going to solve by that method. What is the direct method we are going to do? A simple formula. What is a simple formula? Numerator NPV, denominator present value of whichever variable we are doing. Sales price, present value of sales is divided. Variable cost, denominator present value of variable cost. Sales volume, we don't divide by present value of sales volume because volume is not in rupees. So remember, regarding volume, what is the formula? Numerator is NPV, denominator the present value of a respective variable. Now sales volume I cannot do. Instead, what is the relevant number? What is the relevant parameter for sales volume? We have discussed in the basics. We use contribution. We use contribution. Okay. So let us make use of those. First, let's calculate NPV. And while calculating NPV, what we are going to do, we will calculate the present value of individual elements. Like the way we did columnar, right? Of course, I can do direct NPV calculation also. Okay, I think let me use that method. Hope you have learned the technique which we applied. Let us do the direct method in this problem. So first, let's calculate NPV. Then we'll calculate the present value of respective variable. So first, let's calculate NPV. Okay, part A of the problem. There are two parts of the problem. Okay, so first we'll do sensitivity analysis. So first let's calculate. So here cash flow. Oh, cash flow directly not given now. They have given selling price. They have given number of units, and they have given fixed cost. Tax rate not given. Cost of capital is 12%. Accepted level of risk is 20%. Okay, that is accepted level of risk, but that you don't worry much. That level of 20% risk means to 20% change they will accept it. I'll tell you why it is comes. I'll tell later. First, let's calculate NPV. Okay, first let me calculate NPV. Cash flow directly not given, so let's calculate cash flow first. Let me calculate individually in detail. Sales value, sales selling price per unit is 30 per unit. Number of units 2 lakh. So 30 into 2 lakh. Think you get 60 lakh less variable cost. Hope PPT is not visible. Okay, now it's visible. Sales 30 into 2 lakh, 60 lakh. Variable cost is 16.5. So 16.5 into 2 lakh. $33 lakh. So you get contribution 27 lakh. Then let's subtract fixed cost. That is one flat amount, 10 lakh. So profit before tax 17 lakh. I think information about tax is not given, and we don't have information about the tax means okay. We have to subtract depreciation also. This is not profit before tax. Sorry, there is no depreciation also. But even if you consider depreciation does not matter, even if I subtract depreciation does not matter. Why? Because, okay, let me show it to you. Let me calculate and show it to you. So fixed cost 10 lakh less depreciation. Depreciation cost of the machine 50 lakh, no scrap value, life of the machine is 5 years. So 50 lakh divided by 5, you get 10 lakh. So what is the profit before tax? Subtract both of them. So you get 20 lakh. If you subtract, I think you get 7 lakh. In this problem, there is no tax. So less tax 0. So profit after tax is 7 lakh. Then to get the cash flow, I'll add depreciation 10 lakh. So you get cash flow after tax as 17 lakh. Okay. So now you see, even if I ignored the depreciation, it would not have had any impact because contribution 27 lakh minus a fixed cost 10 lakh, I would have got still 17 lakh only as the answer. Can you tell me why depreciation would not have mattered here? What do you think? Why depreciation would not have mattered in this problem? Because there is no tax. Depreciation is relevant in financial management only because of the tax impact. Otherwise, depreciation is only an accounting journal entry, that is only notional expense. It's not a cash flow. So because no tax rate, the depreciation has got no impact. So even if I ignore depreciation, that would not have mattered. So in some other problem when I'm doing, I don't even consider this. So I compute the cash flow directly. You remember how can we do this directly? Instead of calculating this vertical format, I can do it in one line also. How can I do it in one line? Selling price 30 rupees, variable cost 16.5. You multiply it by 2 lakh units minus a fixed cost of 10 lakh. You do in one line, you get the answer 17 lakh. Selling price minus variable cost multiplied by number of units, you get total contribution minus fixed cost, you got the profit, no tax impact, ignore depreciation. So one line you get the answer. Remember, in some other problem I would have done like this, in one line only. Here also you can follow that format. But in this problem, I just want to do it slightly differently. And I want to do it in a regular format, a regular columnar, what we used to do in a vertical income statement format. I have followed here. Hope you got it. Okay. Next. So cash flow we have calculated. Let's calculate NPV first. Calculation of NPV. So you know the format: year, cash flow, discounting factor, discounted cash flow. Discounting factor at the rate of cost of capital is a discounting factor for us. Cost of capital is 12%. So year 1 2, how many years are there? Life of the machine is 5 years. So year 1 to 5, cash flow we calculated 17 lakh. Discounting factor, since every year cash flow is same, I can use annuity factor. At 12% for 5 years. They have not given. So let's calculate. Four point 4643. No, not 4.4643. 1 divided by 1.12 press equal to 5 times. 3.6048. Okay. 3.6048. 3.6048. So if you multiply, (61 lakh 28,160). This is present value of inflows. So what I get now is present value of inflows. (61,28,160) less initial investment, cost of the machine 50 lakh, no other cost. So you get NPV as 11,28,160. So NPV 11,28,160. Is the screen fine? Okay. Fine. So NPV we got it. Sensitivity analysis, I'll do it here itself. That is, I'll make use of these numbers only. So I'll just draw one line and I'll use this space only. Okay. So sensitivity calculation. They've asked for 3 calculations. First one they want is sensitivity of sales price. Sensitivity of sales price. So what formula we do? NPV divided by present value of sales. NPV we calculated. I just have to divide by present value of sales, then multiplied by 100. So NPV is 11,28,160 divided by present value of sales. How do we calculate the present value of sales? We have a sales value as 60 lakh. But this number I have to multiply it by annuity factor. So into 3.6048 multiplied by 100. And in calculator, you don't have to write that number and then divide separately. You can do directly in the calculator. How you can do? 11,28,160 into 100 you can do. Divided by 60 lakh, divided by 3.6048. Denominator, two factors are there. No, both of them you divide one after the another. You get the answer directly. You don't have to multiply 60 lakh into 3.6048, write that number, then do 11 lakh 28 by that. No need to do that. So what do you get in the calculator? 11 lakh 28 160 into 100 divide by 60 lakh divide by 3.6048. 5.216%. Let's say 5.22%. 5.22%. So selling price sensitivity 5.22%. Then they asked uh, volume. So volume sensitivity, sale volume sensitivity. Formula is NPV divided by present value of, not volume, present value of contribution. Relevant for this volume sensitivity is contribution. So NPV is eleven lakh 28 160 divided by present value of contribution. Contribution we have 27 lakh multiplied by annuity factor. So the present value is obtained 3.6048. So 11 lakh 28 160 by 27 lakh into 100 by 3.6048. 11.59%. 11.59%. Then we have asked variable cost sensitivity. Variable cost sensitivity. Same format. NPV divided by present value of variable cost. NPV is 11 lakh 28 160 into 100 divided by present value of variable cost. So variable cost is 33 lakh into present value means annuity factor 3.6048. You can do directly in the calculator. 11 lakh 28 160 into 100 divided by 33 lakh divided by 3.6048. 9.48%. So we got three sensitivity factors what they asked for. So if among these three, which one is most sensitive, if you have to comment, it would be selling price, right? Because lower the number, higher the sensitivity. So you have to take care of the selling price the most. So please make sure you have written down till here. Okay, hope you got it. And one more point I would like to address here. They said accepted level of risk is 20%. So what do you mean by that accepted level of risk is 20%? So for any factor, if it goes beyond 20%, they don't want to do it, or they can only change 20% uncertainty. If the cash flow change Beyond 20%, they don't want to accept the project. But we don't have that information in this case. So this 20% uncertainty level is not really relevant in this problem, because this 20% means if cash flow changes beyond 20%, if your sales change beyond 20%, sales goes below 20%, they don't want to accept the project. But we don't know how much it is changing. See, for example, we have calculated in this problem as a sales 60 lakh. I mean, cash flow 17 lakh. How much cash flow will change by? We don't know. They are not telling in the project the cash flow likely to be changed by 30%. It can go below 30%. No information of that sort. So in this problem, accepted level of risk is 20%. That point you ignore it. That is not relevant for the problem. Even in some other problem also, this point you can ignore. That is not required. Okay, hope you understood how to calculate the sensitivity of these three variables which is asked in the problem. Okay, fine. So hope you got it. I'll go for second part of the question. On further investigation, it is found that there is a significant chance expected sales volume 2 lakh per year will not be achieved. So they are having some issue. They feel 2 lakh units will not be able to achieve. Then what they will achieve? Oh, they can achieve either 1 lakh 75,000, or they can achieve 2 lakh, or they can achieve 2 lakh 25,000 with the respective probabilities depending on state of the economy. What do you mean by this? You are expecting 2 lakh, but I think 2 lakh will not happen. Why, sir? It depends on the economy level. What economy level? If the economy is doing well, if world economy is doing great, Indian government is doing well, everybody is prospering, we will be able to make 2 lakh 25,000 sales. If economy is normal, nothing above, nothing below, then we will be able to make only 2 lakh units. What you're expecting. But if the economy level is poor, see for example, because of corona effect, the economy is down, like that for other reasons also, economy may be down. So if economy is down for some reasons or the another, if economy state is poor, we will be able to make only 1,75,000 units. And what are their chances? Probabilities are also given. So in this case, we have to calculate expected net present value. So here we have two methods to calculate. One is long method, one is short method. I will tell you both the methods, but I'll use short method to get the answer quickly. What is long method? Now we have calculated for 2 lakh units. When number of units is 2 lakh, we got 1 NPV. We already got it. Similarly, I'll substitute 1 lakh with 1 lakh 70, substitute 2 lakh with 1 lakh 75,000 units in the calculation. I get one more NPV now. I get revised NPV now. Similarly, I substitute that number of units with 2 lakh 25,000. I get one more NPV now. So basically, for assumption 1, volume 1,75,000, assumption 2, volume 2 lakh, assumption 3, volume 2 lakh 25,000. For 3 assumptions, I get 3 NPV. So I get NPV under first assumption, NPV under second assumption, NPV under third assumption. Then we have the probability. Do you know in statistics You would have learned perhaps in probability something called as mathematical value of expectation. How do you calculate mathematical value of expectation? X multiplied by probability. That is nothing but an average. Same thing we apply. We have NPV. This is like X. We have probability, which is P. Then we do X into P. So NPV into probability, X into P. I get one product column. The total is called as expected value, E of X. That's what is called as expected NPV. That is one method of calculating. Second method is there, which is even more faster method. What is that? You do that shortcut method. You do apply that expected value for number of units only. Number of units, you multiply it by probability, x into p of x, you get expected sales volume. Based on expected sales volume, you compute NPV. That itself is expected NPV. So you have two methods to arrive. Both answer will give us the same answer. I will choose the easier one. I don't want to go to NPV, the longest route method. The units they have given, using the units only, I am going to calculate the expected volume. Based on expected volume, I calculate NPV. That becomes expected NPV. Hope you understood both the methods. I'll do the shorter method, but if you want me to prove, I'll do both the methods. What would you prefer? Both the methods? Okay. Always keep it in mind. Time is limited. I will do both the methods, this problem. But that time we will consume. So some other problem we will not be able to solve it. Anyway, that is your choice. I'll do both the methods. But remember, law of science, whatever you call it, when we have only limited time. So when I use this problem, both the methods, some other problem I'll not be able to solve, which might be a different variety. Anyway, you want both the methods? I'll do both the methods. Okay. So part 2. Okay. Calculation of expected NPV. Long procedure you will do. You give us the steps. I just told you the steps, right? What I just explained so far. Using one volume, you compute NPV. Using one more volume, you compute one more NPV. Using one more volume, you compute one more NPV. Okay, there is one more method. I'll do that also for you. Just give me 1 second. We will do it. Okay. Fine. So let's calculate expected NPV. Okay. So first method, method 1, using NPV under different scenarios. Okay, I'll be calculating NPV directly here. I hope you'll be able to understand. Like, how do we calculate NPV? I'll write the formula for you, like the way I told you earlier, we have discussed earlier, but I hope you understand. Selling price minus variable cost gives me contribution per unit multiplied by number of units. It will give me total contribution minus fixed cost will give me profit. There is no tax, so this itself is cash flow. Then you multiply it by annuity factor and subtract initial investment. Initial investment. Hope you understand this part. This is, don't think like a formula kind of this, think like a logical aspect. Instead of calculating in a vertical format, because that is time consuming, I'm writing it in a horizontal format. So it is easier and quicker to calculate. Hope you understand this step. We have done it also earlier, this kind of discussion. No tax. So tax I'm not subtracting. No tax means depreciation I'm ignoring. That's why I'm able to calculate directly. So I'm calculating under 3 scenarios. So what is that scenario they have given? Economy state of economy. State of economy. And depending on the state of economy, we were computing NPV. Then we multiplied by probability. Then we get the product like P into X. Like that. Okay. So economy state when it is poor. So how do we calculate NPV? Selling price per unit is 30 rupees. Variable cost 16.5 multiplied by, how many units will I multiply? I don't multiply it by 2 lakh units. This is a situation where economy state is poor. So I multiplied by 1,75,000 units, less number of units, 1,25,000 units, minus a fixed cost, that is flat. Fixed cost is 10 lakh. Then you multiply it by and subtract investment. Annuity factor is we already calculated now previously 3.6048. 3.6048 minus investment 50 lakh. So what is that NPV we get? Let us fill up this problem first. This NPV calculation. So 30 minus 16.5 into 1,75,000 minus 10 lakh into 3.6048 minus 50 lakh. I think you get negative NPV. 88,000. $460, right? 88,460 minus 88,460. Okay. Similarly, when the economy state is normal, you will have 2 lakh units. So same format I'll use. Instead of 1,75,000, I'll do 2 lakh. So 30 minus 16.5 into 2 lakh minus 10 lakh multiplied by 3.6048 minus 50 lakh. That gives me 11,28,160. which is what we already calculated in the first part of the problem. I'm making use of that directly. I don't have to calculate this. I did as a process, but this is what the 2 lakh units was there in the first part of the problem. So same number I can make use of it here. Then when it is good condition, I can do 2,25,000 units. So 30 minus 16.5 into 2,25,000 units minus 10 lakh into 3.6048 minus 50 lakh. Twenty-three lakh 44,780. Okay, so we have got this. These are the things we require. Then we got NPV. NPV is like X now. Then I will have two columns, one for probability, then one for product. Probability they only have given. Let's make use of that probability. Uh, 0.3, 0.6, 0.1, 0.3, 0.6, 0.1. Okay, then you multiply, you get the product like X into P. Hope you understand. NPV is like X, probability is P, X into P, we get the mathematical value of expectation products. So minus 88,460 into 0.3. Twenty-six 538 minus 26 538. 11 lakh 28 160 into 0.6, 6 lakh 76 896, 23 44 780 into 0.1, 2 lakh 34 478. Total 884 836. Hope you are getting that number. 884 836. So this expected value, mathematical value of expectation is called as expected NPV. This is a long method. Expected NPV. Okay, so this is method 1. Now let me do method 2. Method 2, what I do, I'll compute cash flow under different scenarios. I don't compute NPV under each scenario. I'll compute cash flow under different scenarios. What I'm going to do, same process I do, state of economy, I don't calculate NPV, I calculate cash flow. I multiply it by probability. Then what do I get? I get expected cash flow. I'll show you that methods. Okay, so we calculate NPV, multiply probability, we got the product. So we calculated expected NPV. Same process I'm going to do for cash flow. Same state of the economy, but my column will not be NPV calculation. Instead, my column will be calculation of cash flow. Under three scenarios. How do I calculate? When it is poor, what is my cash flow? uh, I will not multiply vanity factor. I will not subtract initial investment. That is NPV. So how do you calculate cash flow? Cash flow is selling a price 30 minus a variable cost 16.5 into number of units 1,75,000 minus 10 lakh. That's all I'll do. I don't multiply vanity factor. I don't subtract relation investment. Because if I do vanity factor, I get present value. I don't want that. I just want annual cash flow. Selling price minus variable cost gives you contribution per unit. Multiplied by number of units, we get the total contribution. Subtract fixed cost, we get profit before tax. No tax, so I don't have to subtract tax. And no tax, so no impact of depreciation. So directly this only will give me the cash flow. So what is that cash flow I'm getting in this situation? $13,62,500. Maybe I can write in the same line. Yes, I think space will permit me. 13,62,500. Okay. Then when economy level is normal, 30 minus 16.5, I don't multiply it by 1,75,000 units. I'll multiply it by 2 lakh units minus 10 lakh. $17 lakh. And 17 lakh is what we have calculated in first part of the problem. Because in first part of the problem, also number of units was 2 lakh. So there only we had got. So same number I could have used. And there also this shortcut I could have used. Anyway, and then good condition, 30 minus 16.5 into 2 lakh minus 10 lakh. Not 2 lakh, 2 lakh 25,000. So 20 lakh 37,500. Okay, so 20 lakh 37,500. Now this is our cash flow. Now we need expected cash flow. How do we calculate expected cash flow? Same concept of statistics, mathematical value of expectation. The cash flow what we got, I multiplied by probability. Then I get the products. So what probability? Same probability I'll use, which is 0.3, 0.6, 0.1, and you can do the products. That product only will give you the expected sales. So 13,62,500 into 0.3, 408,750. 17 lakh into 0.6, 10 lakh 20,000, 20 lakh 37,500 into 0.1, 203,750. Total 16 lakh 32,500. Okay, so this is our expected cash flow, because cash flow we multiply probability, we get expected cash flow. Hope you're getting that. 16 lakh 32,500. Okay, now using the cash flow we compute NPV. How do we calculate? Cash flow multiplied by annuity factor, subtract investments. That's all is NPV, correct? So let's calculate expected NPV based on expected cash flow. Expected NPV based on cash flow, very simple. Cash flow, annual cash flow, what we got now, into annuity factor, subtract initial investment. That's all. Present value of inflows minus investment. So 16 lakh 32,500 multiplied by 3.6048 annuity factor minus investment 50 lakh. Or you can do the format year cash flow. You can do follow that format also. I'm writing it in one line. I hope you can understand. So what is that NPV comes to? Are you getting same answer? 8,84,836. Which is what we got earlier also. Hope you understand the last line. NPV calculation, present value of inflows minus investment. Cash flow is 16,32,500 multiplied by annuity factor, we get the present value, subtract investment, we get the NPV. Okay, this is method 2. Now let me do method 3. In the exam, whichever method you are comfortable, you can follow it. These are just mathematics. Any method you can follow it. Method 3, you get the data answer using expected volume. Using expected volume. So same format I'm going to follow. So I'll calculate the expected volume first. So state of economy. Just adjust the size little bit. So that I can fit into this page. Okay, so now state of economy, poor, normal, good. Volume, directly they have given. Sales volume. Poor means 1,75,000 units. Normal means 2 lakh units. Good means 2,25,000 units. I multiplied by probability. I get the product. So we get the expected amounts. So multiply probability and you get the product. So calculate the products. So 1,75,000 into 0.3, 52,500 units. 2 lakh into 0.6, 1,20,000. 2,25,000 into 0.1, 2,200. So now if I add all, I get expected volume. 52,500 plus 1,20,000 plus 22,500, 1,95,000. So my expected sales volume is 1,95,000. This is expected volume. Expected volume. Now using this volume, I'll compute NPV. I'll calculate in one line only, like the way I've done at the beginning. I'll use that only. Like NPV, I'll calculate by using this volume. I'll do like the way first method I followed. Selling price 30 minus 16.5 into number of units. This new number of units I'll use, which is 1,95,000 minus minus fixed cost 10 lakh multiplied by RT factor 3.6048 minus investment 50 lakh. Same formula I've used in the first part of the problem. I get? See, are you getting same answer? Expected NPV. 30 minus 16.5 into 1,95,000 minus 10 lakh into 3.6048 minus 50 lakh. 8 lakh 84, 836. Okay, so this is what is the diff3 methods. You can use any one method. My opinion, last method is the quickest one because volume is there, multiple probability, we get the product, use one line, you get NPV. So third method is faster in my opinion. You can use any method which is comfortable to you. Okay, I'll go further. Okay, Let me go further. Okay, next. Okay, uh, hope you got the question. Let us read. XYZ Limited is considering a project with the initial outlay of rupees 14 lakh. Initial outlay means investment. And the possible three cash inflow attached with the project as follows: year 1, year 2, year 3, and the probability, worst case, most likely, and the best case. Assuming cost of capital as 9%, required, calculate best case NPV, worst case NPV, and also most likely NPV should the project be accepted. So what is this chapter is all about? It's about making decisions, investment decisions, capital budgeting, but incorporating the concept of interest, concept of risk. And one of them is this one, which is scenario analysis. What is the scenario analysis? It's all about making decisions about the future. If economy is doing well, India have political stability, economy is going, India is in a boom run, right? From 2000 to 2006, 7, 8 years, India have seen a bull market. Stock market is up, economy was doing well, business was doing well. If that is repeated, every business will flourish again. Or from 2008 to 2011 we are almost in a bear market means it's not so well. Indian petrol price were increasing, jobs were not there, at least jobs were not very frequent, business was not flourishing. Your business also likely to be affected. And after that we are in a stagnation stage, not too much of growth, not much of depression, we are in a constant at a same level. Correct? Same thing will be repeated. Business is a cycle. We can't always expect it will be good or bad. It will always happens in a circular basis. It moves in cycle, business cycle. So if you're expecting next few years will be worst case, everything bad, bad, bad. You see, in this case, we are having cash flow. Year 1 is also less, cash flow year 2 also less, cash flow year 3 also less. You get cash flow, but less cash flow you get. So what will happen to the NPV if that situation happens? Similarly, if it is best case, what will happen to your NPV? If it is most likely, what will happen to your NPV? Applicable to your life also. If the question paper is difficult, how much marks you can get? If question paper is average, how much marks you can get? If question paper is very, very easy, how much marks you can get? Under different scenarios. And always remember, you are mostly influenced by economy. See, one small joke is there. You also might have heard of. One day there will be examination result, and the child comes home. Father asks, "What happened to examination result? How much you got?" The child tells the doctor's son, "No, he failed." Then again, father asks, "What happened to your result?" Engineer's son, "No, he also failed." Again, the father asks, "What happened to your result?" The child says, "IAS person's son, no, he also failed." Then the father has lost his temper. "Tell me what happened to your result." The child says, Are you Einstein or what? Your son also failed. Correct. No, you'll say that basically you're telling question paper is difficult, all out of syllabus questions, nobody passed, I also not passed. Same thing applicable in business also. If economy is not doing well, corona effect, lockdown happened, all business will close. Whether it is restaurant business or it is, you can say software business, people will do work from home. Okay, software business will do work from home. Software needs clients, right? That business also needs clients. For example, they are going to prepare software for banking business. If the banks are not recovering loan, all NPA happening, bank will not have money to pay to the software people. So it's a chain events. Anyway, I hope you got the point. Under different scenarios, the cash flow will be different. Accordingly, our NPV also will be different. So we estimate under different scenario what will happen to our NPV. Then we assign a probability based on past experience and we compute the average. That average is called as expected NPV. If that average is positive, we say the project can be accepted. Okay, so let's calculate one by one. Worst case NPV. Okay, now if it is worst case NPV, what will happen? Year 1 cash flow will be 4 lakh 50, year 2 cash flow will be 4 lakh, year 3 cash flow will be 7 lakh. And then we have cost of capital, discounting factor. I can calculate discounting factor. I have cash flows. I multiply cash flow discounting factor. We get present value. Then subtract investment, initial outlay. So present value of inflows we get. Subtract investment. That's what you get NPV in scenario worst case. Let's calculate. See what are the cash flows? 4 lakh 50, 4 lakh, 7 lakh. So take those numbers. 4 lakh 50, 4 lakh, 7 lakhs. Multiplied by discounting factor, cost of capital they have given 9%. So 1 by 1.09. You compute for year 1, year 2, year 3. Multiply. You will get the present value of inflows. Subtract investment 14 lakh. Outflow. So subtract. Then you get NPV. Sir, NPV negative. A project should not be accepted. A project should be rejected. Don't jump into conclusion. This is under worst case scenario. Okay, this is what happens if everything goes wrong. Our NP will be so much. But we should look at other scenarios also. Then we combine and we take an average. Anyway, so write down this scenario. In case of worst case scenario, our NPV will be so much. Write down. Okay. Next. This is in case of worst case NPV. So we took the lowest cash flows, worst case cash flows. Then most likely NPV. What is the most likely NPV? We will take these cash flows: 5,50,000, 4,50,000, 8 lakh. We will take those cash flows and multiplied by discounting factor. We get present value. So cash flow will be 5 lakh 50, 4 lakh 50, 8 lakh multiplied by discounting factor. You get the present value. Subtract investment 14 lakh. That is same for all the three scenarios. You get NPV. So I have calculated worst case NPV. You understood the method. I've shown you most likely NPV. Took those three cash flows, and you try for best case NPV. You take the highest cash flow multiplied by discounting factor. Get the present value. Subtract investment. You get NPV. You please try for best case NPV. Okay. How much you got? So if you have done, please compare. Third NPV, best case NPV would be 3,12,140. Please check your numbers. Okay, fine. Now, we got how many NPVs? We got 3 NPV under 3 scenarios. Now, can we say that in the first scenario, NPV negative, reject the project, next scenario, NPV positive, accept the project? No. These are all different NPV for a single project under different situations. So, we need to combine them. How do we combine them? Using probability. So, worst case NPV, most likely NPV, best case NPV. Worst case NPV we computed 1,09,950. Most likely NPV we computed 101,095. And best case NPV we also we computed 3,12,140. Now we multiplied by probability. Probability they have given 0.3, 0.5, 0.2 and total probability should be 1. So 1,09,950 into 0.3, 101,095 into 0.5, that is 50,547. 3,12,140 into 0.2, that is 62,428. So when I do the total, that is what is called as expected NPV, nothing but average. Average, expected NPV. This is positive 0. On an average, you are fine. Your average is positive, therefore the project is to be accepted. Please calculate that. Okay, I hope you have done till there. Let's move forward. We can also do it in one more manner. I have not told you. We can also do it in one more manner. How? By computing cash flow method. We computed 3 NPVs and that's what they asked in the problem also we did. But if they ask you just compute expected NPV, I can compute year 1 cash flow, year 2 cash flow, year 3 cash flow using expected cash flow method. How? Let me just show you that quickly, just for understanding purpose. You see, year 1, what is expected cash flow? 4,50,000 into 0.3, like X column, P column, X into P column, 5,50,000 into 0.5 and 6,50,000 into 0.2 and do the total. That will give you expected cash flow for year 1. Similarly, you can calculate expected cash flow for year 2 and expected cash flow for year 3. And that you do then present value using discounting factor, subtract investments, you get NPV. You get the same answer. But what's the problem with that approach? You will not get NPV under 3 different scenarios. So if they have not asked best case NPV, worst case NPV, you could have done that also directly. Anyway, hope you got the point. Let's go further. Find the probable NPV. Find the probable NPV from the information given below for a project with life of 5 years. Annual cash flow 50,000, 2,25,000, 4 lakh. Probability 0.1, 0.7, 0.2. Initial investment 7,50,000, discounting rate 12%. Find the probable NPV means expected NPV. Probable NPV means expected NPV. Now, here we have cash flow. So what I can do? I can calculate if the cash flow is 50,000, annual cash flow 50,000, what is the NPV? If annual cash flow 2,25,000, what is the NPV? If annual cash flow 4 lakh, what is the NPV? Then I get 3 NPVs, I apply probability, I can calculate average. That is one method. Or what I can do, I can calculate expected cash flow method. So in this problem, I'll do both the method for you. Okay, I'll do both the method for you in this problem. Just give me 1 minute. I'll do it together. Will in this problem I'll do both the methods using the cash flow method and as well as using the NPV method. Okay. Now I will do using the NPV method, expect NPV method. That is what NPV under first scenario, second scenario, third scenario. For different cash flows, NPV will be different. Let's calculate NPV and scenario if it is 1, 2, 3, I just write. And how do you calculate the formula? Present value of inflows minus investment. So if cash flow is 50,000, annual cash flow, so I can multiply the annuity factor. So what is the rate they have given? 12%, and this is for 5 years, 5-year project. So 1 by 1.12 and press equal to 5 times and then press GT. That will get you the annuity factor. That is what is 3.6048. You get for year 2 also. I mean, not year 2. This is scenario 2, not year 2, scenario 2. 2,25,000 into annuity factor, you get present value of inflows minus investment. Same thing applicable for the last year. 4 lakh in last situation. 4 lakh into annuity factor minus investment 7,50,000. So we get NPV under first scenario, second scenario, third scenario. But how do we mix all of them? We multiply it by probability. Probability they are given 0.1, 0.7, 0.2. So multiply 0.1 into 5,69,000. Negative number, 56,976. 0.7 into 6,180. 0.2 into 6,91,920. You get expected NPV, probable NPV. And this is more than 0, so project is accepted. So expected NPV, or you can say probable NPV, is more than 0. So project is accepted. We can do by one more method that also I'll show it to you. Before that, you write it down slowly, understand correctly. Any doubt, please let me know. right? Hope you got it. Fine. What is the other approach? We have cash flow, right? We had a 50,000 in one method, or 2,25,000 another scenario, 4 lakh another scenario. That cash flow is there. No, that you mix all the cash flows. You take average cash flow, expected cash flow, and using that you calculate NPV. That becomes expected NPV. That is second approach. Let me explain. Then I'll give time to copy it down. Under three scenarios, we got 50,000, 2,25,000, 4 lakh, three cash flows. That you multiplied by probability. 50,000 into zero point 0.1, 2,25,000 into zero point 0.7, 4 lakh into zero point 0.2. We get the 50,000, 5,000, 1 lakh 57,500, 80,000 total, 2 lakh 42,500. You see, this approach is there, no? Expected value approach. You can apply it on any parameter. You apply it on marks with probability, you get expected marks. You apply it on salary with probability, you get expected salary. You apply it on units sold with probability, you get expected units. You get expected cash flow, you get expected NPV. Format is same, structure is same. So we have three cash flows under three different scenarios. We have mixed it into one. Now one cash flow is there, multiplied by RT factor, we get present value of inflows, subtract investments. So present value of inflows, this is what we got expected cash flow, multiplied by annuity factor, 3.6048. You get present value of inflows minus investment, 7,50,000. You get exactly the same answer, 1,24,164. So in the exam, you can use either of the method to present your answers. So write down. Let me know if you have any doubt. What you want to see? Question. Okay. This is the question. Yeah. Okay. Hope all of you got it. I'll go further. Okay. So the next concept is about incorporation of risk as standard deviation. You know, standard deviation basically means how much you are differing from average. So if deviation is less, you are close to average, less risk. If deviation is high, variation is high. If variation is high, that is basically high risk. So using standard deviation, we can identify whether project is a less risk or more risk. We also have coefficient of variation where we can adjust the return for risk. Average return by standard deviation, x bar by mean in 200. Anyway, let's first understand compute standard deviation of the cash flow. So this problem is just to understand about calculation of standard deviation. Annual cash inflow along with respective probabilities. So X value, anyway, 20,000, 30,000, 40,000. Anyway, it is in thousands, right? So for the time being, I can ignore, I'll make everything rupees in thousands. So X value 20, 30, 40. Okay, let me write along with you. You also write down along with me. X value, this is rupees in thousands. So I can save some time. Otherwise, I would repeat every time 20,000, 30,000, 40,000 will take more time. So this is 20, 30, 40 along with respective probability 0.1, 0.1, 0.7, 0.2. What is the formula for standard deviation? This is the symbol standard deviation of x. I have already shared with you. Summation x minus x bar the whole square. And if number of observations there, I'll divide by n. But probability is there means I'll multiply it by p. If I do only this, I get variance. I'm going to do square root of this. So what are the columns I require? First I should do x into p. That will give me x bar. Then I am going to do x minus x bar whole square. And the last column x minus x bar whole square multiplied by p. So this will give me the variance. I take a square root. I'll get standard deviation. Write down till there. Okay, now let's multiply 20 into 0.1, that is 2, 30 into 0.7, 21, 40 into 0.2, that is 8. Do the total, that is what is x bar. I think you get 10 and 31. Yeah, you get 31. Then x minus x bar whole square. You can do one column x minus x bar, then you can do whole square also. So x minus x bar, x is 20, x bar is 31. So 20 minus 31 whole square means 11. 11 square is 121. Then 30, 30 minus 31 whole square. You can have one separate column x minus x bar also for safety purpose. So this is 1. Then 40 minus 31 whole square. So 9 square, you get 81. 121, 181. Multiplied by probability, that is 121 multiplied by 0.1, you get 12.1. 1 multiplied by 0.7, you get 0.7. 81 multiplied by 0.2, 16.2. You get 16.2 and do the total. 12.1, 0.7, 16.2, that is 29. And this is nothing but sum of these things. Summation x minus x bar whole square multiplied by p is 29. That column total. And we need standard deviation means square root of this. So square root of 29, that is what is standard deviation. 5.385. Again, remember this is rupees in thousands. Rupees thousands. Just remember this is rupees in thousands. So this is the standard deviation. Directly I can't comment whether it is high or less. If I compare with some other project, if that is having let's say standard deviation of 6, that means the other project is more riskier. Higher the standard deviation, higher the risk. Lower the standard deviation, lower the risk. Okay, hope you got it. I'll go further. This is a basic problem just to understand the formula. Full-fledged problem we'll do subsequently. Okay, good. Okay, so next one. This is the next one. XY Limited has under its consideration a project with a initial investment of 1 lakh. 3 probable cash flow scenarios with their probabilities of occurrence have been estimated as below. Annual cash flow probability. The project life is 5 years and the desired rate of return is 20%, means required rate of return, that is the cost of capital discounting rate. The estimated terminal value for the projects under the 3 probability alternatives respectively are 0, 20,000 and 30,000. You are required to find probable NPV. Find the worst case NPV and the best case NPV. State the probability occurrence of the worst case. So we have to calculate probable NPV, which means expected NPV, and we should also recalculate the worst case or best case, and we'll calculate in between also, and state the probability of occurrence of the worst case. Okay, this also you can do under two methods, but anyway, let me solve it in the regular manner. So if it is worst, let's start with the worst case NPV. Worst case NPV. Worst case NPV means your cash flow should be worst cash flow. Now, can you tell me? In this case, cash flow should be worst cash flow. How much annual cash flow you take? In these cases, what we have? You will be taking the lowest cash flow, which means you take 20,000. This is annual cash flow. Not only you have annual cash flow, you'll also have terminal cash flow. You remember initial, interim, terminal, and terminal cash flow will be 0. For annual cash flow, we should bring it to present value. We multiplied by annuity factor. Terminal cash flow, we should bring it to present value. This is not every year cash flow. Terminal cash flow comes only once. At the end of the project, we multiplied by discounting factor. So 20,000 annual cash flow, 0 terminal cash flow, use the discounting rate 20%, project life 5 years, investment same, that will not change, 1 lakh. So present value of inflows minus investment, you get NPV. So worst case, year 1 to 5, discounting factor 20, cash flow 20,000, discounting factor at the rate of 20%. So how do you calculate 20%? 1 by 1.20 press equal to 5 times GT, you get discounting factor. 20,000 annual cash flow into annuity factor, you get DCF, you get present value, and cash flow 0. Then last, anyway, 0 multiplied by any number is 0 only, but as a formality you write down. And how do you calculate discounting factor? 1 by 1.2 press equal to 5 times, don't do GT. The last number what you get, that is last year discounting factor, multiply, do the total, you get present value of inflows. Subtract investment, you get NPV. This is worst case NPV. You write down, and can you try other two scenarios? Please try. Yes. Uh, yes, it is available. Whichever the question number we have done previously, this is the next question. So I have done the worst case NPV. You write down, copy it down, any doubts get clarified, and then you try for the next two situations, most likely NPV and best case NPV. Then we'll mix all of them. Do the questions are covered from ICI material? Please share the question. I've already shared the material on day 1 itself. I have shared my material already on the day 1. I think all of you have got it. So, okay. So, fine. So, possible NPV, worst case NPV, we got it. Then next situation, best case NPV, by taking the highest cash flow, highest terminal value, we get 31,681. Then most likely NPV, middle number we got, middle cash flow and middle terminal value, we get NPV as minus 2244. Please compare. You should get 3 NPVs based on 3 scenarios. Check it out. Okay, fine. Now we have got 3 NPVs. This NPV is going to be multiplied, and I mean this is going to be combined, and we get single NPV. How do we apply? By using probability. So we got the 3 NPVs, minus 40,188, 31,681, and minus 2244. We have got 3 NPVs multiplied by the probability 0 0.1, 0 0.2, 0 0.7, multiply and do the total. This will get you expected NPV, or you can say probable NPV. In this case, positive. Therefore, project is accepted. Write down. Okay, now this is expected value more than 0, probable NPV, project is accepted. What else question they have asked? Find the probable NPV, we have done. Find the worst case NPV and the best case NPV and the probability of their occurrences. That we already calculated. Worst case NPV, lowest NPV 40,188. And what is its probability? 0.1. The probability, corresponding probability. They only have given the problem and they're asking again. And the best case NPV, this is the best case NPV 31,681 and its probability 0.2. So probability of occurrence is 0.2 or 20%. So that is the answer for second part of the answer and the third part, second part of the question and third part of the question. So please write down. Let me know if you have any doubts. Okay, so I hope you have got this one as well. Let's go further. Let us take this problem. This problem. Hope you got this one question. Consider the data below to a project with a cost of 5,000. Year 1, probability net cash flow, year 1, year 2, year 3. Find the expected cash flow in each year. Find the expected NPV, assume risk-free rate of 7%. Also compute standard deviation for the project. In the problem, in your material, if this sentence may not be there, if it is there, good. If not, please add this question in your material. Also compute standard deviation of the project. You can add this one. Fine. Hope you got it one. Hope you got this one. Let's compute first the expected NPV and then we go for the standard deviation. What is the formula of NPV? Present value of inflows minus investment. Investment we know it is 5,000. Now we need a present value of inflows. For that I need year 1 cash flow, I need year 2 cash flow and I need year 3 cash flow. But year 1 I have 3 cash flows. Year 2 I have 3 cash flows. Year 3 I have 3 cash flows. 3 cash flows are given. We need only 1 cash flow. So how do we can convert the 3 numbers into 1 number? Mathematically we say we'll take an average. Statistically, when we have a probability, we will compute expected value. How do we calculate the expected value? Probability we have, net cash flow we have. When I multiply probability with net cash flow, probability P column, cash flow like a X column, X into P, the product, when I do the total, I get expected value E of X, and that is what is becoming expected cash flow for year 1. Similarly, we'll calculate expected cash flow for year 2. Similarly, we'll calculate expected cash flow for year 3. Then using all the three numbers, we can calculate the NPV overall. Let's calculate. These are all 3,000, 4,000, 5,000. So I'll keep everything rupees in thousand so I can calculate a little bit faster, so that every time I don't have to repeat 1,000 every time. I can do a little bit faster. So what we are going to do, we will compute year 1 expected cash flow we would like to calculate. What are the columns we are going to have? We need X, we need P, and we need we will have one column for X, one column for P, and one column for X into P for the product. Correct? So similarly, I'll do for year 1, year 2, year 3 separately. So for year 1, I have the cash flows. X cash flows are 3,000, 4,000, 5,000. I don't want to write full. I'll say rupees in thousands. So I'll write 3, 4, 5. And probability 0.1, 0.75, 0.75, 0.15. Let's multiply. So 3 into 0.1, we get 0.3. 4 into 0.75, just slightly reduce the size. Okay. 4 into 0.75, we get 3. And 5 into 0.15, we get 7.5. No, 0.75. 0.75. So total, this is our E of X. Mathematically, E of X, nothing but expected value of X. Expected value of X. That is 4.05. 4.05. This we can also say like X bar, because it's also called as average. So this I can also say like a X bar. Okay, so X bar also will say, E of X also will say. So basically it means expected value of X for year 1. Some more calculations will come later. So at this point in time, leave the table as it is. Similarly, let me do for year 2. Same process I'll follow for year 2. Year 2 cash flows. 2,000, 3,000, 4,000, 2, 3, 4. Again, every time I don't want to write it as like big numbers. So I'm writing rupees in thousands directly. Probability 0.1, 0.75, 0.15. That probability can be different. It happened to be same. 0.1, 0.75, 0.15. Let's multiply. 2 into 0.1 is 0.2. 3 into 0.75 is 2.25. 4 into 0.15 is 0.6. So total, total 3 is it? 0.2 plus 2.25 plus 0.6. 3.05 I think. 3.05. Okay. So I have done for year 2. Similarly, we'll do for year 3, expected cash flow. Year 3, expected cash flow. I hope you're able to understand the interpretation of it. There is 0.1 probability that 3000 is the cash flow, 0.75 probability that 4000 is the cash flow, 0.15 probability that 5000 will be the cash flow. On an average, the cash flow is 4.05, which I call it as expected cash flow. So expected cash flow for year 1 is 4.05, mathematical value of expectation. Expected cash flow for year 2 is 3.05. Similarly, we are going to calculate the expected cash flow for year 3. Same column, we will write it x into p. Then we'll calculate the average. Cash flow, what we have is 2000, 3000, 4000. Okay, same number. 2000. I think same numbers, same probability also. Oh, in fact, I get same answer then. I don't have to repeat it. You repeat it. I can do copy paste. You please repeat it. You please repeat. Same numbers, so same answer I get. X into P, we get the expected cash flow for year 1, expected cash flow for year 2, expected cash flow for year 3. 4.05, 3.05, 3.05. Okay. Uh, Hope you got it. Now we are going to calculate NPV. How do we calculate NPV? We require cash flow. Is every year cash flow same? First year expected cash flow 4.05, second year expected cash flow 3.05, third year expected cash flow 3.05. Every year cash flow is not same. So what we are going to do? We will not be using annuity factor. I'll be using discounting factor. Let's calculate NPV calculation. NPV calculation. So year 1, 2, 3. Expected cash flow, what we calculated 4.05, 3.05, 3.05, or you can write full for like I mean 4050, that also you can write. Then discounting factor at the rate of 7%, they said, I think. So 1 by 1.07. Okay, so just 1 second. Seconds. Okay, so 1 by 1.07, 0.9346, 0.8734, 0.8163. Okay, let's multiply. We get discounted cash flow. So 4.05 into 0.9346, 3.78, or you can say 79. 3.05 into 0.8734, 2.66, 3.05 into 0.8163, 2.49. So total 3.79 plus 2.66 plus 2.49, you get 8.94. This is what you get is present value of inflows. This is present value of inflows. For this, I have to subtract investment. So less investment, that is project cost. Investment is 5,000. So we get NPV as 3.94. That is basically, this is rupees in thousand, so 3,940. Approximately you get 3,940. 3,940. Okay, fine. So what we got now is expected NPV. Should the project be accepted? Since the expected NPV is positive, we say that project should be accepted. The straightforward thing. Project should be accepted. NPV is positive. The expected NPV is positive. Then one more question comes. Also calculate standard deviation. Okay. So how do we calculate standard deviation when we have probability? Hope you know the basic formula in statistics. Standard deviation is calculated by summation x minus x bar the whole square divided by n square roots. Correct? This is the standard deviation formula in statistics. But we have probability also. And we have for year 1 separately, year 2 separately, year 3 separately. So what I'm going to do, first I'll compute year 1 standard deviation. I will compute year 2 standard deviation. Then I'll compute year 3 standard deviation. Then I will mix all the three. I get project standard deviation. Like the way I've done for NPV calculation. Year 1 cash flow I got, year 2 cash flow I got, year 3 cash flow I got. By discounting all of them, we got the present value of inflows, correct? Same method we are going to do with respect to calculation of standard deviation. For year 1, you calculate standard deviation. For year 2, you calculate standard deviation. For year 3, you calculate standard deviation, and then we are going to calculate the overall standard deviation that becomes standard deviation of the project. Can't it be done with combined standard deviation? No, you cannot do the combined standard deviation because this is year 1 cash flow, year 2 cash flow, year 3 cash flow. So the three standard deviation are not happening at same point in time. They are happening at different years. So when they happen at different years, we need to give time value of money. So I have to make use of the concept of time value of money. Then I will combine. Okay. Now first let me understand how do we calculate standard deviation when there are probability. Okay, so when you have a probability, the formula goes like this: summation x minus x bar the whole square, just like the way I just told you earlier, divided by n don't come. Instead, I will multiply it by probability. Because when probability comes, the formula is same formula, x minus x bar whole square divided by n, but changes divided by n don't come. Instead, we multiply it by probability, or you may remember like this. If you remember the conceptual basics earlier, good. If not also, please write down this formula. Standard deviation equals, when you have a probability, summation x minus x bar the whole square multiplied by p square root. If I don't do square root, basically if I square both sides, when I do standard deviation square, or I'll use the short form only, this is the symbol standard deviation square, and that becomes variance. Standard deviation square becomes variance. So that formula is basically square root will not come. Same formula, the square root will not come. Summation x minus x bar whole square multiplied by p. The square root will not come. That becomes the variance. Is the square root for p also? Yes. This is a full square root. Square root for full. Yes. And when I square both sides, I get square root and square root cancels. That square root will be cancelled. Variance u will be obtained. Why I am calculating variance? There's one mathematical reason behind this. We need the project variance, so project standard deviation. So I told you what is the process. I take year 1, I take year 2, I take year 3, I mix all of them. So when we are doing this mathematical simplification combinations calculations, as per the mathematical property, standard deviation should not be used. Instead, variance should be used. Standard deviation is for expressions only. When you want to mix all these things, standard deviation always will be squared. Even in the formula of combined standard deviation, we always square the standard deviation. Because we need variance. Variance only can be used for mathematical simplifications. For that reason. That's why for year 1, year 2, year 3, I will not calculate standard deviation. For year 1, I am going to calculate variance. Year 2, I am going to calculate variance. Year 3, we are going to calculate variance. We mix all of them. Using time value of money, I get the present value of variance. Then I take standard deviation. Then I get the project standard deviation. So let me explain the process. So year 1, variance. I'm going to calculate. Year 2 variance is going to be calculated. Year 1 variance, year 2 variance, year 3 variance is going to be calculated. Then I mix all of them. I'll tell you how to mix all of them. Then I will be getting one standard deviation, one variance, that is project variance. Project variance. From the project variance, ultimately, when I do a square root, we get project standard deviation. Project standard deviation. If you want, you can just write down this part. And x bar. X bar is nothing but our expected value. X bar is calculated by nothing but E of x. That x bar is E of x calculated as summation x multiplied by p. Expected value, nothing but x bar, nothing but average. Correct. When we combine the variances of years, we get project variance. That's what I've written, right? What else I've written? Year 1 variance, year 2 variance, year 3 variance. When I combine all of them, I get project variance. That's the process I'm explaining. Calculations we are yet to do. That's the process. Year 1, year 2, year 3, when I combine all of them, I get project variance. Then I take a square root, I get standard deviation. We will calculate that. Okay, hope you got it. I'll go for calculations now. So what are the columns we require? Columns ultimately I require x minus x bar the whole square multiplied by p. So I need one column for x minus x bar. I need one more column for x minus x bar whole square. And last column I require for x minus x bar whole square multiplied by p. Three columns required: x minus x bar, then x minus x bar whole square, and then x minus x bar whole square multiplied by p. Hope you get it. So hope you written down till here. Okay. So I'll go further. So what are the columns we are going to have? Let us write down in the form of columns. I told you 3 extra columns required for each year. So I require one column for x minus x bar, one column for x minus x bar whole square, and one more column for x minus x bar whole square multiplied by p. These are the 3 additional columns required. Ultimately, last column required. For that, the previous 2 columns are used as calculations. Okay, hope you've taken down the column also. Okay, next. Let's calculate what those going to become. So I need x minus x bar. X minus x bar. So I'll show you for the first calculation. Subsequently, you should be able to do. For the first year, x is 3, x bar is 4.05. So 3 minus 4.05. That becomes minus 1.05. Plus minus, you don't have to worry. Anyway, we are going to square it. But still, as a practice, you write it. X minus x bar. 3 minus 4.05. Then next x value. Below that, what next x value we got? 4. 4 minus 4.05. Minus 0.05. Then 5 minus 4.05. You get 0.95. Hope you got the x minus x bar values. That is 3 minus 4.05, 1.05, 4 minus 4.05, 0.05, 5 minus 4.05, 0.95. Then x minus x bar, the whole square. This column should be squared. X minus x bar, column should be squared. So 1.05 square, 1.10, 2 decimal I'll take. 0.05 square, 0.0025. Okay, I'll take 0 only. That's almost 0 only. 0.95 square, 0.9025. I'll take 0.90. Or you can take 4 decimals also. That's also fine. But let's take 2 decimal. That's sufficient. So you get 1.1, 0.9 total. Sorry, total error required. This has to be multiplied with probability. X minus x bar whole square multiplied with probability. So x minus x bar whole square into p. Multiplied by probability. So how are we going to do? Let me explain. 0.1 is probability into 1.1. 0.75 is probability into 0. 0.75 probability into 0.9. You can take 2 decimals. So 0.1 into 1.1, you get 0.11. This anyway 0 you get. Then 0.75 into 0.9. You get 0.675. I'll round it off, 0.68. So 0.1 into 1.1 is 0.11. Second one is into 0. Next 0.15 into 0.9 means you get 0.68. You can do the total. That itself is summation x minus x per whole square means first year variance. So 0.11 plus 0.0 plus 0.68. You get 0.79. So first year variance is 0.79. First year variance. Similarly, we'll repeat the column for second year. We get the second year variance. Like that we have to calculate. It's 0.135. What is 0.135? Total is it? Okay, 0.9 into 1.15. You get 0.68. You get 0.135. Okay. 0.15 into 0.9. Okay, you get 0.135. Okay, I'm sorry, that's my mistake. So 0.135, I'll say 0.14. So I think you get 0.25 then total. Point 0.25 is the total. Okay, fine. So let me do for year 2. X minus x bar. 2 minus 3.05 minus 1.05. 3 minus 3.05 minus 0.05. 4 minus 3.05 means 0.95. Same answer you're getting. Okay, anyway. So square that number. 1.05 square. 2 minus 3.05 is minus 1.05. 3 minus 0 minus 0.05. 5 minus 0.05. 0.95. I think same numbers. So I think you can calculate similarly, but repeat the columns. 1.05 square give you 1.1. 0.05 square you can ignore. 0.95 square is 0.9. Then multiplied by p. 1.1 into 0.1 is 0.11. 0.75 into 0 is 0. 0.15 into 0.9 is 0.135. I'm rounding it off to 0.14. So total 0.25. Oh, I think you're getting same answer for all. Okay, that's a interesting part. That's okay. Next year also same calculations we have. So follow the process. I think same answer you get. So fortunately we are getting the same answer everywhere. No problem. This will be faster then. But in, of course, some other problem it will not be same. So here everywhere we got 25.25.25 as the variance. Same answer we got. Okay. So year 1 we got the variance, year 2 we got the variance, year 3 you got the variance. You can please repeat it quickly. Same thing you come, because numbers are same, so you're getting same answer, but it will not be same in different problems. Okay, let's go for next, project variance calculation. Just like NPV calculation, I'll go for project variance calculation. Okay, there's one small difference. Year I'll take as it is. Cash flow means variance. I got the variance same for every year, 0.25, 0.25, 0.25, same cash flow I got every year. Please observe here, the discounting factor what you're going to do will not be discounting factor, it will be discounting factor square. This will be discounting factor square. The column will be same like NPV calculations what we got, but it will be discounting factor square. The reason being, what is variance? I told you how do we get the variance? It's standard deviation square, correct? Mathematically, variance is obtained by squaring it. So, logically or mathematically here also, discounting factor, we are going to calculate by squaring it. So, don't do discounting factor, make that a discounting factor square. Discounting factor square. Okay. Okay. So, how do we square the numbers? 0.9346 we had, right? Discounting factor, square that. 0.9346 square it. You get 0.8735. 0.9346 you had. Discounting factor, square the discounting factor. 0.9346 into equals in your calculator. Square that number. Similarly, 0.8734 we got. Square it. 0.8734 into equals 0.7628. Then 0.8163 we got, square it. 0.6663. Okay, then you can multiply the discounted cash flow, same method, discounted cash flow, 0.25 into 0.8735, 0.21, 0.22, I'll take two decimals, 0.25 into 0.7628, 0.19, 0.25 into 0.6663, you get 0.17. You get 0.58. Hope you're getting same number, 0.58. So 0.9346 square you do, 0.8734 square you do, 0.8163 square you do. Then multiplied by the cash flow, you get the discounting factor, discount cash flow, and that is project variance. Project variance. And how do you get the standard deviation? Take a square root of this, you get the project standard deviation. Square root of this, you get project standard deviation. So 0.58 square root, you get 0.76. So 0.76 is the standard deviation. Okay, so what is the interpretation of it? Ultimately, logical interpretation of 0.76. Based on these probabilities, most probably our expected NPV is 3.94. That is our average NPV. But what is its range? How much it can be plus minus? It can be plus minus 0.76. That is the expectation. So 3.94 is our average and deviation is 0.76. So expectation, or how do we tell our managers and all? It is 3.94 is my average, but plus or minus 0.76. That is how we create the range of expectations from standard deviation, which is our expectation. Which is our expectation. Okay, there's also one more formula which institute gives. If you want, you can calculate that also. I'll give it to you. You can try this calculation later, but I'll just show the formula what institute gives. We also done the same thing, but a formula kind of thing. Standard deviation of the project is given by variance of first year. Sigma 1 square means variance of first year divided by 1 plus r square. Basically, first year discounting factor square plus sigma 2 square second year variance divided by 1 plus r to the power of 4. Basically means second year discounting factor square. Then third year variance sigma 3 square divided by 1 plus r to the power of 6, which means third year discounting factor square. So when you add all, we get the project variance. You take the square root of this, you get the project standard deviation. So same what we have done in tabular format, they have given in the formula format. If you want, you can write down the formula and you can try it later. But examination, tabular presentation is definitely easy and risk free. Okay, hope you got it. Let's go further. Okay, let me go further. Let's do this problem. You can come to this one. Skylark Airways is planning to acquire a light commercial vehicle aircraft by for flying class clients at an investment of rupees 50 lakhs. The expected cash flow after tax for next 3 years is as follows. Year 1, year 2, year 3, cash flow probability. Company wishes to take into all consideration all possible risk factors relating to the airline operations. The company wants to know the expected NPV of this venture assuming independent probability distribution with 6% risk rate of interest. So we have to calculate NPV here and we have to calculate risk. So when they give you things like this, risk here means we have to calculate standard deviation. Understand the problem first. Then we can go to the solution part. First, let me focus on NPV. Now, year 1, year 2, year 3, cash flows multiplied by the discounting factor will give you present value. Correct? But in this problem, we don't have one number. We have so many cash flows with the respective probabilities. Any idea? How do you convert these many cash flows into one number? Anyway, I will tell you. That is called as expected value method. Mathematical value of expectation. Expected value method. So how are we going to calculate that? The cash flows multiplied by probability. That is like taking an average, basically, weighted average, where probability is like the weight. So 14 lakh into 0.1, 18 lakh into 0.2, 25 lakh into 0.4, 40 lakh into 0.3. That will give you an average cash flow for year 1. Expected cash flow for year 1, or mathematically we call it as E of X. Expected value of X. X is one column, probability one column, multiply the product will give you, the total of the products will give you expected value. Expected value, that is nothing but an average. Like that, we compute for year 1, for year 2, for year 3. So we get the expected cash flow, then we multiply it by discounting factor, do the total, you get present value of inflows. Understood? Now, regarding standard deviation, you should be careful. That too when probability is there. Standard deviation is given by square root of summation x minus x bar whole square into P. Why? Because we have probability here. Sir, what is x bar? Average. I told you we calculate expected value for year 1, year 2, year 3 separately. That is x bar. X means what? So cash flow individual values are called as X observations. So then we do X minus X bar whole square multiplied by P. If I don't put the square root, you know what is it called as? The basically standard deviation square. You know what is it called as? That's called as variance. So all these things we have to calculate in this problem. So first let's calculate expected cash flow for year 1. They have given 14 lakhs. That's a too big number. So I'll make it as 14, 18, 25, 40 cash flows. Okay. Then we multiply it by the probability. So 14 into 0.1 will give you 1.4. 18 into 0.2 will give you 3.6. 25 into 0.4 will give you 10. 40 into 0.3 will give you 12. So total you get 27. What is this 27? This is X bar. 27. That is expected cash flow. Or I can say average cash flow. Expected cash flow for year 1 is 27 lakhs. So year 1 I computed expected cash flow. Like that I compute year 2 expected cash flow, year 3 expected cash flow. So I get the 3 years cash flow multiplied by discounting factor. I get the present value of cash flows. Similarly, for first year standard deviation I compute. Actually, I don't compute standard deviation, I compute variance. First year variance I compute, second year variance I compute, third year variance I compute, then I total it up. That will give me the project variance. Understanding? Cash flow basis, we compute the every year cash flow discounting factor, we get the NPV. Similarly, every year variance I compute, applying discounting factor, I get the project variance. Project NPV, project variance. Project NPV is the return of the project. Project variance is the risk of the project. Okay, you first write down this, then I'll tell you how to calculate variance And then we are going for overall calculation. Write down till here. Okay, is it done? Okay, now to compute the variance, what is the variance formula is going to be? I told you summation x minus x bar whole square multiplied by p. So what are the columns required? X bar, 27 is x bar here, what we got, okay. We require one column for x minus x bar, this deviation, then x minus x bar whole square. For squaring it, then you multiply it by probability. These are the three extra columns which are required. Let me explain to you one by one. X minus x bar. Write down along with me. Write down along with me. How to calculate this one? 14 minus 27. 14 is x. 27 is x bar. 14 minus 27 minus 13. 18 minus 27 minus 9. 25 minus 27 minus 12 minus 2. 40 minus 27 plus 13. Did you get it? How to calculate x minus x bar? X values subtract with x bar, which is 27. 14 minus 27, 18 minus 27, 25 minus 27, 40 minus 27. Got it? Then we are going to square. 13 square, 169. Please write down along with me. 9 square, 81. 2 square, 4. 13 square, 169. Okay. Now, this multiplied by probability. So, 169 multiplied by 0.1, 16.9. 81 multiplied by 0.2, 16.2. 4 multiplied by 0.4, that is 1.6. 169 multiplied by zero point 0.3, that is 50.7. And do the total, 85.4. What you get is the variance for year 1. Variance for year 1. And 27, what we calculated? Expected cash flow for year 1. So we have done for year 1. Same table repeat for year 2. Same table repeat for year 3. Then we prepare the combined table after that. Did you get the point? Any doubts here? Okay. Let's do same thing for year 2. X values probability they only have given. Please write down along with me now. Let's do it together. Please write down second table for year 2. Repeat the second one. Repeat for year 2. Okay. Hope you have written down 2 columns. Now products. Let's multiply. 15 into zero point 0.1 equals 1.5. 20 into zero point 0.3 equals 6. 32 into zero point 0.4 equals 12.8. 45 into zero point 0.2 equals 9. And total 29.3. This is X bar for year 2. Expected cash flow for year 2. Then X minus X bar. 15 minus 29.3 minus 14.3. 20 minus 29.3 minus 9.3. 32 minus 29.3 2.7. 45 minus 29.3 15.7. All x minus x bar. Then square it up. 14.3 square 204.49. 9.3 square 86.49. 2.7 square 7.29. 15.7 square 246.49. Hope you got it. Then multiplied by probability. 204.49 multiplied by 0.1 20.45. 86.49 into zero point 0.3 25.95. 7.29 into zero point 0.4 2.92. 246.49 into zero point 0.2 49.3. I'm getting one question like 32 minus 12 is 18, not 2. I don't know which one you're talking about. 32 minus 29.3 is 2.7. 15 minus 29.3 is minus 14.3. 20 minus 29.3 is minus 9.3. 32 minus 29.3 is 2.7. 45 minus 29.3 is 15.7. Hope you got the questions. Okay. So total it up, we get 98.62. This is variance of year 2. Similarly, can you repeat the table for year 3? I'll give you 2 minutes. You please try to prepare for year 3. Please give a try. You please try for year 3. I'll give you 2 minutes. Have you completed the table 3? If done, please check it out. For third year, please check it out. For third year, you should get 27.9 and 74.29. Please check it out. Okay, hope you have done it. So year 1, year 2, year 3, cash flows we got 27, 29.3, 27.5. That we discount and we subtract from investment, we get the uh, expected NPV. Similarly, we got the variance of year 1, year 2, year 3, that we discount, and when we discount, that will give us the project variance. Let's calculate. First, let me calculate the project NPV. So year 1, 27, year 2, 29.3, year 3, 27.9. Multiplied by discounting factor, 0.9434, that is 1 by 1.06. Hope you know how to calculate it. Discounting factor, 1 by 1.06 equals. Then multiply cash flow into discounting factor, 27 into 0.9434, 29.3 into 0.89, 27.9 into 0.8396. Total it 74.97. Subtract investment, which is 50. You get NPV 24.97. So subtract investment 50, you get NPV 24.97. Write down the table. Okay. This we have done for NPV calculation. They wanted expected NPV. We have a calculated expected NPV. NPV is more than 0. So we say project can be accepted. But they also want to understand the risk. Means they want to understand the standard deviation. Let's compute standard deviation each one. So we got variance for first year 85.4, variance for second year 98.62, variance for third year 74.29. Three variance we got. Now we are going to discount it. Okay, this be careful. I'll repeat this cash flow. The variance of first year 85.4, variance of second year 98.62, variance of third year 74.29. Completely fine. Please be attentive, my dear friends. Here, focus. What is variance? Variance is basically standard deviation square. Correct? So discounting factor also I need to square it. 0.9434 square will give you 0.89. Please, I repeat once more. Standard deviation square is variance. We have got variances. So I should not multiply with discounting factor. I should multiply with discounting factor square. That is 0.9434 square, 0.89. 0.89 square gives you 0.7921. 0.8396 square gives you 0.705. That you multiply and do the total. That will give you the standard deviation. You can take a square root. That will give you the variance. So, that will give you the standard deviation. So year 1 variance, year 2 variance, year 3 variance multiplied by discounting factor square. Then cash flow into discounting factor square. Total whatever you get is project variance. Take a square root of that. That will give you standard deviation. One more alternative method is there to get this answer. But anyway, you write down this table and then we can go further. I've zoomed it. I don't know whether you're able to see this zoom in portion. Let me know once it is done. So expected NPV calculated more than 0. So we recommend to accept the project. And then we have come across the risk curve, project risk, standard deviation. That is the risk they wanted to compute. Hope you got it. Hope it is done. Okay, let's go further.
Next topic is decision tree. It's also called as joint probability. If one event can be done in m ways, other event can be done in n ways, then both of the event can be done simultaneously, one after the another, m into n ways. I don't know whether you understood. Now, let me give you a basic example. Suppose you know in CA there are 3 levels. I know foundation, intermediate, final. Let me take a popular name, CPT, IPCC, final. What is the pass percentage in CPT? I'll take 40%. I know I'm taking optimistic number. I will tell you why later. IPCC, let's say 25%. Final, let's say 10%. So if somebody asks you, dear friend, you are doing CA, can you guide me? I am planning to do CA. What is the pass percentage in CA? Tell them a factual thing. Don't take revenge on them telling do CA and all. Don't take revenge on them. So you tell them CPT 40%, IPC 25%, final 10%. That and all they don't understand. You tell them one number. They tell I want one number. Which one will you tell? Whichever is less? Whichever is high? Oh, we'll take an average. If 100 people join CPT, 40 people come out of it. And 40 people, 25% IPCC means 10 people come out of it. And 10 people, 10% means only 1%. So CA pass percentage is actually only 1%. It's actually less than 1%. I took 40, 25, 10, so I got one full number. If I take the real number, it will be less than 1. I can't explain fractional number and all. 0.2% comes. Yeah, by the time you pass, you will also be a fraction only. But for getting some round of number, I assume like this. Are you understanding what is happening? Cumulative probability, joint probability. If one event can be done in m ways, one event can be done in n ways, other event in, let's say, p ways, then all of them can be done in m into n into p ways. So first year cash flow with one probability, second year cash flow with one more probability, then you multiply all of them, joint probability you get. Scenario analysis. Fine. So let's do a problem based on that. Question number 4. Again, please have your concentration in understanding the problem, not about the solution writing, because I've given solution in writing. Except one or two questions, I've given everything in writing. So just concentrate on understanding. That is sufficient. Okay. Please read the question. Okay, hope you've read it. So if you look at the question, first thing is they're asked us to draw the decision tree diagram. So let's get that first. That will give us the clarity for next set of questions. So year 1, there are two possible cash flows, either 50,000, 60,000, and the probability are 0.4 and 0.6. And those will further divide into 0.2, 0.3, 0.5, cash flow 24,000, 32,000, 24,000. And the second probability will further divide into 0.4, 0.5, 0.1, probability of 40,000, 50,000, 60,000. So let me explain, then you please write it down. You have to write down this part, you have space in your material. Okay, done. Fine. So please look at it. So first year 80,000 initial outlay. Now first year it can be 40,000, sorry 50,000 with 40% probability, or 60,000 with 60% probability. And that year 2 what can happen is further probability is there, 20%, 30%, 50%, and year 2 probability again 40%, 50%, 10%. So how do you compute the joint probability? 0.4 into 0.2 means 0.08, 8%. 0.4 into 0.3, 0.12, 12%. 0.4 into 0.5, that is 0.2, that is 20%, and so on. What do you mean by this 8% joint probability? If you want to get 50,000 in the year 1, 24,000 in the year 2, 50,000 in the year 1 and 24,000 in the year 2, then the joint probability is 8%. So please write down this chart, then we'll go for the table given in the solution. First write down this chart, 1 minute. Okay, hope you have written down. Now, please again be with me for the next table. It's very simple, but you have to be focused. Please check it here. How many NPVs are possible here? Can you think of it? 6 NPVs. Which are those? One NPV is computing year 1 50,000, year 2 24,000. One possibility. Year 1 50,000, year 2 32,000. Second possibility. Year 1 50,000, year 2 44,000. Third possibility, third set, third scenario. Then 60,000 first year, 40,000 second year, fourth possibility. 60,000 first year, 50,000 second year, fifth possibility. 60,000 first year, 60,000 last year, second year, sixth possibility. So we get 6 possible values, 6 NPVs, then we are going to bringing into one using probability concept. Fine? Very good. Now, all these 6 scenarios, I'm going to write it in a row level. Preparing 6 tables for 6 NPV become too much. So all those table, I'll convert it to one row. So each row here represents separate NPV calculation, separate table. So whatever we used to calculate like year, cash flow, discounting factor, discounted cash flow, I'll convert into a horizontal format. So same solution is in your material. So just understand, then you can look at your solution. Plus understand, see cash flow first year 50,000 and cash flow second year 24. One set. Cash flow first year 50, cash flow second year 32, second set, 50, 24, third set, and like that. 6 scenarios. We need discounting factor, which is 0.909. So 50,000 into 0.909, first year discounting factor, present value is 45,450. Similarly, 50,000 into 0.909, 50,000 into 0.909, 60,000 into 0.909, that is one first year cash flows into present value terms. Second year cash flow, 24,000 multiplied by 0.826, you get 19,824. Okay, so 24,000 into 0.826 is 19,824, like that. 32,000 into 0.826, 26,432. 44,000 into 0.826, 36,344. 40,000 into 0.826, 3340, and so on. So basically we are supposed to prepare 6 tables for 6 NPVs. I am doing it in one table with 6 rows. 6 tables becoming 6 rows. Then what do? We got the present value of first year cash flow, first year and second year cash flow present value. We need the total. So 45,450 plus 19,824, that is 65,274, like that. 45,450 plus 26,432. See, these are all different present value of cash flows. Then what do you do? I need NPV, subtract investment 80,000. So 65,274 minus 80,000, 14,726. 71,882 minus 80,000, 8118. 81,794 minus 80,000, 1794, like that. So you see 6 tables if I prepared, I would have got 6 NPVs. I got those 6 NPVs. So 6 scenarios, 6 NPVs. I need one number, convert this into average, that is multiplied by joint probability. In the addition tree we have calculated that 8%, 12% and all. So multiply. So this is the x value, this is P, this is x into P. Do the total, we get expected NPV. Since expected NPV is more than 0, we say project should be accepted. Oh, actually, okay, fine. Accept the project since accept NPV is more than 0. And they asked worst case NPV, best case NPV. Now, worst case NPV is how much? Worst case NPV, lowest NPV, 14,726, probability is 8%. And best case NPV is highest NPV, 24,100, it's 6%. That's all the problem. Please write down. Okay, I've given solution.
Please go through it. 1 minute. See if you have any question. Please go through it. 1 minute. This is purely decision tree problem. This solution is not there in the material. You have to write it down. Okay. L&R Limited wishes to develop a new virus cleaner software. Read carefully. The cost of the pilot project is 2,40,000. Presently, the chances of the product being successfully launched on a commercial scale are rated at 50%. In case it does succeed, L&R can further invest a sum of rupees 20 lakh to market the product. Such an effort can generate perpetually an annual net after-tax income of 4 lakhs. Even if the commercial launch fails, they can make an investment of smaller amount of 12 lakhs with hope of gaining perpetually a sum of 1 lakh. Evaluate the proposal, adopting decision tree approach, applicable discounting rate 10%. I'll give you 1 minute. Read the problem once more. Tell me in this problem how many decision points are there. Decision points. Read and think. 1 minute. Got it? In this problem, there are 3 decision points. 3. First decision is whether to do the pilot project or not. Okay? Then second decision is if it is successful, then should I invest it or not? In case it does succeed, it can further invest. Please observe, it can further invest. So invest or not is second decision. And third decision, in case if the pilot project is a failure, again you can invest or not. Invest or not. So basically there are 3 decisions. Today pilot, then if it is successful, further invest or not. Second, if it is failure, further invest or not. Total 3 decision points. And first decision actually based on the next 2 decisions. You should work backwards. If it is successful, what is the value? Come back. If it is failure, what is the value? Come back. Then using these 2, what is the value today? So you should move from left to right in the time sequence, but in the calculation you should move from right to left. So first calculate D2, D3, then come to D1. Okay. Please observe. I'll explain cleanly once more now. Cost of the pilot project is 2,40,000. It can succeed or it can be a failure. The probability of success is 50%. The probability of failure is also 50%. If it is successful, you can further invest or you need not invest. You understand? This is D1 and this is D2. You can invest or you need not invest. If it is a failure, still you can make investment or you need not make an investment. That is D3. Now, I'll give time. I think solution is there in the material. I've given the screenshot of this, so nothing to write down, just understand sufficient. If you invest in the event that the project is successful, then investment is 20 lakh. What is the value you get? 4 lakh perpetually. What is the value of perpetuity? Cash flow by interest rate. Remember, value of perpetuity, present value of perpetuity, annuity by interest rate. Or if you know Gordon growth model, cash flow by K minus G, D1 by K minus G. No growth rate means D1 by K only. So 4 lakh by 0.1, cash flow by rate of interest, perpetuity value 40 lakh, net benefit 20 lakh. That is if you invest. If you don't invest, 0. Which one will you choose? If you invest, you get a benefit of 20 lakh. If you don't invest, 0 benefit, whichever is higher. So D2 is to invest and make a benefit of 20 lakh. D2 is decided. Let's come to D3. Investment 20 lakh, benefit here how much you get perpetually? 1 lakh forever. So 1 lakh by 0.1, cash flow by rate of interest, perpetuity value 10 lakh. You invested 12 lakh, you are getting 10 lakh, net benefit is 2 lakh, loss. That is if you invest. You can invest. It's not that you should invest. You can. You have a decision to make. It's a choice. Correct? Now, if you don't invest, nothing to lose. 0. Which one will you choose now? Minus 2 lakh or 0? If you invest, you lose 2 lakh. Don't invest. So, D3 is don't invest and the benefit is 0. Now, what are the probabilities? This D2 probability 50%, benefit is 20 lakh. D3 probability is also 50%, benefit is 0, that's what we are selecting. So, net amount is 20 lakh into 0.5, 20 lakh into 0.5, 0 into 0.5, net is 10 lakh and cost of the pilot project is 2,40,000. So, net benefit is there. That means benefit is more than cost. So, we say that project should be accepted. So 1 minute, please take a look at this. I've given the solution in the material, nothing to write down. Okay. Okay. So hope you got it, my dear friends.
So next problem, year 1, year 2, year 3, 10,000, 12,000, 15,000. Cost of capital 12%, inflation 5%, investment 25,000. Compute net present value. Hope you got this question. Okay. So this is one typical problem, not very frequently asked in exam, but you should be aware of it. That is impact of inflation. What is inflation? In simple words, increase in prices. Increase in prices. Just imagine if a person's salary increases by 10%. If a person's salary increase by 10%. And if inflation means all the price, cost of the materials, expenses increased by 8%. So can I say effectively he is richer only by 2%? Even though 10% salary is increasing, but his expense also increasing by 8%, effectively we say 2% is the uh, effectively 2% is what we say is going to be a richness of salary, is the growth of a person. You only have 2 extra percent now for your, you can say my standard of living will increase only by 2% more depending on what you spent. But okay, that is logical. But mathematical, I told you. Mathematical, if you remember, we discussed in the basics also. I will not follow additive model. What is additive model? If I start with 100 rupees, first year if I earn 10%, second year earn 12%, can I say total for 2 years is 22%? I will not say that. Approximately you say, but actually it is not right. Why it is not right? Because first year on 100 rupees 10 means you becomes 110. Second year 12% you don't do it on 100. 12% you do it on 110. 12% you do it on 110. So second year how much interest you get? 110 into 12% means you get 13.2. So 13.2 plus 110 means 123.2. So it's not actually 22%. It is 100 to 23.2 means it is 23.2%, not 22%. So effectively, so when I want to calculate from year 1, year 0 to year 2, I don't do plus plus. What method we do? Remember the basics. From year 0 to year 2, if I want, I multiply it by 1 plus r square. 1 plus r 2 times. Or if different interest comes, 1 plus r1, 1 plus r2. Hope you know the basics. That's called as multiplicative model. Okay, I'll keep it simple for you. Listen. In compound interest method, from 1 year to another year, we follow multiplicative model. That is, we keep multiplying by 1 plus rate of interest, compounding. That's how we get the future values. But when there is inflation impact, how do you calculate the real growth, actual growth? There is a formula. It goes like this. Write it down. The formula goes like this. 1 plus nominal rate. Okay, let me write down here. 1 plus nominal growth or nominal rate is given by 1 plus inflation into 1 plus real growth rate, real rate. So when I say nominal rate, that means it is including inflation. And when I say real rate, it is without inflation. When I use the word nominal cash flow, it includes impact of inflation. When I say real rate, it does not include impact of inflation. That's why you see 1 plus real rate, I multiplied by 1 plus inflation means what? For the real rate, I am applying the impact of inflation, then I am getting nominal rate. So nominal rate is including the impact of inflation. Real rate is excluding the impact of inflation. So in this example, Cost of capital is like your increase nominal rate. So 1 plus 0.12. Inflation rate is 5%. 1 plus 0.05. 5% means 0.05. 1 plus real rate. So how much do I get here if I calculate? This is 1.12. 1.05 will go to left side. So a denominator I'll write 1.05 equals 1 plus real rate. So 1 I keep it left side. So 1.12 by 1.05 minus 1 plus 1 becomes minus 1 is real rate. How much that comes to? 1.12 by 1.05 minus 1 0.66 0.0667. Or if I express in percentage, if I multiply it by 100, it is 6.67%. What do you mean by 6.67%? If your salary increased by 12%, inflation is 5%. You're happy. You're getting 12% salary increase, but expense only goes for 5%. Effectively, what is your savings? What is your real growth? 12 minus 5, 7%. And that is what you're getting, 6.67%. Sir, why not number matching? Because 7% you calculated not mathematically. You did 12 minus 5. That's additive model. You found out the difference. But in mathematics, compounding happens, 1 plus there happens. So approximately it is 7%. For understanding a purpose, you can say, but actual calculation goes like this. So basically, inflation is increasing by 5%. Real rate is 6.67. Put together, your overall increase 12%. So 12% is called as the nominal rate, which includes inflation. And 6.67% is called as real rate, which does not include any inflation. So this is 6.67 without inflation. 12% is with inflation. Why this is required? In project, in our investment decisions, project plannings. Why? Because when we project the cash flows, while computing NPV, we will project the future cash flow, we apply discounting rate. Listen to me carefully. A simple point, tricky point. We project the future year cash flows, we apply discounting factor, and we get the present value. Correct? Now, when I project the future cash flow, will I include inflation or will I don't include inflation? Normally, I include inflation also. Normally. So, my cost of capital, my discounting factor should also include inflation. But suppose in the problem, like in this problem, cash flow they have given, but they said real cash flow. So cash flow does not contain inflation element. If cash flow does not contain inflation element, the discounting factor also should not contain inflation element, which means if cash flow is real, the discounting factor also should be real rate. If cash flow is nominal, discounting factor also should be nominal rate. Ultimate answer is going to be same, but depending on the cash flow, our answer will change. So in this problem, I'll show you both the methods, and because of mathematical reasons, number will not match, but approximately number will match. Why 0.33 difference? I just explained you. It's mathematical model. In mathematics, when I say, if I say 10% for first year, 12% for second year, it is not 10 plus 12 equal to 22%. It is not that, because compounding effect. So if I do 1 plus, if I start with 100, on that 10 I get, it becomes 110. On the 110, if I apply 12%, I get 13.2. So actually I get 10 and 13.2, which become 110 plus 13.2, 123.2. So what is my total interest, actual interest? 23.2. It is not 22%. Why 10%, 12% will not add up to 22? Why it becomes 23.2? Because of compounding factor. I explained to you. I explained once more. And that is why you cannot get that directly that 5% plus 7%, you don't get 12% directly. 5 plus 6.67. 5 plus 6.67 actually becomes 12%. Compounding effect. So 1 plus 0.05, 1 plus 0.0667 effectively becomes 12%. Hope you got the point. Okay. I gave you the formula. If you want to compute the real rate directly, same formula simplified, you get this formula. If you want, you can write down this formula also. Same answer you get. Nominal rate means cost of capital 12%. Divided by 1 plus inflation, 1 plus 0.05 minus 1. So 1.12 by 1.05 minus 1, you get 0.6667 or 6.67%. Same only, but you get the answer slightly faster if you directly use the formula. Okay, so what is the concept while computing NPV? This is important. Alternative 1. Alternative 1, you use real cash flow and you use real rates. Alternative 2, you use nominal cash flow and you use nominal rate. Nominal rate, you can also say cost of capital. Both answers are same, but from exam point of view, I would recommend the second method. This is recommended. From exam point of view, the second method is recommended. So please note it down. Alternative 1, real cash flow and real rate. Alternative 2, nominal cash flow and nominal rate. Did you get the difference? I'll just tell you once more. Real rate is before inflation. Nominal rate is after inflation. So if you are using real cash flow, your discounting rate also should be real rate. If you use nominal cash flow, then your discounting rate also should be nominal rate. Nothing but cost of capital. I would recommend the second method in examination. Both answer will be same. Why I recommend the second method, I'll tell you a little bit later. I'll tell you. Hope you have taken down this much. Should I take this part out? If you have any questions, please ask conceptually. I already answered that part. Why it will not add up to that exact number? Real plus inflation is not equal to nominal mathematically, but conceptually you can say real plus inflation is equal to nominal. Clear? Okay, very good. But this is a very important concept, okay, in real life also. It's a very important concept. Let me spend 2-3 minutes on this. Little bit of economics also involved. You're going to learn this at a later stage also, but in real life, this concept is very important. Many people, or at least in my opinion, this statement is in my opinion, many people will say, I invest in fixed deposits, 6% interest I get. I don't want to take any risk. 6% interest you get. But let me tell you, if you just invest entirely in fixed deposit, no doubt you get 6%. But what if your expenses are increasing, inflations are increasing by 8%, 9% every year? What is your real rate now? It is negative, right? You lose. Inflation, you are keeping the money in the bank so that future your expenses are covered. But if you keep the money in the bank, which is giving you 6-7% interest, and if your expenses are increasing by 7%, 8% interest, you're going to lose, right? So that's why to compensate for that loss, we always recommend if there's inflation, you go for stock market. Because after what is inflation, you consume more expenses. What you consume more toothpaste, you consume more rice, you consume more telephone. So all these are companies in stock market: Reliance, Airtel, Nestle, Britannia, Maruti, whatever expenses you call, that is in the stock market. How do we get to know inflation rate in the economy? You are economic students, you should know. Anyway, RBI will publish. You go to RBI website and you can check it out. RBI will publish for every product monthly whatever is the inflation and overall inflation. You need to be aware of it. Of course, you can go blindly, but our objective in the classes, we would like to make an informed decision. Okay, so many things. Now, flip side is also right. If interest rate is 6%, imagine, but if inflation rate is 1%, you are gaining 5%. So what banks will do then? You're having too much of rates, let's reduce the rate. So the things will work both the ways. So so far what used to happen, interest rate is 6%, if inflation rate is only 2%, real rate is 4%. See, real rate also should not be too much. Little bit of economics I'm spending, I would like to discuss with you, because recently government has reduced interest rates, and lot of people have criticized the government because reducing interest rate is bad. I am completely against that point. I'll explain how. See, there is a bank. What does bank does? They take money from public. You say saving bank account, you say fixed deposit, you say current account, whatever it is, and they give the money to public. I mean business. They give loan, business loan, vehicle loan, commercial loan, home loan, whatever it is. Now, you're expecting the bank to give the loan at a lower rate of interest, because they tell bank is charging loan 18%, you tell too much interest rate, give me at a lower rate. Okay, bank will give the interest rate at 8%. But bank, if they accept the saving account, and if they pay 6% saving bank, bank will be left with only 2% interest, right? Where will bank go? First of all, whatever the loan they get also, they may not get it. So bank is just a mediator. Our people, some people don't understand the logic. You may not be the case, but I'm just trying to explain so that you don't become one simply criticizing others and we don't do any of our work. There's a saying, right? Even a chai wala will always tell he know everything about the world except how to prepare tea, because that's his job. So except our job, we know everything else in the world. Anyway, so when the interest rates falls down, that means banks are giving interest at a lower rate of interest. Loan, when they give you lower rate, they should pay lower rate to the public. Otherwise, bank will suffer loss. Then bank will suffer loss. Then again we criticize government. Government don't know how to run the bank. I'm not talking about any party politics here. I'm talking about the economics. So when the interest rate falls down in the market, even the saving bank account interest also will fall down. Correspondingly, inflation also will fall down. So your real rate will remain same. Should remain same. If not, RBI should take some measures. See, I'll explain to you. Suppose inflation rate was 10%, let's say inflation rate is 8%, and interest rate in the economy, you can say FD rate or whatever it is, suppose it is 9%. So what is your real rate? Your real rate is 1% growth after adjusting expenses. If interest rate because of economy falls to, if inflation is falling to 3%, then interest rate falls to 4%, let's say, your real rate is still 1%. So you should not think, sir, earlier I was getting 9% interest FD, now I get only 4% interest FD, I lose 5%. You are not losing 5%. Your expense also coming down. So your expense is only 3%. So effectively your margin 1%, you are going to gain. Anyway, this slightly technical aspect, but the point I'm trying to tell you is, when you make a decision, just be aware. There is something called as real rate. There is something called as nominal rate. When you look at FD rate, it is nominal. Don't make your judgments based by just looking at nominal. See what is FD rate, that is nominal rate. See inflation rate, the difference is your profit. The difference is your real growth. The real rate is the difference between the nominal rate, which is FD rate, and the inflation. So when you make a decision, please don't go directly with one data. Try to look at the inflation and then you try to give interpretation whether you are making loss or profit overall. Anyway, it's general things. If you understood, good, great. Otherwise, also fine. Our objective in this problem is very simple. If it is real cash flow, I should use this real rate. If it is nominal cash flow, I should use nominal rate. And my recommendation, use nominal rate. That's all what we wanted to discuss in this chapter. Change in one rate need not be equal to one. Exact perfection will not happen. But that is the job of RBI. What is the job of central bank? To make sure the difference is always maintained. The objective of central bank is not to give too much of FD rates. The objective of RBI is not to have too much of inflation. They want to keep the control. So they are the ones who keep looking at the difference. What is inflation rate? What is interest rate? They are always looking at the difference. Whenever they feel the difference is too much, either negative or positive, both sides, RBI comes with measures either to reduce the interest rates or to increase the interest rates. What tools RBI uses? That is your economics again, macroeconomics. You have statutory liquidity ratio, cash reserve ratio, bank rates, reverse repo rate, various techniques which you have monetary measures, fiscal measures, all these things are there. Petrol and gold changes daily. Let it change daily. We are not worried about that. Let's say we are always going with average. Last month, last year, last 6 months average. So we compare the averages. Daily, I'm telling you, things difference. I told you inflation rate and this FD rate. The difference will not be exact same day. We are trying to do an approximations. So if things are changed drastically, the government, which is RBI, should come and take measures so that the real rate and the real rate always intact. The nominal rate and inflation, they should always be intact. The moment inflation is too much, interest rates is less, RBI should make sure that the inflation is checked. How inflation will be controlled? Inflation means what? Too much supply of money. How too much supply of money will be controlled? The government will say the banks have to maintain higher balance with me, or what will the RBI do? They increase the interest rates. When interest rates are increased, what will happen? When you keep the money in fixed deposit, you get more income. So lot more people keep the money in bank rather than in economy. And people don't take loan. Because interest rates is high. Supply of money is reduced. Supply of money reduced, inflation gets controlled. If inflation is too less, that is also bad because the difference will be very large. Not good for economy. The moment inflation is too less, they reduce the interest rates. So that when they reduce the interest rate, people take out the money from fixed deposit and invest in shares. They come to capital market. When interest rate is less, people take loan. They do business transaction. Supply of money comes down. So these are all the economical part. Since you asked, I just told you. Okay, we'll come back to this. We have to make sure that we complete this part. Okay, so that's all economics you are going to learn. Maybe economics you have not learned yet. You have in our subject economics for finance or macroeconomics in some other course maybe. You will learn all those part in detail. You will definitely learn. I just give a hint. My point is only simple. When you look at the interest rate, don't look at only interest rate. Also look at the inflation. The difference is your impact. When you earn or when your family member earns, keep this in mind while making decisions. Okay, so let me go for this now. I'm using year 1 real cash flow method. I will also use nominal cash flow method. Okay, so year 1 they have given cash flow 10,000, 12,000, 15,000, year 1, 2, 3. Discounting factor, because cash flow is real, discounting rate also I'll use real rate is 6.67. So how do you calculate discounting factor? 1 by 1.0667 equals. Every year is different cash flow. Are you discounting factor, not annuity factor? Multiply, you get discounted cash flow. Please write down till then. Okay, then discounted cash flow, 10,000 into 0.9375, we get 9375. 12,000 into 0.8789, 10,546. 15,000 into 0.8239, we get 12,358. Then subtract investment, 25,000. That will give you the NPV. A little bit of alignment parts. Just give me 1 second. Just give me 1 second. Okay. Okay. So NPV you get 7280. Present value of inflows 32,280 minus investment 25,000, NPV 7280. Okay. Now this is the first method using real rate and real cash flows. The second method which I recommend in exam point of view is this. I hope you've done till here first of all the calculations, NPV. Okay, good. Okay, now let me go for the second method, recommended method for exam point of view. First two columns you repeat, year cash flow real. This second method, cash flow also will be real, and second method, cash flow will be nominal, discounting rate also nominal. When they give you nothing, we'll take it as nominal only in general. So cost of capital will take it as nominal. Cash flow also we should convert into nominal. The second method, the rate and the cash flow both should be nominal terms. Both should be nominal terms. And we are trying to convert it, we are trying to calculate NPV using those two. Cost of capital is already nominal terms that we don't have to convert. But cash flow is in real terms which we need to convert into nominal terms. How do we calculate? What is the meaning of real cash flow? Real cash flow is before considering inflation. Nominal cash flow after considering inflation. Pay attention, this is important. So we have 10,000 and rate is 12%. Inflation rate is 5%. So 10,000 increases by 5%. So how much it will become? 10,000 into 1 plus 0.05, like 1 plus R. You know, every time we increase, that 1 plus r is multiplied, 1 plus 0.05. Like a future value, you know, future value is present value into 1 plus r. 1 year only I'm asking. So 10,000 into 1 plus 0.05, 10,500. Of course, in a raw method, 10,000 is the basic. 5% if you add, you get 500. So 10,000 plus 500, 10,500. 1 plus r. So 10,000 is before considering inflation effect. Before considering inflation means what? 10,000 is considering today price. Today price. 10,500 is considering the price at the end of year 1. Is at the end of year 1. Let me just explain that part once more because I would like to give the clarity on that aspect. See if you are able to understand. Okay. This is a numerical different example. Year 1 in the project which I am trying to tell you, let's say I will sell 1000 kg. Let's say I will sell 1000 kg. This is quantity. But if I want to know what is my sales, what should I multiply to get the total sales value? What do you think? In the current year, I am expected to sell 1000 kgs. If I want amount, I want to know amount of sales. Then I have to multiply it by price per kg, right? Price per kg. Price per kg. Suppose today in the market it is selling at price per kg is 10 rupees. Then what do? Okay, then my cash flow sales will be 10,000. But this is 10 rupees in today price. What is this today price is called as? That is called as real cash flow. What is real cash flow? That is the cash flow that is going to be at the end of the year using the price now. Using the price today. What is the price today? No inflation effect yet. Because when you add inflation, that will be at the end of the year. What is inflation? Every year, I'll expect a 10% inflation. Okay, 10% inflation. That means at the end of the year, I will not be selling at 10 rupees. This is, I'm expecting to sell at the end of the year. 1000 kgs, I will sell at the end of the year. But my price will not be 10 rupees at the end of the year. When I'm selling this 1000, 10 rupee, 10% increase, that means 11 rupees, right? 10% increase, it becomes 11. That becomes actually 1000 kg multiplied by 11, it becomes 11,000. Understanding 10,000 in today price is real cash flow. 10,000 is using 10 rupee today price. I sell the units at the end of the year, but I'm using today price. Using today price means real cash flow. 10,000 real cash flow. Applying 10% inflation, I get 11,000. Now imagine, second year, I'm going for this further expectation. Second year, I will not sell 1000 kgs. I'm going to sell, let's say, 1200 kgs. My inflation for first inflation is 10% per annum. Can you tell me what will be my price at the end of second year? Interesting, important, very, very important. 1200 kgs I'm selling. Okay, multiplied by what will be the price? Today price is 10 rupee. Year 1 price is 11 rupee. But I don't want 10 rupee, I don't want 11 rupee. This 1200 kg I'm selling at the end of second year. So you have to increase 10% again because the price would have been increased again. Today start with 10 rupee. 10% inflation first year, again 10%. 10% on which number? Not on 10 rupee. 10% should be on 11 rupee because compounding effect. So it becomes 12.1. Hope people are getting it. Or directly if you want, can we do like this? Can you do like this? 10 rupee into 1 plus 0.1 into 1 plus 0.1. Basically 1.1 square. 10% compounded 2 times. That is the reason. Here what I am going to do, 10,000 to 12,000 I have. Real cash flow. What is real cash flow? Real cash flow means today price. But I don't want today price. I need 2 year later price. 2 year later price means inflation should be added 2 times. That is 1.05, 1.05. Both the year happen to be same. Oh, what if first year inflation is different? Second year inflation is different? That also can happen. Suppose first year inflation is 5%. Second year inflation 6%. How do I calculate? 12,000 into 1 plus 0.05. So compounded for first year, considering first year inflation, again multiplied by 1 plus 0.06. So basically, I keep multiplying by 1 plus r, 1 plus r, 1 plus r. How many ever times? As number of years. I hope you got the clarity regarding impact of inflation. Chance of asking different rates, that's why I just answer. Practically they will be different for different years. Exactly, that's the answer. That's what I just answered. If different interest rate comes, for example, if 5% for first year, 6% for second year, and 7% for third year, this is the data given in the problem. Then how do you calculate? 10,000 into 1.05, only 1 year. 10,000 into 1.05. But 12,000, what do I do? 12,000 into 1.05 into 1.06. Because 0.05 first year, 0.06 second year. So 1.05 into 1.06. Third year, what do you do? 15,000 multiplied by 1.05 for first year, 1.06 for second year, 1.07 for third year. But in this case, 5% is same for all the 3 years. So 1.05, 1.05, 1.05, that becomes 1.05 cube. 3 times you multiply. I hope I answered your question. Okay, very good. So you get the cash flow in nominal terms. And that is why I recommend this method. Why I recommend this method? If 3 years, if they give you 3 inflation rate, how do you calculate real rate? Because real rate, inflation becomes 3 inflation. That means every year different interest. Every year you have to calculate real rate. That is going to be a headache. That will be too complicated. You can, but too complicated. So we don't follow that method. So when multiple inflation rate comes, here very simple. We just increase by 1 plus r, 1 plus r, 1 plus r. How many years are there? So you don't have to worry anything beyond that. So that is why when different inflation rates are given, the first method becomes complicated. We don't recommend that. But conceptually, I'm solving under both the methods. Okay. After this, very simple. Discounting factor 12%. 1 by 1.12 nominal. Multiply 10,500 into 0.8929. 13 to 13 to 0.7972. 17,364 into 0.7118, you get 12,359, total 32,280, minus investment 25, NPV 7282, approximately 7280 only you get. Difference because of the mathematical reasons, roundup reasons. You see, both answers are same. So second method is recommended from exam point of view, especially if they give you different inflation rates. So please write down and let me know if you have any doubts. Okay, hope you got it. Okay, very good. You can come to this problem towards the end. This problem is to make us understand the inflation on a full-fledged basis. You can come to this problem. Hope you got the problem. XYZ Limited requires 8 lakh for a new project. Useful life of the project 4 years. Salvage value nil. Depreciation charge 2 lakh per annum. Expected revenue and cost excluding depreciation, that is ignoring inflation, is given. Revenue and cost, applicable tax rate 60%, cost of capital 10%, then calculate NPV of the project if inflation rates for the revenue and cost are as follows. Year 1, 2, 3, 4 revenue cost, inflation rate they have given. So what is this inflation, my dear friends? Very simple words. Inflation means increase in the prices. So 6 lakh they have given as first year revenue, but this is ignoring inflation. Before applying inflation, inflation means what? The sale price cost will increase. So first year increase is by 10%. So on 6 lakh increase by 10% means how much? 60,000. So actual sales will become 6 lakh 60,000. 6 lakh is before inflation. Apply 10% inflation. Inflation is increase in the cost, increase in the price. So 6 lakh plus 10% means 60,000 becomes 6 lakh 60,000. Second year is interesting. Second year, how do you calculate? 6 lakh, second year amount is 7 lakh. Don't do 7 lakh into 9%. Don't do 7 lakh into 9%. 7 lakh is before considering any inflation. Now, from today, if I have to come to year 2, I have to cross year 1 and then come to year 2. Please understand, if we are at year 0, we have to come to year 1 and then we have to come to year 2. Year 1 inflation is 10%, year 2 inflation is 9%. So if I have to come to year 0 to year 2, that means suppose if they have given 7 lakh, 10% inflation means I should multiply it by 10%. So basically 70,000 I get. So at the end of the year I get 7,70,000. Then on that 9% I get. But instead of that directly can I calculate? Compounding interest method. How to calculate directly? 1 plus 0.1. You remember 1 plus R. 1 plus R is keep multiplied. That is 10%. Second year 9% means 1 plus 0.09. So first year revenue, how do I get? Multiplied by 1 plus 0.01, 1 plus 10%. Second year revenue, how do I get? 1 plus 0.09. 1 plus 0.1 into 1 plus 0.09. Third year, 1 plus 0.1 into 1 plus 0.09 into 1 plus 0.08. We keep on multiplying by 1 plus R like this. Are you getting the point? Like this we compute revenue, like this we compute cost, then we compute depreciation, we get profit, then we get tax, we get profit after tax, we add back depreciation, we get cash flow. From the cash flow, we apply discounting factor, we get present value of inflows, we subtract investment, we get NPV. Did you get the point? What is the extra thing in this problem is the impact of inflation. What is inflation? Increase in prices. What is the impact on our calculation? Sales, whatever they're given, increase it by inflation. How do you increase? 1 plus R, 1 plus rate of inflation for first year. But for second year, what you should do? Don't take only second year inflation. First year inflation and second year inflation you should take 1 plus R for first year inflation, again 1 plus R with second year inflation. Similarly, when you go to third year, again 1 plus R you multiply. When you move on, again you multiply it by 1 plus R. So every time you move from one year to another year, inflation rate, 1 plus inflation rate is kept on multiplied. Same thing with for revenue, same thing with for cost. Are you clear? Shall we go to calculations? Okay. Let's go to revenue now. What revenue given or before inflation, I'll say 6 lakh, 7 lakh, 8 lakh, 8 lakh. 6 lakh, 7 lakh, 8 lakh, 8 lakh. Inflation rate, applicable inflation rate. First year, inflation rate, you take how much inflation rate first year? 10%. But when you come to second year, you should not take only 9%. Take first year, comma second year. Both will have impact. From year 0, have to come to year 2. Similarly, year 3 means 10%, comma 9%, comma 8%. For year 4, all the 4 I should take 10%, 9%, 8%, 7%. Okay, so how do we calculate the revenue? Revenue after inflation. First year we do 6 lakh into 1.1. Second year we do 7 lakh into 1.1 into 1.09. Third year I don't have space here, so I'll write here 8 lakh into 1.1 into 1.09 into 1.08. Fourth year 8 lakh, I don't have space here, so I'm managing it, into 1.1 into 1.09 into 1.08 into 1.07. I don't have space, so I'm trying to managing it, fitting it here. So what is the applicable revenue now? First year 6 lakh 6,000, 60,000. Did you get the point, my dear friends? First year only 10%. Second year 10% also I should take. 9% also I should take. Third year 10% also I should take. Second year 9% also I should take. Third year 8% I should take. So 1.1 into 1.09 into 1.08. Fourth year all the 4-year inflation, because inflation keeps on increasing every year. Every year increase in price I should take. So first number we get 6 lakh 60,000. Second number 7 lakh into 1.1 into 1.09. 8 lakh 39,300. Third number 8 lakh into 1.1 into 1.09 into 1.08. 10 lakh 35,936. Next fourth year 8 lakh into 1.1 into 1.09 into 1.08 into 1.07. 11 lakh 8,452. So this is revenue. Applicable revenue, total revenue. Similarly, we are going to do for cost. And for the cost, different inflation, because the revenue will increase different percentage, cost will increase different percentage. The inflation for different commodities will be different. So cost given 3 lakh, 4 lakh, 4 lakh, 4 lakh. So 3 lakh, 4 lakh, 4 lakh, 4 lakh. Okay, this is cost given. Applicable inflation rates. Applicable inflation 12, 10, 9, 8. First year 10%. Second year, sorry, 12, 10, 9, 8, right? Yeah, 12, 10, 9, 8. So applicable inflation 12%. Second year, don't take only 10. First year inflation 12 and second inflation 10. And third year 12, 10, 9. And last year 12, 10, 9, 8. All four you should take. So how do we calculate this one? 3 lakh multiplied by 1.12. That's for the first year. Second year 4 lakh into 1.12 into 1.1, 12% also, 10% also. Third year 4 lakh into 1.12 into 1.1 into 1.09. All the 3 years I should take. And last year, I just around a space or right below, 4 lakh into 1.12 into 1.1 into 1.09. And the last year rate 1.08. So that will give you 3,36,000 for first year. Second year 4,92,800. And third year 5,37,152. And last year 5,80,124. This is the cost after inflation. Okay, hope you got it till here. See, please confirm if the amounts are right. All the amounts are right. Okay, so revenue is done, cost is done. Now we'll go for one more cost. What is that? Depreciation. What is depreciation? Depreciation charge, they say 2 lakh per annum because 8 lakh, no scrap value, 8 lakh by 4, 2 lakh. Directly you get. So depreciation, you can take every year 2 lakh. So profit before tax, you calculate PBT, 6 lakh 60,000 revenue, cost 3 lakh 36,000 minus depreciation 2 lakh. Are you able to get it? Any doubts? Please let me know. Should I repeat any explanation? Okay, so how much you're getting profit? 6 lakh 60,000 minus 3 lakh 36,000 minus 2 lakh. You get 1,24,000. Similarly, 8,39,300 minus 4,92,800 minus 2 lakh. You get 1,46,500. 10,35,936 minus 5,37,152 minus 2 lakh 2,98,784. 11,08,452 minus 5,80,124 and minus 2 lakh will give you 3,28,328. So that is your profit before tax. Please check if the amounts are correct. Profit before tax. Okay. Subtract tax 60%. 1,24,000 into 0.6 into 60%. 1,46,500 into 60%. 2,98,784 into 60%. 3,28,328 into 60%. You get tax. You get profit after tax. 1,24,000 minus 74,400. You get 49,600. 1,46,500 minus 87,900. You get 58,600. 2,98,784 minus 1,79,270. You get 1,19,514. 3,28,328 minus 196,997. We get 1,31,331. But we need cash flow. Add back depreciation. 2 lakh, 2 lakh, 2 lakh, 2 lakh. We get the cash flow after tax, which is what we wanted ultimately. Cash flow. So revenue we calculated, cost we calculated, depreciation given, profit before tax we calculated, minus tax, profit after tax, add back depreciation, cash flow after tax, CFAT, cash flow after tax. After this, we have to prepare the tabular format, but anyway, we've done so much here. Here only we can continue. No much calculation after this. So multiplied by discounting factor at 10%, 1 by 1.1 equals discounting factor we get, multiply. Here only we can complete the solution. 2,49,600 into 0.9091, 2,26,911, 2,58,600 into 0.8265, 2,13,733, 3,19,514 into 0.7514, 2,40,083, 3,31,331 into 0.6831 will give you 226,332. You add all, you get 907,059. You add all this present value. Hope you're not confused. Instead of writing in a vertical format, I'm writing horizontal format. Year cash flow, discount cash flow, like that. I'm writing in a horizontal manner. So add all these cash flows, discount cash flow, you get present value inflows minus investment 8 lakh. NPV you get 107. NPV is positive. Project can be accepted. Please write down till here. Let me know if you have any doubts. Okay, hope it is done. Please confirm. Any doubts in this one? So when inflation is given, revenue should be increased, cost also should be increased. But be very careful, don't apply only that year inflation. You should apply cumulative inflation. First year to second year, then to third year, then to fourth year. Why cumulative in this question? That is the impact of inflation always, no? Like if your today's salary is, if you got a job, 1 lakh, and if you want to know what will be your salary after 2 years, you apply first year inflation and second year inflation, right? Like that. Revenue 7 lakh. Here we got revenue 7 lakh for second year. But this is without inflation. So when I say with inflation, first year inflation I should apply, second year inflation also I should apply. That's why it's cumulative. So from today, if you want to go to year 2, both their inflation you have to apply. Similarly for year 3 and year 4. So you have to apply on a cumulative basis. That is the concept of inflation. Okay, hope you got it. I'll go further.
Okay. Next problem is regarding replacement of machine. Whether to replace or not is a IPCC level question. It can still be asked. If they ask you, should the machine be replaced or not, compute NPV. NPV is positive, replace the machine. NPV is negative, don't replace the machine. We are not going to do that problem. The problem is, once you purchase the machine, when it should be replaced. Let's say useful life is 5 years. Should I replace after year 1, after year 2, after year 3, after year 4, after year 5? 5 alternatives are there, 5 times of replacement. And I will compute NPV under all 5 alternatives, but they are not comparable because the term under each alternative is different. How do you do in such case when the useful life is different? Projects of unequal life, first problem we discussed in this segment, in the previous segment at final level, EAC. The present value what you get, divide by annuity factor, you get equated annual cost, and that is to be compared when the project is unequal life. The same thing we are going to apply. Let's do a problem. Now, nothing to write down. Solution is there in the material. Stay focused. Just understand. Nothing else is required. No need to write down. Just understand. Okay. Let's read. X Limited is a taxi operator. Each taxi to cost to company 4 lakh, useful life of 3 years. Taxi's operating cost for each 3 years and salvage value at the end of year 3 is as follows. You are required to determine the optimal replacement period of taxi if cost of capital of X Limited is 10%. Just 1 minute, just read the problem. Okay. Now, just observe here now, you have 3 years. You can replace after year 1, you can replace after year 2, you can replace after year 3. If you replace after year 1, today anyway you have to pay 4 lakh. After year 1, you have to pay 1,80,000 and you get resale value of 2,80,000. First option. Second option, you have to pay 4 lakh today. You have to pay 1,80,000 after year 1. You have to pay 2,10,000 after year 2 and you get 2,30,000 after year 2, salvage value, inflow. So 4 lakh is outflow, 1,80,000 is outflow, 2,10,000 is outflow, 2,30,000 is inflow. Remember, again don't take 2,80,000 into consideration. You can't sell 2 times. Operating cost will come in both the years. Resale value will not come in both the years. You can't sell 2 times. No double acting and all here. Okay. So if you are taking year 3 replacement, 4 lakh today, 1,80,000 after year 1, 2,10,000 after year 2, 2,38,000 after year 3 and 1,68,000 inflow after year 3. Don't take 2,80,000, 2,30,000 then. Okay. So that's what happening here. Operating cost will come every year, but salvage value will come only in the year of sale, not prior to that. Okay. Solution is there. Take a look at this. If you replace after year 1, today cash flow 4 lakh minus first year outflow operating cost 1,80,000. Second year, first year out inflow 2,80,000 salvage value. Replace after year 1. Replace after year 1. Replace after year 1. Multiplied by discounting factor, you get this present value and you get the NPV minus 4 lakh, this present value, net present value. If I take it replacement after year 2, year 1, cash flow 1,80,000, first year operating cost, second year operating cost 2,10,000 outflow, and second year you get the resale value, salvage value because you are selling after second year. That is 2,30,000, 0.8265. Do the total, NPV will become 5,47,108. Now if you replace after year 3, initial cash flow 4 lakh, first year operating cost will come 1,80,000, second year operating cost will come 2,10,000, third year operating cost will come and third year replacement, so third year salvage value inflow 1,68,000, discounting factor NPV comes to 3,89,000. So it comes to 7,89,000. That is also inflow. So can I say that these are NPV, take whichever is less because all are negative? You say this one. And don't tell all 3 are negative, so don't replace at all. No, this is a costing problem, which means we are not considering the cash flow generated by these machines, this car, this taxi. So we have to choose whichever is cheaper. Don't say all NPV are negative, so don't replace it. No, don't go for it. We have to choose one of them. Since it's a costing decision, you choose whichever is cheaper. Now, this NPV relates to 3 different periods. Unequal life, not comparable. So these 3 NPVs, 309 100, I'm rounding it off. 547 100, I'm rounding it off. 789 801, I'm rounding it off. Or let me take the actual number only. What will happen? 309 090 547 108 789 801. Just give me 1 second. Divide by annuity factor. Just calculate how much you get. Please calculate in your material ones. Just calculate. So we get 3,40,033, 3,15,336, and 3,17,699.5. Let's say 700. Got it? So, since the time period is different, unequal life, all the NPVs are divided by respective annuity factor 0.909 only for the first. Then these two numbers are added, you get 1.735. Then 3 discounting factor is added, you get 2.486. So those are the EAC you get. Now they are comparable, everything annual terms. Then you choose whichever is cheaper. Second option is cheaper. So decision is replace after 2 years. Replace after 2 years. So solution is the material. Just go through it. Simple step. When to replace? All 3 options. Compute NPV, divide by annuity factor, choose whichever is less. That is based on EAC. NPV by annuity factor is AAC, EAC. Choose whichever is less. That's all. Done. Next.